Some single stocks definitely worth focusing on. We'll keep an eye on the luxury space, the engineering space, and all that is happening within it. Let's take you now to that market open. It's time for the opening trade. We're just going to get through today, basically, get into the long weekend. Let's talk about the market open and see what exactly is happening. We're expecting London to be fairly flat at the get-go this morning, and that is exactly what we are getting, down by 1/10%. Losses in Madrid, I see that. It's maybe appropriate, actually. It just goes into the green just for annoyance. I was expecting some losses to come through in Madrid. The red, actually the black, probably more an emphasis there as we watch Arsenal do very well down in Madrid. Anyway, that market is down by 1/10%. I'm talking about the football because, to be honest, there's not actually that much to see in European equities this morning. We are down a little bit, but US futures are pointing us fairly positive, so it'll be interesting to see as the session progresses, maybe some of that positivity kicking in to what we see in these European markets. Chrissy.
I have no sports knowledge to offer and to match, so I'm going to just go straight into what's moving this market, which is a lot of tech seems to be on the downside. A lot of healthcare seems to be on the downside as well. But banks, they're kind of in the positive, but really they're flat. And I guess in a market that is selling off across the board, that is a good sign. I am seeing several of the commodity names lower as well. To me, Anna, this just seems like a market that wants to pull back ahead of a long weekend.
There are only two sectors in positive territory that I can see this morning: industrial goods and services, banks, autos and parts. That's also in there now. I'm not going to mention cars or car parts, but industrial goods and services is interesting. We're still waiting, I think, for ABB to open and Siemens Energy to open, but others sort of in sympathy with that sector, perhaps moving a little higher. There we go. ABB is up by 4.5%. So that's certainly one that we are watching. Consumer products and services is the weakest performer, and this goes to the luxury story as well. Hermes down by 3.3% on the back of the numbers they put out. So the fact they say it's tough comps with China in the first quarter is not cushion enough for the business, it seems. And there's still some more downside following the selling we saw on the back of LVMH.
So China was weak. They're also going to raise prices in the United States. Does 10% make a difference? If you want to buy a Birkin bag, if you can get on the list, if you can buy a Birkin bag, does it make a difference? I don't know. It's going to be interesting to see just the price tolerance that American upper-end consumers do have at the moment to what is happening here. It's interesting. Ferrari's pushing up prices. Hermes is pushing up prices. They're not pushing them that hard. They are pushing them a little bit. Are they going to reach some resistance at some point?
I think we should send you on assignment to buy a Birkin.
I'm up for this.
Charge it to the corporate card and just come back and tell us your experience. What do you think?
Yeah, cool. I'll do it on Tuesday morning.
You can interview the folks who are buying it, see if they're going to talk about the price increases. We'll pitch it to the bosses in charge. But at the core of this is jokes aside, very much that price tolerance story, not just at the upper end, but at the kind of middle class end as well. And you're seeing that in some of the buybacks and the operational guidance that is potentially being suspended over in the States in certain parts of the market. Does that sustain and does that spread throughout the rest of the world, given the volatility that we are seeing? Well, Carlyle Group CEO Harvey Schwartz spoke to Bloomberg about that volatility. Take a listen to what he had to say.
I think they should still stay buckled. It's just a question of whether or not the airbags come out now. But I think that, I think this is an environment where if you have a lot of tolerance for volatility, then you can lean in. I think if your tolerance for volatility is low, then you should be protecting capital.
There, the Carlyle Group CEO. We'll stick with that theme of volatility and bring in an expert here. Remy Olupitan, head of multi-asset growth and income over at Schroders, joins us around the table. Pleasure to have you. Good morning. Talk to us about this volatility. Harvey Schwartz there saying, buckle up. Do you have to be a player at scale to take advantage of some of the volatility?
Yes, I mean, the time horizon matters. We're in this acute phase of shock right now. A lot of investors were not expecting this level of tariffs, so it's causing some concerns. And there is a debate whether this is a trade war morphing into a financial war. And so that's creating a lot of nervousness, and it will require time for this to ease. Yesterday, Powell didn't provide the necessary commentary that investors wanted with regards to providing that liquidity that equities really love. And so it feels like the market is left to its own devices and to have a lot of concern with regards to the noise.
So let's doomsday this out a little bit, in case we haven't already. This idea of not getting that liquidity or that Fed put, what happens if we never get it? What is the worst case scenario in terms of these markets that, as Chair Powell said, are functioning correctly, have plenty of liquidity at the moment? Does that simply just mean it takes longer for markets to recover from any sort of sell-off?
Well, we just have to reset at the right price. And so it becomes a valuation issue in that things just need to get cheaper. And so that's why, yes, we'll continue to have volatility, but that reset will happen. There are lots of attractive stocks, lots of innovation that still exists. It just means that the growth rate that we were projecting in January is that much lower.
The Wall Street Journal keep writing pieces about the fact that the buy-the-dip strategy, which has worked so well over the last few years, is now being seriously called into question. Investors are not necessarily doing what they have done for the last few years. How different is this environment for investors relative to where we've been over the last 10, 15 years?
I think it's because the instability is coming from the US. So for the last 10, 15 years, we had stability. We could price. We could more or less anticipate the direction of US policy. Now that you have so much policy unpredictability, you don't have that tailwind providing you with that comfort to buy the dip.
So what do? You talk about a reset. Do I stay invested during this reset? How do I manage a reset to a lower price that allows me an attractive entry point once again?
You need a lot of liquidity, so some cash on the sidelines. But look elsewhere. Does it just have to be the US right now? There are lots of other markets with much better valuations outside of the US, Europe. We've seen that this year, Japan recently.
And they can go up if the US goes down?
We think that we will see a capital reallocation. So a lot of that demand for the US, unquestionable demand for the US, has to move elsewhere. And there will be a time where those markets will go up if the US goes down, particularly if we have a consumer recession in the US, which is something we're not used to.
No. Yes. So, Remy, that's interesting, that allocation and the resilience of that reallocation story to Europe, because you talk in your notes about how this is a generational economic change. And that's characterized by a move towards more proactive fiscal policy, protectionism, anti-immigration. We see some of those things in Europe as well, don't we? I mean, maybe not the protectionism yet, but they're still working out what to do in response to Trump's tariffs. But you think that money can still find its way then from the US to Europe?
Two reasons. First of all, a rebalancing. I mean, we think that a lot of investors, particularly asset owners, haven't really necessarily needed to rebalance their allocation from US assets. Now that's being called into question. There's a bit of a confidence crisis. So that rebalancing, moving away from just extended passive overweights and reallocating back to benchmark, will support other markets like Europe. But for once in so many years, well, certainly since the financial crisis, we're actually spending in Europe. And that's coming from the fiscal side, which is something that typically happens in the US. Now, investors follow capital. If policymakers are providing that capital for the economy, investors will do the same.
Okay, and you focus on growth. You also focus on income. And I wonder, when you look at income right now, how reliable are estimates of income? Because a lot of companies are telling us, well, if they're sticking to guidance, some of them are saying, this is what we think will happen, but also this other thing could happen, which is much, much more negative, depending on how things play out. So how much can you rely on your estimates of income?
No, that's a very fair point. Right now, we can't. We have to be very, very cautious. We also have to apply haircuts. to those estimates of income, particularly from dividends. On the fixed income side, income's getting much more attractive. So we're seeing much higher yields. But again, we've got to hold ourselves back and just not rush in just yet. So these yields are rising for very good reason. One thing that's a bit nerve-wracking is just seeing higher yields in US Treasuries, particularly at the long end. So that is a bit of a concern and a reason to not rush in just yet. So a little bit of patience is required, but you're absolutely right. We cannot rely on the numbers we're seeing. We have to scrutinize the income right now.
Give us a floor, give us a ceiling for this kind of new higher range for Treasuries.
No pressure.
No pressure. I mean, one of the things we've been really worried about in multi-assets at Schroders is 5% becoming the new norm. So if you think about it, between 2010 to 2020, 0 to 1 was the new norm. So we think that 5% becomes the new norm, which means we can move comfortably above 5% over the next few years. So perhaps I think we should just become accustomed to 5 as the new starting point.
Corporate balance sheets, you could argue, are in better shape than government balance sheets. Should I buy credit rather than govies? Because actually I have maybe more certainty about where credit is than I do about where govies are.
I think you're absolutely right about that. The only concern we have at the moment is that that theme is something a lot of investors have bought into quite heavily over the last 18 months. And that's why particularly high quality credit, the spreads are not attractive enough for the concerns.
Do you think there are going to be better entry points?
There will be better entry points. And your point about corporate balance sheets being very attractive is absolutely fair. Compared to any other time in history, particularly at the high quality end, these balance sheets are solid. There's a lot of strong cash flow. So I think, again, it's about just being a little bit more patient. And pausing.
Pausing?
Pausing.
Which you did. That was nice.
Yeah, nice little pause to go into. Nice to see you. Thanks for stopping by to see us. Remy Olupitan, Head of Multi-Asset Growth and Income over at Schroders. Call 6 looks like this morning. A few interesting stocks on the move this morning. The luxury space certainly is absolutely front and centre. LVMH, Hermes vying for the world's largest luxury stock this morning. LVMH down a little bit, but Hermes is down significantly more. Ferrari under a little bit of pressure as well. Schneider Electric is up. Have you seen Siemens Energy this morning? It is certainly popping. Let's get some other single stocks. Here's Joe.
So Siemens Energy is the place to start, Guy, because that's really the big outperformer today. We're up around almost 10% now. It was a little bit higher than that. And also lifting the parent company, Siemens, as well. It does seem to be about the margins and the wind turbine business looking pretty strong. And actually the electricity grid business not doing too bad either. So both of those sectors or industries getting a boost for Siemens Energy. The best performer on the Stock 600 today. Then in terms of luxury, Hermes, that's the real notable underperformer today. We are down at 3% at the moment. Now, a pretty big move in terms of the size of the company. It's the biggest points weight on the Stock 600 this morning for Hermes, missing expectations. Moncler, all those Stone Island jackets you see at football stadiums mainly, that one actually not doing very well either, coming down 3%, a bit of a miss there. And Brunello Cucinelli, fancy cashmere sweaters, also a bit of a weak spot today. All of those luxury stocks lower this morning. Then in terms of drinks, we had numbers from Pernod. Now the company does seem to be hit by China's anti-dumping measures on brandy. That is a weight on the stock at the moment and continuing to come down after a big sell-off over the past couple of years. And we are seeing weakness across the other drinks makers heading in to the long weekend where there might be some brandy drunk, I imagine. And then moving over to Sainsbury's, looking a little bit better in the pre-market indications on that. We're seeing that feeding through today. Lots of Easter Sunday roast dinners going to be sold at Sainsbury's, but importantly they are doing a bit of a shareholder return, a capital return, amid a pricing war with Aldi and Lidl ramping up discounting. Sainsbury's having to do that, and actually not much profit at all going to be reported for the year ahead. So Sainsbury's actually beating expectations in terms of the returns, but the sales and profit looking pretty weak at Sainsbury's today. Then Forvia, we're all licking our lips over this one, the car parts maker, not actually as exciting as we expected, up 3% at the moment. It was up initially around 8 or 9% at the open trading in Paris, the car parts maker, but pretty positive on that one following a slump. And then finally ABB with the big news about the robotics business being spun out. getting a boost on that stock. That's a big company as well, about $95 billion market cap, and that unit is around 7 or 8% of the company, so it would be a significant spin out for the business, and is boosting that stock very slightly, up 1.8% for ABB in Zurich this morning.
Joe, thank you. Joe Easton.
Can I just say that Anna groaned when Joe said that?
Very quietly, off mic. I remain professional.
You were expecting more excitement out of Forvia this morning.
There was more excitement out of Forvia at the beginning, but, you know, we're 13 minutes in and some of it's waned. Maybe that tells you something about market sentiment. There's only so excited you can get about a relatively small car parts supplier, but it did lift the sector. Right, enough of that. Coming up, as Joe mentioned, Hermes shares lower as weak Chinese demand hurts its sales. We get a deep dive on the results and the darkening outlook for luxury next. This is Bloomberg.
To Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Welcome back. You're watching the opening trades. European equity markets are open this Thursday. We're down a little bit, 0.2% on the Stock 600. One sector on the upside really stands out. That's the energy sector. It's up by 1.22% this morning. On the downside, you've got construction and materials, certainly exhibiting some weakness this morning. But the second worst performing sector is basically the luxury space, and that's an Hermes story. We'll come on to that in just a moment. Technology is not actually doing very much in Europe, kind of mid-table at the moment, but we have had TSMC out with numbers overnight, reporting first quarter profits that beat estimates. A couple of customers kind of slightly scrambling to stockpile advanced chips in the United States ahead of the tariff war. Has that created a little bit of pull forward? Let's find out. Bloomberg intelligence analyst Matt Bloxham joining us around the table. Is that how I should read this? Slightly better than anticipated, probably because of tariffs, but actually net fairly good.
Yeah, I think, it's encouraging the message they're giving about, it's doubling in AI chip demand, that underneath everything structurally, the AI story is still there. I think a lot of this may well be tempered by the uncertainties that around what's going to happen with tariffs. They've kind of put an outlook out there based on what they see today, but obviously the world could change, as we know, tomorrow quite significantly, and obviously they're massively exposed to tariffs. We're waiting for Trump to come out with specific tariffs on chips and smartphones, so that there could be a sudden break on demand for some of these things into the second half. So they're all the right things, everything they can do to kind of prepare for this, but as I said, the outlook could change.
So TSMC kind of coming in, as you say, better than expected. That is not the messaging we got from ASML yesterday. Can you connect those dots for us?
Yeah, I mean, actually, when you kind of drilled into, like I say, the kind of the ASML order number was lower than people expected, but actually the commentary from ASML was that, orders are very lumpy, don't read too much into that. They're actually quite consistent with TSMC saying that underneath everything, the demand is kind of robust. They're not seeing any material changes. I think one of the things that doesn't quite connect from TSMC today is what we heard from NVIDIA about the H20 chip constraints and the $5.5 billion write down they're going to have to book against that. That ultimately, will kind of flow through to slower demand for TSMC. Now, TSMC said that they've kind of taken all this into account in the guidance they've given, but these kind of shocks to the system, potentially going to keep people a bit cautious, I think, about getting too optimistic.
Yeah, and we saw NVIDIA, it was only down 1% actually by the close yesterday on the back of that $5.5 billion hit from these new China curbs from the US administration, the H20 as you referenced. Now we've had some more time to look into that, is there a sense that there's more write down to come on that front? Because a lot of people were trying to join dots saying, wasn't this chip made only for China, and hasn't it the potential to sell a lot more than 5 billion? So how big is the hit, I suppose, is the question.
Yeah, and I think people are still kind of trying to figure that question out, as that could be just a bargaining chip that the US administration is using in the negotiations with China. It may not, so it's hard to say, but I think people will be I'd say just cautious that there could well be further negative shocks coming in the future, in the coming months, whether it's more things like the H20 chip, or whether it's like, constraints on chips for smartphones, which kind of tempers demand for smartphones. So there's lots of moving parts here that, are going to take a while to settle.
What do you think's happening? I'm really curious about guidance. There was this temptation, I suspect, for many CFOs, CEOs coming into this reporting season to abandon guidance. We don't know. There's too many things going on. We have no idea what's... A lot of companies seem to be sticking with guidance, but adding a line, this is related to current information.
Yes.
How solid do you think guidance is at the moment within the chip sector, within the tech space?
Not very.
Right.
And, we've also seen this with like a lot of the ad agencies too, that, Omnicom cut the bottom end of their guidance, but Publicis, for example, maintained their guidance range. And again, it's like you said, it's based on what we know about the kind of current economic situation and some anticipation there might be a bit of weakness into the second half. But that, as I said, that could all change overnight. And, I think it's a responsible position for companies to take. They don't know what's going to happen. So on their best knowledge about the situation today, they're kind of sitting with their view, and it may well be that we through a period of volatility we come out and actually there's no recession, that there are no tariffs, or the tariff situation ends up being a kind of relatively minor thing, and that actually we're kind of where people thought we were coming into 2025. So I think
but the risk is to the presumably the risk is to the downside in all
like
of this.
The risk is to the downside for sure. Yeah.
All right, Matt Bloxham from Bloomberg Intelligence walking us through the tech sector and all the pieces through it in every part of the world. We thank you so much. Let's go to the other heavyweight, and that, of course, is the luxury sector. Hermes shares down this morning after the maker of the coveted Birkin bag reported weaker China sales. Let's go to Paris now and bring in Angelina Rascouet, who, of course, covers the sector for us. Angelina, your initial read of some of these numbers?
Hi there. Yes, indeed. I mean, it was a slightly disappointing quarter for Hermès. Sales in China, I mean, in the region that includes China, were up about 1%. So they're still growing, but obviously it's a region that generates about 48% of Hermès revenue. So that's actually a much bigger an exposure than, for instance, LVMH, which generates about 30% of its revenue from the region. But overall, you know, analysts still seem to be quite positive on the company, because it's the most resilient, it's the most exclusive brand as well that's out there, and typically they enjoy a business model that is scarcity driven.
Yes, and for that reason, maybe they, out of all of the luxury businesses, Angelina, might have more luck putting up prices, and they've talked about that today.
Yes, indeed. So obviously we've had the announcement that the US is going to impose 10% tariffs on EU goods. So the CFO told us that as of May 1st, Hermès will fully compensate those duties. They're still ironing out the final prices, but yes, it'll be on all product categories in the US. So because they had, you know, they enjoyed the pricing power, and they can do it. So we'll see, you know, what happens if we eventually go to 20% duty in, at the, you know, after the 90-day period. But so far, that's the strategy.
Do we know how much inventory they have inside the United States at this point? Do we have an idea of what the next few quarters look like? We don't know what's going to happen with tariffs, but are there enough bags in the United States to satisfy current demand?
I mean, generally, it's true that some of the companies, and we spoke with, you know, we heard from LVMH this week, and they have shipped more wines and spirits, for instance. However, because Hermès, you know, it's not like their model is constrained by their output capacity. So every year they try to increase output, especially of the leather goods, between 6 and 7%. So I don't think they can really ship more products. If there's some management of maneuver, it would make sense for them to do so, absolutely.
Thank you very much. Thanks, Angelina. Thanks for bringing us the story. Bloomberg European luxury and retail reporter Angelina Rascure in Paris with everything we need to know about that sector. The CAC 40 underperforms a little bit, and some of that is to do with that luxury story, isn't it? The DAX up by 0.4%. That's Siemens Energy doing the heavy lifting there, but the CAC 40 a little under pressure. But really, we're kind of flat, waiting for the ECB, I suppose, and the long weekend.
And the long weekend that is definitely coming towards us. There's also another big political event that is going to be coming up. Georgia Maloney is in Washington, and I am fascinated, given what happened with the Japanese yesterday, how she gets on a little bit later on.
Well, she's meeting Donald Trump today, that she's getting on a jet, I'm assuming.
She's done
back
that.
To Rome.
Oh, she's going back to Rome, and then she's meeting J.D. Vance tomorrow.
J.D. Vance, who's also on his way from D.C. to Rome. I don't know if they're carpooling.
Why?
I couldn't tell you. J.D.
Vance goes on tour. We know this.
Yes, he's going on a one-week tour to Italy and then to India. Part of this. On top of that, Iran and the U.S. are also having negotiations in Rome. So there's a lot happening in Italy.
Of an Italian nature.
Yes.
Yes.
Exactly.
Which is excellent for us, because we are going to be shining the spotlight on the Italian Prime Minister's visit to the United States. Matteo Renzi is going to be joining us next. We will have that conversation with the former Prime Minister of Italy. This is Bloomberg.
Let's cut right to it. This is Bloomberg's new show, Primer. Technology is $1 trillion game. won, lost, won again, just by backing the right science at precisely the right moment.
My life has been focused on how can you elicit intelligence from brain cells in a dish.
This is the fundamental building block of our fusion technology.
We're doing things that have never been done by anybody, ever.
Everyone is selling the future. If you want to understand what's coming, you'll want to watch Primer, because details matter.
Lasers on.
So do lasers.
There we go.
Oh, and it's on all these lovely channels. Hope you're jotting this down.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
This is the opening trade. We're at 30 minutes into today's session. Seeing a little bit of a mixed session. We're going back to the original, or what it feels like is the go-to European playbook, which is the DAX outperforms consistently. That is what we saw in the futures picture. Higher by 0.4%. Euro stocks as a whole flat at the moment. Underperformance right here in the UK, but only down by 0.2%, Guy. Let's see how this all shakes out.
Siemens Energy, I suspect the main reason for that outperformance that we're seeing coming out of the DAX. Siemens Energy. Let's turn to politics and back to the tariff story. The Italian Premier, Giorgia Meloni, is in Washington. Later, she is going to be meeting with the US President, talking about defense, talking about tariffs. Joining us now to discuss expectations for the trip and what can be achieved, Matteo Renzi, former Italian Prime Minister and current leader of the centrist party Italia Viva. Senator Renzi has, remember, called on the EU to appoint a special envoy to negotiate with Donald Trump. The name he has in mind, you've probably heard of him, Mario Draghi. Matteo Renzi, thank you very much indeed for joining us this morning. Let's start off with the Prime Minister's trip to Washington. What are your expectations for what she can achieve?
Good morning, and thank you so much for inviting me. But I think this trip will be very difficult to imagine the follow-up, because with President Trump, for the traditional politicians, myself, it's not easy to predict what he could do. It's a normal trip for a lot of reasons. It's normal to have diplomatic dialogue between USA and Italy. In this case, a lot of storytelling and narrative in Italy. Imagine Giorgia Meloni could win this official trip with if Donald Trump will change idea. But it's not clear what type of idea Trump could change, because for the tariffs, I think it's a mistake for America and it's a mistake for Europe. And for the dialogue between Europe and the USA, it's not a competence of a single country. It's a competence of the European Commission. So we have to wait for a meeting between President Trump and President von der Leyen. As Italian, I hope the dialogue will be good, will be fine, but I don't believe this is a good time. Those are really crazy times, and Europe needs a only one voice. That is the reason of my proposal for Mario Draghi as the only one special envoy for all the European Union.
One might think, though, that because Giorgia Meloni gets on well with Donald Trump, that maybe she can achieve more than maybe others could achieve. Mario Draghi, von der Leyen. I wonder whether this is about personalities. Trump has a different way of approaching these kinds of negotiations. You've seen that in his relationship with a whole range of leaders, that he requires a different approach, that he requires maybe, and people talk about people kissing the ring, that they go to Washington to pay homage to Donald Trump and not to build him up rather than knock him down. Do you think that Giorgia Meloni is better placed maybe to do that?
Maybe it's not easy. In my opinion, as Italian former prime minister, the idea to kissing ring is not the best idea to defend the national interest. But it's true, there is a very good relation in terms of political approach between sovereignists in Europe, as Giorgia Meloni, and sovereignists in USA, as President Donald Trump. I think for the Italian business, for the Italian economy, that is not a good signal. Why? Because we don't need sovereignism and protectionism. We are a country based on the export. We are the country of fashion, of food, of manufacturing. For that reason, we need globalization. The real point is Giorgia Meloni won the election with a platform very clear, focused on protectionism and sovereignism. But now, everyone in Italy understands for the Italian business, for the Italian interest, it's better if we have globalization and not sovereignism. About the possibility Georgia could be better than others because she's very familiar and friendly with Trump, why not? If she will be able to achieve an agreement with Trump for the ideological reasons, okay, we are very happy. We will be very happy. But I don't believe in that. Because the strategy of President Trump is a strategy, in my opinion, against globalization. And that is a problem for us.
Okay, Matteo Renzi, can you imagine where the landing ground might be between the United States and Europe? Is a meeting place, what does it look like? There's been talk of removing tariffs entirely on industrial products. That hasn't made any progress yet. The US administration wants to sell more cars and food to Europe. What does a landing ground look like to you?
Not easy to understand. First of all, the agreement have to be with the European Union and not with only one country, because that is the rule of Europe. Second point, in my expectations, the most important thing which Trump could exchange with Europe is the gas. After the closing of a relation between Russia and Europe, the surplus of production of gas in USA could be in the hands of European countries. Why? Thinking about Europe, thinking about Italy, we produce only 25% of our needs in the energy. So we need more gas. In my opinion, if I know a little thing about geopolitics, Trump could try to exchange a reduction of tariffs with an agreement of gas and maybe also in defense. Not about food, also because, okay, yes, he could try, but the quality of particularly Italian food is a quality, in my opinion, different for a lot of sectors respect to the food around the world.
So, okay, so that's your view there. Let me ask you about defence then. You mentioned defence as another area where some common ground could be found. How much more can Italy and how quickly should Italy spend more on defence? And do you think we will see a European army, a more substantial European army being formed here?
two different things. About the first, yes, we have to arrive minimum to 2%. That is not a request of Trump or a proposal of Mrs. Meloni or Mrs. von der Leyen. This is an obligation we, as Europeans, we bring in 2014. You remember during the World's NATO summit. So that is our obligation. We have to arrive to this point. About the European army, the question on the table is what is the future of NATO? Because in 2019, with the presidency of Donald Trump, with the president, I remember an interview of President Macron who used to say NATO is died, is a brain death, you remember. After Russian invasion in Ukraine, everything is changed. But the question is what type of NATO we will imagine for the next years. If there is a future for NATO, okay. In my opinion, Europe has to be more close in the organization of army. And I have a dream. My dream is the United States of Europe. My dream is European army. But to arrive to this dream, we need step by step. The first is combined together the investment in defense of Germany, France, and Italy. That is the priority.
Matteo, talk to us then about perhaps the posturing from Europe looking eastward. In the last couple of days, as European leaders digest the news from Donald Trump, there has been, especially led by the Spanish, a little bit of warmth towards a relationship with China as well, one that it feels like Ursula von der Leyen is leaning into with a visit this summer to Beijing. How should Italy be thinking about the relationship with China in the absence or potential absence of friendlier relations with the United States?
That is a risk, but that is a consequence of mistake of President Trump. My opinion is with this approach of President Trump, USA risks to lose the role as a global leader around the world. And we will go in direction of polycentric world. That is a problem because in my opinion, the United States has the best ally we have. But if Trump decides to declare a commercial war to Europe, it's normal there is someone in Europe who try to have other markets. Of course, China and the visit of Prime Minister Sanchez last week is a signal in this direction. Of course, India. Please consider India is the most important country in terms of population, Middle East, and potentially in the future, Africa. Then we will see what could happen after the end of the war in Russia. So in my opinion, with this approach of Trump, paradoxically, he risks to give an opportunity to create new alliances around the world. And that is a mistake for the United States.
Alliances on the geopolitical front, Matteo, but the argument for doing that and for leaning at least towards China specifically is that the businesses need kind of reliable supply chains and a reliable consumer base as well. As the geopolitics are figured out and the relationship on the political front is figured out and digested, are Italian businesses, do you think, prepared to kind of stop, to sit on cash, to be able to operate in an environment where the geopolitics are this volatile, or are we dealing with or looking down the barrel of a crisis the longer we wait?
It's very complicated and difficult to imagine today what could happen. But I think about Italy. I think about economy in Italy. We have 67 billion of export in United States. In my opinion, tariffs will be removed because that could be a problem in future also for both. But if those tariffs will remain in the next 90 days, I think will be normal for someone to establish manufacturing in United States, but at the same time to try to create new markets. And please don't undervalue the resiliency of the European industries. So it's normal. If this commercial war will continue, for sure everything risks to change in geopolitics. Because what the changes in the commercial world created a change in political worlds. In my opinion, as one of the best friends of the United States of America, I think we have to come back in an area of free trade, in an area in which it's normal to have a good partnership, particularly with the United States. If you think about what could happen, pharma, autos, wine, food, car industry, I think, of course, in the first period, we risk a problem. But the great problem is not the single budget, the single market. The real problem is the consequence in geopolitics of the tragedy of a break between USA and Europe. That is the reason for which I believe we will work all together to create an agreement with the Prime Minister Meloni, with the President von der Leyen, with the President Macron, but also with the Special Envoy to dialogue with the President Trump and his team.
Senator Renzi, final question. A lot of people are getting very excited that Germany is going to lead Europe when it comes to spending and deliver stronger economic growth. Do you believe that currently? Do you believe that Europe is going to be better economically as a result of what is now happening in Germany? How quickly does it happen? How does that change the dynamic within Europe?
Yes, I think Germany will lead in the next years European Union. That is the history of the last decades with Angela Merkel, when I was Prime Minister, and before with Helmut Kohl. Merz is not a member of my party. He's a center-right, I'm center-left. But I think today is the most important leader Europe will show in the international stage. So I believe that is possible. That is the future. There is one problem, I believe. Germany in the last years made too much mistakes. The first with the export with China, because we gave to Chinese too much positions in the car industry with the stupid decision of Green Deal. Germany have a strong relation with Russia for energy, and they decided to close nuclear plants, and that, in my opinion, was a stupid decision. And Germany have a traditional relation with America for defense. Germany today have to reimagine the future of Berlin, because no car industry with China, no energy from Russia, and troubles with the United States for defense. I think Merz could be the key leader, the real leader of European Union, if we'll be able to bring together the interest of Germany and a good relation with others waiting for the next election in France and in Italy in 2027.
All right, Matteo Renzi, former Prime Minister of Italy, we thank you so much for joining us from Florence this morning. Talk things all about Italy ahead of Giorgia Meloni's visit to Washington, D.C., Anna.
Okay, coming up on the programme, could Trump's tariff turmoil be an opportunity for emerging markets credit? We'll get back to the markets conversation. We will be joined by Tunde Lawal from Barings on set shortly. This is Bloomberg.
Walk is helping steer J&J into a new phase of its history, expanding the frontiers of healthcare by discovering drugs and advancing medical technology.
Developing digital robotic capabilities where it's not just the robot doing a surgical procedure. It's garnering information from that procedure for your specific demographic or the patient's demographic, and then informing the next procedure down the road. Right? It's getting smarter. I would say it's starting to morph into personalized medicine, which we know will lead to the best outcomes.
Innovative medicine and medtech are run as separate business divisions, but in the culture of research at J&J, they interact.
If you look at some of the spaces that we're in today, specifically oncology, there is a lot of dialogue going back and forth. I think it's something that will position us extremely well as we talk about not only a continuum of care, but also a continuum of knowledge.
The convergence of technology and medicine is driving innovation in both sectors, with scientific and commercial possibilities just beginning to come into focus.
I'd like to actually see some partnerships down the road happen between healthcare companies and technology companies. I think we'd get to better outcomes faster if we did that. Right now, technology companies don't have the healthcare knowledge. Healthcare companies probably don't have the breadth of knowledge they need for technology. If we can figure that out together with great minds from both sides, I think that leads to a much better place.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Default rates will undoubtedly rise. There's no question about it. That's a lock. That's a given.
If we were to see more big banks calling for recession, of course, they would be more reluctant to lend.
Spreads are not saying recession, and treasuries are not saying recession.
This is a public debt problem. It's not a problem in corporate balance sheets or household balance sheets.
Some of our guests on Opening Trade reflecting on repricing of credit markets in the days since President Trump's pause on expanded tariffs for most countries, 60 countries, wasn't it? Seems like a big journey we've been on the tariff narrative. Let's bring in Omotunde Lawal, head of EMEA Corporate Credit and Emerging Markets Corporate Debt at Barings. Tunde, very nice to have you with us. There's a lot to talk about then on this big journey that credit seems to have been on. We were listening there to a lot of people talking about volatility, but also saying, look, the markets are functioning. Would you say the same? Yes, there's volatility. We've seen some spreads go wider, but broadly speaking, things are functioning as they should.
Yeah, absolutely. I'd say things are definitely functioning. I think away from Liberation Week, where we had that huge spike of what's going on, I think we've really corrected ourselves. The spreads on the European investment grade side went from pre-liberation at 92 to 128, and then we're back at 116 now. So, minor corrections. And on the EM side, I think we went as wide as sort of 279, and we're back now around 272. So, again, the correction. So the panic, there hasn't been huge amounts of panic. Even Liberation Week, we didn't actually see huge amounts of selling there. There were wider bid offers that we saw, but actually largely not a huge amount of just hit any bid you get type thing. Yes. Primary markets did sort of shut down, and last week this week actually, we've had tentative moves around European investment grade where we've seen a few deals price.
Okay, so that's the spike up that we're showing there. On this is one of the measures of credit spreads. This is around EM, I think. So we're showing those, and as you say, they went up, then they come down a little bit. Do you get any sense that markets, whether it's EMEA corporates or emerging market corporates, are markets underpricing the risks here? Or are they doing what a lot of the companies are doing that we're hearing from at the moment, saying, well, we think there might be downside risk to our guidance or our consensus, the consensus views around us right now, but we don't know where to take our forecast to, so we'll just stick with what we've got.
Well, this is the key thing, right? Where we sit here today, it's the uncertainty. You speak to CEOs, you speak to treasurers, you speak to CFOs. You can't plan. You can't do your budgets. You can't forecast what your spending needs are or your capex needs. Therefore, you don't know what your funding plans are. That uncertainty isn't fully priced into spreads yet. Yes, we are wider from 92 to 116, but that's by no means recession-type spread levels, neither on the European side or the EM side. And so, yes, potentially there is more downside to come as we get more clarity, but right now the markets are pricing in a bit of uncertainty, but certainly not the deterioration in fundamentals that we may see if things get more clarity.
Can you connect the dots for us between maybe the dislocations we're seeing in the FX space right now and how that's reflecting in credit? You're talking specifically about EM, and I'm immediately looking at things like the carry trade. But it feels like the bond market and the FX market are on two different planets. How are you thinking about it?
Well, typically, rule of thumb people think is stronger dollar, not so great for EM. Actually, what we try to tell people is it's nuanced. You know, there are a lot of exporters within EM, and then there's a lot of domestic businesses. So when you get a stronger dollar, it doesn't mean it's negative. Right now, we've got the flip side where it's a weaker dollar. So actually, what we're seeing is people are moving into more domestic sectors. You know, people are looking at more domestic sectors in strong EM countries where you're saying, well, I want to be in healthcare, I want to be in TMT, I want to be in the strong banks, you know, I want to be in my more utility type sectors where I know inflation is under control in some of these EM countries. I'm going to be in the domestic sectors. I know that they could be in a position to cut rates in some of these countries depending on what goes on. And so actually a weaker dollar is not that bad for them. And then you sort of scale down a bit on your exporters. And actually we've seen a bigger hit on commodity guys and the exporters this time around in this bout of volatility, which actually does corroborate that point.
Do I make the moves now? Do I wait? Lots of uncertainty. I'm taking money out of the United States. I'm figuring out where I'm going to deploy it. Do I have enough information to make the decisions at the moment? If there's a global recession, it feels like all bets are off. We don't know yet. But it feels that those are really big fat tail risks that exist.
Absolutely.
Do I make that? Do you have enough decision? Do you have enough information at the moment to make the decisions that you feel are coming at this moment?
Well, no one has a crystal ball, so we all are working in this.
But this feels like a particularly opaque period.
Yeah, exactly. This sort of uncertainty, but you're making your best guesstimate of that. And so what we advise and what we are doing is saying move up in quality, move up into your investment grade stuff, because if you are going to get global slowdown, sort of recession, shallow, deep, whatever it is, it's the lower end of the rating spectrum that feels the pain because they can't refinance, they have more vulnerable balance sheets. So you move up in quality. And actually what we are also hearing anecdotally is people are saying, why should I be so overweight to US when I know that actually the US slowdown is probably going to be a lot harsher than the rest of EM. And so we're seeing some of that rotation, a bit more interest in EM. Because you take a look at it, actually, within EM, there's going to be winners to what's going on. You see, India stands to replace some of the demand that China won't feed into the US. So some of the Indian companies can do that. You're seeing Brazil, RG, in terms of soft grains, soft commodities, actually can supply China, where China is no longer buying soybeans and all these things from US. So actually there's good parts of EM that can actually step in the gap and benefit from what is going on with US and China. So that corroborates the point that you can move some allocation into EM. So whilst we all don't have a crystal ball, we know that the US probably will fill this more. And so it does make sense to move some of your eggs out of that basket into a more diversified asset class basket.
All right, I'm Matunde Lawal, head of EMEA Corporate Credit and Emerging Markets Corporate Debt over at Barings, trying to make sense of, I think what we're all trying to make sense of is, do you look west, do you look east, do you stay put and try to just tread water?
Yes, and the ECB trying to navigate that, just like the rest of us, I suppose. And so we look ahead, 1:15 UK time, the ECB rate decision, and then 30 minutes later we get the press conference. Is this going to be an ECB that, yes, cuts by 25 basis points, that's what the market expects, but then tries to say not very much about what happens next?
That appears to be what the strategy will be. We don't know enough yet. We're going to keep our cards quite close to our chest. It's interesting to hear, actually, Powell being more hawkish, Lagarde maybe being more dovish, but cautious dove. She's a cautious dove, it feels, right now. The Maloney meeting, I think, is going to be fascinating. Two quite decent events coming up a little later on today.
Absolutely. Risk sentiment is off ahead of that long weekend. We, of course, will have full coverage of that ECB decision, 1:15 p.m. today, as Anna said. So stick with us on Bloomberg Television. That does it for the opening trade. The Pulse is up next. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anim, only on Bloomberg. From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Fed Chair Jerome Powell strikes a more hawkish tone on inflation amid trade war uncertainty, dashing market hopes for a Fed put. U.S. futures rebound after positive signals from initial U.S.-Japan trade talks. The ECB has seen cutting rates again by a quarter point amid slowing services inflation and risks from U.S. tariffs. Plus, Hermes shares drop after sales disappoint. The luxury group warning tariffs will lead to price rises. Chipmaker TSMC gains after it maintains its full-year guidance despite growing trade worries. Welcome to the program, everybody. A lot to factor in then when it comes to a check of the markets. This is what we have for you right now. Futures are pointing a little bit higher. So we had some negativity at the end of the trading day in the US yesterday, or at the middle of it, really, around what we heard from Powell. No Fed put seemed to be the message there. But having said that, some progress. Japan-US trade talks lifting sentiment a little. This is the yield on the 10-year, a little calmer in treasuries than we were certainly last week. 113 is where we are on euro-dollar and 66 on Brent. This as we wait for the ECB rate decision, the big event, of course, of today. Let's take a look at the European market map then, an hour into our European trading day. We've got a couple of interesting dynamics taking place here. The French market underperformed right out of the gates. It's still weak, but it's actually joined in its weak performance by the DAX, which was outperforming at the start of the day. So we've lost some of the positivity on the DAX. The CAC is weak. A lot of that has to do with the luxury sector. Numbers out of Hermes, certainly a bit of a disappointment. Germany was doing well on Siemens Energy, but that has faded. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacroix.
Good morning and welcome to The Pulse. I'm Anna Edwards in for Francine Lacroix this morning in London. Now, the Fed chair has been dashing hopes of an early rate cut in response to President Trump's tariffs, signaling a wait-and-see approach on the impact.
Tariffs are highly likely to generate at least a temporary rise in inflation. The inflationary effects could also be more persistent. Avoiding that outcome will depend on the size of the effects, on how long it takes for them to pass through fully to prices, and ultimately on keeping longer-term inflation expectations well anchored. Our obligation is to keep longer-term inflation expectations well anchored.
Joining us now, our Markets Live executive editor, Mark Cudmore, with thoughts on the markets right now. Mark, so it seems widespread, the interpretation in markets was that this was a bit more hawkish. There was more emphasis perhaps on inflation, and we saw risk assets reacting accordingly to that. But under the hood, what did you take away about the reaction function of the Fed? Should we see a real slowing down of the US economy?
Good morning, Anna. I think the key point is that Powell is not close to delivering a Fed put, and that was why the overall interpretation was slightly hawkish. It wasn't so much that he is committing to, clearly not committing to rate hikes, nor that he was pushing back on the idea of rate cuts overall. He's more just saying, hey, first we've got to make sure we don't have a major inflation problem, and hey, yes, we're worried about the growth outlook, but the hard data hasn't turned down yet. It's the soft sentiment indicators. If we see that data turn down without inflation shock, well, then we maybe have to react. So I think it wasn't kind of giving the doves what they wanted as opposed to explicitly hawkish. It was basically the idea that, hey, we think the growth outlook is worrying. We think there are problems on the horizon, but we're not going to be rushing to the market savior just yet.
And what do you make of the trade talks that we've seen so far? A lot of emphasis this week on the talks between Japan and the United States. One of the details that stood out to me was that there were 75 minutes of conversation between the two teams. And for 50 minutes, President Trump himself was in the room, which I thought was quite an interesting takeaway. For markets, what are you watching for?
I'm expecting they'll still get some more positive sound bites out of the US-Japan talks overall. I think, remember, there's a 90-day window here for negotiations until these kind of reciprocal tariffs are meant to be reimposed. And I think that generally we'll get some positive sound bites. And I think that'll give the market encouragement that, hey, maybe deals could be negotiated. My worry is that at some point that we're playing a kind of game plan where, if the concrete deals aren't brilliant, and if the removal of tariffs isn't as absolute as some people are hoping for, then we're going back into that negative story. And I think one of the really interesting dynamics we've got at the moment is that tariffs overall are a much higher level than many people were considering only about 2 months ago. And they are going to be very damaging for the US economy and for the global economy. And they're going to be more inflationary. So we've got a massive stagflationary impulse that we didn't have a couple of months ago. And that's really genuine. We just don't know how strong it's going to be. And that means that I think we have to take a step back and not try to trade the theme too aggressively. Just because it might not be as strong as we thought maybe a week ago, it's still way stronger than 2 months ago, which means that overall, this is going to be a tough year for markets. Overall, US exceptionalism is over. Overall, the dollar is going to continue to appreciate, and I expect more bouts of treasury weakness ahead, but we don't have to trade those themes too aggressively. We can wait to the next iteration of the story, and in the interim, we can get some relief flarities.
Yeah, okay. Mark, thank you very much. Our Markets Live executive editor, Mark Cudmore, with thoughts on where trade negotiations meet markets. Let's take a step back and think about where we've got to on those trade negotiations then. President Donald Trump says negotiators made, quote, big progress in a meeting with Japanese officials seeking a deal to avoid higher levies. Joining us now, Brendan Murray, who, of course, runs our global trade coverage here at Bloomberg. And Brendan, that detail for me that stood out was that President Trump was in the room for so much of it. What stood out for you when it comes to the Japanese conversation as we know it so far?
Well, first of all, it was a surprise to all of us when the president posted on social media yesterday that he was going to participate in these talks. You can imagine the Japanese delegation scrambling to adjust to the fact that the president himself was going to be in the room. But I think that there are a lot of optics here to follow up on what Mark was saying, that the president, Japan being the first mover on these talks, the president wants to show other countries that, look, we're rolling out the red carpet for you. If you want to do a deal, we're open to talks, and that will kind of open the door to South Korea next week, India in a couple weeks after that, and who knows, who could come after that. So I think this was about setting the tone, and the tone being we have 90 days to hash something out. What exactly that could be, we don't really know. The real game here is about China and reducing the trade imbalance with China. Remember, Donald Trump's ideology of protectionism dates back to the 1980s when Japan was the big threat from Asia. So now that the context has totally changed.
Yes, and it is, when we're seeing these conversations play out, it's interesting to think about what is happening in parallel, what happens in sequence, how much do you get all of these conversations happening and delivering perhaps around the same time, which would make your life very busy, Brendan. Let me ask you about the US-China relationship then. We heard from the Chinese yesterday that they said they'd be open to talks, but the US needs to show respect. What progress have we made in getting people around a table? Because I'm not sure that's even happening yet.
Well, the optics from the Chinese side are interesting this week as well. We had President Xi traveling to Cambodia, to Malaysia, to Vietnam, talking about an Asian family that needs to stick together. So you have basically these two counterparts in this global trade war trying to line up their alliances and to make sure that that there aren't that trade in the region stays strong. So you have this interesting counterplay between what President Xi is doing and what President Trump is doing. Both different tactics, but trying to achieve the same goal.
Yes, both seeming to be going after China's neighbours. So China trying to bring them on board as this family, as you describe, and the US trying to isolate China from its neighbours perhaps a little bit and its other prior allies. Brendan, thank you very much. Brendan Murray, Bloomberg's Global Trade Czar, joining us with the latest on the trade story. Let's get a check on some of the biggest movers in the market. We've had some earnings to deal with as well. Joe Easton has a briefing. Joe.
So Siemens Energy really the standout performer today, Anna. We're up around 11%. The company reporting strength in its margins in the grid business, also the wind turbines. Now, this stock had a really poor run over the past couple of years after its spin-off from Siemens, but actually more than trebled in value, so investors getting a good return on Siemens Energy at the moment. Then in terms of luxury, kind of chalk and cheese in terms of the stocks that we've got out today. We've got Hermes, those £80,000 Hermes Birkin handbags not doing as much business as they were expected to, but only missing very slightly. So that stock coming down around 2% on the quarterly numbers. Moncler as well, that was weak. Your Stone Island jackets, favourites among football fans. That one looking a little bit soft as well. And Brunello Cucinelli in the cashmere sweaters, 900 quid they'll cost you for a cashmere sweater, but that one actually not looking too bad, but not the best day for luxury. Hermes still the most valuable luxury goods company in Europe. Then we've got Pernod Ricard. That was soft. The company missing on their sales. Once again, a big drop down in sales and facing some regulatory scrutiny over in China with some anti-dumping probes on brandy as well, hitting that company. Then we've got Sainsbury's, the firm, of course, gearing up for a busy Easter with all those Easter eggs. I've been down there to get mine already, thankfully. Now, Sainsbury's actually missed on the profit. The profit was weaker than expected. They're pretty much going to have no profit for the year ahead, but this was already priced in following a profit warning from Tesco and also from Asda as well. So actually priced into the market and investors actually buying back into that one today. Then finally, just to finish on a bit of deal news, ABB spinning off its robotics business. This is an almost $100 billion market cap for ABB in this company, about 7% of the business in terms of the spin out, the robotics unit. So that is being taken positively today. ABB rising 1.3% on that positive spin-off news this morning.
Okay, Joe, thank you very much. Joe Easton from our equity team with a briefing on some of those stocks that are moving. Joining us now to talk about where we go on equity markets, Natalia Lipikina, who's head of EMEA equity strategy at JP Morgan Private Bank. Natalia, thank you for being with us this morning. So let's talk about investor strategy and flows from the United States to Europe. It seems to be a big theme we talk about with lots of investors at the moment. What are you seeing in terms of the European investor base and their desire to bring money home?
Good morning. Very nice to see you. We're definitely seeing that investors over the last decade built a very big overweight to the US markets and to the US dollar. And now this has been into the question, especially given the FX moves that we've seen in the last couple of weeks. So we do see the appetite of closing potentially some of the underweights to the European market in the last couple of weeks. And we continue to say that we're global investors. We do like being in global equities, and that includes having exposure not just to the US market, but also international, including Europe.
Okay, so global investors, so exposure to Europe. And then let's dive into the European earnings story then, because what are the interesting things you're taking away from the earnings season so far? It's interesting to see how different companies are navigating the huge uncertainties that lay ahead for 2025.
Absolutely. So the market is expecting 3% earnings drop this quarter, but I think what will matter matter more is guidance, or the lack of guidance. And I think the market will be looking into the comments as to how the companies, as you rightly said, will navigate that. And I think as long as the companies have a particular strategy of how to navigate these tariffs, I think the market will reward them. And I think specifically for Europe, the domestically oriented companies are probably slightly better positioned this time around compared to exporters, which are more exposed to tariffs and FX risk.
So which kind of sectors within which markets does that take you into? If you're looking for the really domestically exposed businesses, so not the big exporters that, as you described, where does that take you?
I would say some of the industrials companies look quite interesting given the domestic story in Germany with the German fiscal stimulus. We do like some of the financials names here as well, including banks. And tech, even though tech is an international sector, we still think that there are values in that sector.
Do you have any sort of pointers for CFOs and CEOs as they're putting together their earnings releases, thinking about the guidance they're going to issue to markets, about how to pitch it to markets? Because some of them seem to be saying we're sticking to our guidance, but there are these huge uncertainties, and so we're not changing our guidance because we just simply don't know what to change it to. But that's not necessarily a really positive story, is it? It just means there's a huge amount of uncertainty ahead. So how would you suggest that businesses should sort of sell this message to investors?
I think if we have some sort of a scenario analysis, that will help the investor community try to price and try to forecast as to what may happen in the future. Because we don't know how tariffs will actually pan out from here, but if we get a bit of a guidance that this is where, you know, our sales forecast or operating profit can go, that will help. And this is how we're thinking about on the strategy team side, thinking that probably the range of outcomes this year is a bit wider than usual just because of the tariff uncertainty. And we think that this uncertainty will probably close as we go through the year. But for now, even looking into earnings, we may see that earnings may even flip into negative territory this year, but they may be, you know, close to high single digit this year. So the range of uncertainty is just very high.
Okay, so a range of scenarios maybe is a good way to present that level of uncertainty. I noticed in your notes that you think technology companies look particularly attractive after the recent sell-off. Where are you looking for those? Where do you think that they've been oversold in the recent period?
We particularly like software companies because we think the semiconductors are still a bit exposed to the tariff and trade uncertainty, but software looks very interesting, especially if we think that AI trade still has legs. We're going to hear from big tech companies, and we hope that they will all confirm their CapEx guidance for this year, and therefore we think software is the right place right now.
Yeah, have you heard anything from the likes of ASML, NVIDIA, TSMC that makes you think maybe we don't get that positivity from the big tech companies, a little further up the supply chain perhaps? But are you concerned that maybe big tech is not going to be spending quite so much in terms of building out data centers and the like?
Not really, because what we heard so far is actually the confirmation of this AI trade, and we heard from a couple of companies in the US confirming the CapEx guidance this year. So we feel quite comfortable going into the earnings season.
And here in Europe, do you expect the ECB to shore up, maybe not with this intention, but to shore up markets with rate cuts? I mean, we're expecting one rate cut today, possibly we'll get some more from the ECB. What is your expectation for the central bank?
Yeah, I think the 25 bips cuts is priced in by the market for today. We think that another, 50 probably can come into the market, but what will be really, really important today is the outlook on the economy as to what is happening, if tariffs are actually impacting the market or not, and where the economy can go from here. Because in our analysis, we think that the European growth may be a bit weak this year because of the tariff uncertainty. So hearing that from central banks can be quite reassuring for the investor community.
So do you think, I guess without knowing exactly the extent of tariffs, it's difficult to answer, but can the German spending on defence and infrastructure, can that outweigh the negatives around tariffs for Europe?
We think so, and I think this is what investors are also focusing on. And there is a bit of a lag between the timeline, because if we're thinking about the German stimulus, this is more for 2026 story, but it gives a bit of a longevity for the European market.
Okay, thank you very much. Thanks, Natalia. And Natalia Lipakina, head of EMEA Equity Strategy at JP Morgan Private Bank. Coming up on the programme, we'll get the latest on the luxury sector. Hermes shares fall as weak Chinese demand hurts its sales. We get a deep dive on those results and the darkening outlook for that luxury sector. That's next. This is Bloomberg.
global news whenever and wherever it happens. I'm Joanna Versace in Davos, Switzerland, and this is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Bloomberg has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg.
For the conversations that matter and the insights you need, this is The Pulse. I'm Anna Edwards in for Francine Lacroix in London this morning. Now, Hermès sales at the start of the year were hurt by a slowdown in Chinese demand, showing that even the most resilient purveyor of really high-end goods hasn't been spared from the slump. For more, Deborah Aitken from Bloomberg Intelligence joins us. Talk us through what we've heard from Hermès then. The full-year consensus stays intact from this business. But what's the detail we need to take away from the Hermès numbers then this morning, Deborah?
Hi. Yeah, so we saw Asia ex-Japan being the one area where, 4% growth. And the market really, when we're looking on an organic basis, we were really kind of trying to expect them to be up around mid-single digit. They're saying that actually China in particular, the numbers there are flat. Elsewhere, we have double-digit growth across all regions and key markets. So that's a positive. But overall, because of China, we saw Q1 organic sales come in at 7.2%, which was about 70 bips below expectation in the market on consensus. And I would say that's already actually being clipped this week because of LVMH and that -5% on their organic growth, which also from us was linked mostly to China. And then when we think about the full year, actually for the full year, the company has said high single-digit growth, and consensus is still slightly ahead of that at around 11%. And I'm looking further down at the operating margin of 40.5%, which is aligned to 2024, and that probably needs to be brought down too.
Okay, so some concern around consensus there. Talk us through the weakness in China. What's happened, and has sentiment really changed there? We've been talking about another luxury good, a very different one, but Pernod Ricard this morning. There's a different issue there. That's about tariffs on cognac into China. But Hermès also weak in China. So what's the story?
Yeah, I think, not to overplay it, but actually they're up against a very big comp, a big New Year recovery last year. But when we look overall, we can see that there's just less footfall, and they're saying actually into April, it's got a little bit softer, so less store traffic. But the big categories are doing well. The high price categories are doing well. So it's silks and some of the accessory side, the lighter price points that are maybe feeling a little bit more of the pressure. And we'd expect that to continue through the second quarter.
Yeah, and thinking about price, Hermès has been talking about price and how they're going to prepare for tariffs or tackle tariffs. So is this prices going up for Hermès bags in the United States, focused specifically on that market, or is this a wider pricing move?
Right, so at the beginning of the year, or last year into these results, Hermès had already said they needed to raise price about 6 to 7% to cover costs. New production sites, more labor, the quality of their product. So that was coming through. And they said at the very beginning of the year, scope and price out of this 7% growth has been around 5%. But as we go into May the 1st, they will raise prices specifically, separately in the US to cover tariff charges. And on the back of that also, we've been doing a lot of work in Bloomberg Intelligence on this to look at where EBIT cover needs to be, what pricing needs to come in across the different luxury companies. And actually, we heard last night, most specifically, that Brunello Cucinelli said 3 to 4% price rise, starting with their new autumn-winter collection into the US stores in July.
Okay, Deborah, thank you very much. Thanks for joining us. Deborah Aitken from Bloomberg Intelligence with the latest on Hermes, came hot on the heels of LVMH, of course. Let's pivot from the luxury sector to technology. TSMC ADRs are moving higher after the world's biggest chip maker gave a better-than-expected outlook for the second quarter. Let's get more with Matt Bloxham from Bloomberg Intelligence. So on TSMC, we got the numbers for the backward-looking stuff for the first quarter. They seem to be better than expected. And then we got the guidance for the second quarter, and that also coming in a little better than markets had anticipated. How much do we know will continue of this, though, Matt? Because it's possible to imagine a world where people front-load their purchasing if they fear tariffs are going to come.
Yeah, and that does seem to be the case both for the first quarter and for the second quarter guidance. So given that they've kept the full year revenue growth guidance unchanged, so like mid-20% year-on-year growth in US dollar terms, that implies potentially quite a big slowdown in the second half of the year. I see customers preempting the tariffs and getting as much stock in as they come. But the company was upbeat about sustained demand for AI chips. I think there's a lot of big hyperscalers investing a lot of money this year in capacity. So I think even if we were seeing end user demand slow down, that may not play out until 2026, where you get kind of some overcapacity issues. So I think this is going to be still quite a volatile period for a company like TSMC. Tomorrow, the US administration could come out with their new tariff plan on chips and smartphones, and that could suddenly make people feel kind of quite bearish again. So I think we're seeing a lot of companies hold their guidance because they don't really know what's happening until they've got a clearer view on what the future looks like. They're just kind of holding firm. So I think people are going to be a bit cautious about the outlook.
Yeah, it almost feels on the guidance side that companies know they need to move, but they've no idea where to move to.
Exactly.
So they're just staying put for now. How does this affect sentiment? I mean, we recently, just yesterday, we were talking about the Nvidia story that weighed on stocks in the States yesterday, because there are different ways that politics could play in here. There's the tariff story, but there's also security concerns between the US and China and the use of that H20 chip.
Yeah, that's right. And I guess from a TSMC perspective, there's a lot of scrutiny on their investments into US capability. They're spending $100 billion on US fab. Also, a lot of speculation about whether they're going to do a joint venture with Intel. The CEO is quite clear today that they have no plans to form a JV. They're focused on their own business, but clearly a part of that does involve that increased capability in the US. But then it's an incredibly complex ecosystem. They're a big supplier to Apple, for example. Apple obviously very reliant on China for manufacturing, so unless they see some of their partners move to the US, they could still kind of get caught up in these tariff wars indirectly.
Yeah, even if you're producing something in the US, unless all of the components come from the US, there could be tariffs somewhere along the line. Matt, thank you very much. Thanks for joining us. Matt Bloxham from Bloomberg Intelligence with the latest on themes in the tech sector. Coming up, we'll focus once again on the ECB. It's set to release its decision today with a rate cut expected. 25 basis points is what nearly all of the economists served by Bloomberg expect to see in terms of a cut from the ECB. We'll get the latest live from Frankfurt next. This is Bloomberg.
Behind the bright lights and adrenaline of pro sport is an equally exciting world of negotiations and deal-making.
That's what we cover each week on our podcast, The Deal.
I love the fact that you have, we say the cojones, I can't say that in Bloomberg.
Maybe moxie?
Yeah, moxie. I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Billie Jean King.
Well, what should I learn? What should I do? I said, learn the business.
Jay Williams.
You're an asset, but how do you become the principal?
Paul Rabel.
We're going to be the league of digital, and that's why you're going to invest.
Adina Friedman.
I definitely am competitive.
David Rubenstein.
People don't come up to me on the street and say, let's talk about this private equity deal you did recently. Nobody does that. They say, let's talk about the team.
And so many more.
Do you need a clap?
No, anywhere. Go.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Good morning and welcome to The Pulse. I'm Anna Edwards in London. In for Francine Lackwell this morning, here are your top stories. Fed Chair Jerome Powell strikes a hawkish tone on inflation amid trade war uncertainty, dashing market hopes for a Fed put. US futures, though, rebound after positive signals from initial US-Japan trade talks. The ECB is seen cutting rates again by a quarter point amid slowing services inflation and risks from US tariffs. Plus, Hermes shares drop after sales disappoint. The luxury group warning tariffs will lead to price rises. Chipmaker TSMC gains after it maintains its full-year guidance despite growing trade worries. We begin with the ECB this half hour, which is expected to cut rates for the 7th time today after Donald Trump's tariffs upended the bloc's economic outlook. Bloomberg's Lizzie Burden joins us now from Frankfurt. So, Lizzie, these new US tariffs then, we don't know the full extent of the tariffs that in the longer term or medium term perhaps will be applied to the Eurozone. But I suppose the fact that they exist at all, in some senses, makes the ECB's decision a little easier today.
You're right, Anna. It was meant to be a nail-biter, this April meeting, but actually Donald Trump seems to have made it into a bit of a no-brainer for many on the Governing Council, because economists reckon that his tariffs are going to weigh on inflation and growth here in the euro area. And yes, you've had this 90-day pause on the 20% levies, but the talks in Washington haven't yielded much this week. And what we know is that the EU hasn't retaliated yet, so the ECB doesn't need to deal with the potential inflationary impact of that. There has been this debate about whether the fiscal boost to growth outweighs the tariff threat, but the way policymakers have been framing it is that it's long-term versus short-term. And yes, they need to be vigilant about balancing the two, but what they need to deal with in the here and now is this rapid rise in euro-dollar, which of course makes imports cheaper, exports more expensive, and therefore could potentially kneecap growth even if it's all disinflationary. And then they have to look at lower oil prices, and then they have to look at maybe China flooding Europe with cheaper goods to counter the tariffs they're facing of 145% themselves. So all roads, Anna, really point to a quarter-point cut today from the ECB, especially, as you mentioned, when you've got inflation moderating towards that 2% target, including services inflation as well.
Yes, we saw earlier on China saying it was willing to expand mutual opening up with Europe, which seemed like an interestingly timed line around access to each other's markets. We'll see what develops there. So the focus then is on the path ahead for the ECB, Lizzie.
yet again for Christine Lagarde at this meeting, Anna. And markets are currently pricing in 2 more cuts in April and June, but we're really looking at the commentary around this decision. I would not expect them to drop the language about this being meeting by meeting and data dependent, but it'll be interesting whether they drop the language about the policy having become meaningfully less restrictive. They added those words at the last decision. If they drop them, it would really send a hawkish signal. So our economists at Bloomberg Economics reckon that they'll keep that language today. But I've been saying this all morning. There is such a lot of pressure on Christine Lagarde to really calm the markets today, given everything that we saw last week. When you haven't got a Bank of England decision this month, you haven't got a Fed decision this month, and as you've already said, the chances of Jay Powell coming to the rescue of the US economy with a Fed put seem to have been dashed last night.
Lizzie, thank you very much. Lizzie Burden in Frankfurt, of course. Let's carry on this conversation. Let's speak to Isabelle Job-Bazile, Chief Economist at Crédit Agricole, with us to talk about the ECB, the decision ahead, and the global economy. Isabelle, nice to have you with us. So your expectations ahead of the ECB, will this be one of those meetings where the ECB tries to say very little about the path ahead for rates because there are so many uncertainties?
Yeah, for sure. Good morning, Anna. Obviously, no surprise today. The ECB is going to cut interest rates by 25 basis points. What will be important to hear at the press conference is the ECB reassessment of the balance of risk between growth and inflation. I think that ECB will likely share our concern regarding growth, not just because of these tariffs, but more importantly because of the high level of uncertainty that leads to wait-and-see behavior with more precautionary savings from households and a reluctance to invest for companies. And it will be also interesting to see if Mrs. Lagarde adopt a more dovish tone on inflation. Disinflationary pressures are likely to intensify. There are many reasons for that. We have slower growth, we have cheaper oil prices, we have also this appreciation of the euro that makes imports cheaper as well. And obviously the risk of all these Chinese low-cost products flooding the European market. So lower growth, lower inflation, this paves the way for further rate cuts.
Yes, Isabelle, on that subject of Chinese product looking for a home, looking to be globally exported and maybe not able or too expensive to send it to the United States, so trying to get that product into Europe. How quickly are you expecting that to put downward pressure on inflation? Where will you look for signs that that is what is happening in European markets?
I think it's difficult to know exactly the timing because, as I mentioned, we have a lot of uncertainties. It is obviously a risk, but, China tried to be the adult in the room in the moment, and we want to maintain this multilateral trade system. So there are some room to negotiate with China to avoid this flooding of low-cost Chinese product.
Okay, so we'll watch out for that. Given all of these downside risks for the Eurozone economy and perhaps less need to worry then about inflationary risks, Isabelle, how much cutting can the ECB do? How close to neutral are we? How far into neutral the ECB be prepared to cut?
I think that the ECB should proceed in 2 steps. The first step by moving towards the neutral rate, let's say 2%, because it is the middle of the estimated range of for neutral rates by the ECB, and then by remaining data dependent while looking at the smooth transmission of monetary policy. And in this respect, the last bank lending survey is interesting because it shows that the housing market is responding to the looser financing conditions, but businesses are still reluctant to take out loans, and banks are cautious to lend. And so we have this tightening of credit standards for firms, and also the negative impact of the quantitative tightening for the market financing conditions for banks. And this should be monitored and could and may warrant further easing. And to go on the accommodative side of the monetary policy, maybe 2 cuts.
Okay, and thinking about the United States, because the Eurozone is not an island economically, let me ask you about risks of stagflation. You say in your notes, Isabel, that risks of stagflation in the United States have been overestimated. Why do you say that?
In fact, yes, I'm not a fan of this stagflation story. We should experience a change in relative price regarding inflation. That means that the price of manufactured goods will automatically rise due to the tariffs. But the price of services, which is the main component of the inflation index, could come under downward pressures as private demand weaken. And by the way, we have also this story around the cheaper oil price that could tame inflationary pressures. And I would say that in any case, the Fed is not supposed to respond to a temporary shock in inflation, and should be more worried or more sensitive to the downside risk on growth and employment. That's why we still believe that we will experience 2 rate cuts before the end of the year.
Yes, it's interesting in the context of the recent spike up in inflation over recent years and criticism of central banks as a result of that. Interesting that we saw the Fed lean into inflation fighting, perhaps, in its narrative yesterday from Jerome Powell. Isabel, thank you very much. Isabel Job-Bazile, Chief Economist at Crédit Agricole, with thoughts on the Eurozone and a little on the United States as well. We'll have coverage of that ECB decision. That's at 1:15 p.m. UK time, followed 30 minutes later, of course, by Christine Lagarde's news conference. Lizzie Burden will be there for all of that, and there'll be coverage of the rate decision, of course, here on Bloomberg Television. Now, Italy's Prime Minister is set to meet with the US President Donald Trump at the White House later today, tasked with negotiating EU tariffs. Giorgia Meloni has an ideological affinity with the president, but not everyone is convinced that will aid the discussions.
About the possibility Georgia could be better than others because she's very familiar and friendly with Trump, why not? If she will be able to achieve an agreement with Trump for the ideological reasons, okay, we are very happy. We will be very happy. But I don't believe in that, because the strategy of President Trump is a strategy, in my opinion, against globalization, and that is a problem for us.
Former Italian Prime Minister Matteo Renzi there speaking to us earlier on. Let's bring in Bloomberg's Alessandro Migliaccio in Rome with a look ahead to what Giorgia Meloni can achieve here. So, Alessandro, the Prime Minister goes to Washington with this big task to try and make some progress where Maroš Šefčovič has not made very much progress on the trade front. So what's expected from today's meeting?
Well, because as you were saying, there is some, let's put it this way, ideological affinity. There was hope that she could talk some sense into him. And, you know, in Italy, it's also known that Meloni started off as a 16-year-old in a far-right party. She has a lot of experience dealing with, let's put it this way, right-wing men. And so there was a thought that maybe she could do things that others couldn't. On the other hand, there's also controversy because, you know, within Europe, there have been complaints that we need to stay united. We need to be careful about negotiating alone with someone who is unpredictable, with someone who has shown contempt for Europe. Of course, she is in agreement with the EU. She's spoken to Ursula von der Leyen about this meeting. She's not going it alone, but there's just concern that she's going to speak to someone who is very unpredictable and doesn't really like Europe.
Okay, a lot to watch then as we look at those pictures there of Giorgia Meloni arriving then in the United States. Bloomberg's Alessandra Migliaccio in Rome, thank you very much for the preview. Coming up, we'll talk technology. LinkedIn's latest AI and global economy report reveals how generative AI is reshaping growth and productivity. Sue Duke, the company's head of global public policy, joins us next. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Conversations that matter and the insights you need. This is The Pulse. I'm Anna Edwards in for Francine Lacroix in London this morning. Now, the UK's decision to leave the European Union had severe consequences for the economy, including a decline in the value of the pound and a decrease in business investment. Many Britons who voted to leave the EU now favour rejoining, if you look at some of the more recent polling on that subject. And the UK's Prime Minister has an opportunity to reset and repair some of the damaged relationship with Europe. Matt Winkler, Bloomberg's Editor-in-Chief Emeritus, has written an opinion piece about this and joins us now. Matt, very nice to see you and to get this sort of international perspective on something that happened very close to my home, of course. So give us a sense of the scale of the economic consequences that you see from Brexit. It's nearly 10 years ago now that the vote took place. But over that period, it's been difficult perhaps to untangle the impact of COVID and war in Ukraine from Brexit. So what have you discovered?
Well, you start with the day itself. You start with June 21st or 3rd, that period right after the referendum. And the pound plummeted a record 8.05% in minutes, and it was a 31-year low against the dollar. Nothing like that has ever been seen by sterling. It was a 13% depreciation in less than a week. And sterling, of course, is yet to recover. It was Britain's worst foreign exchange fiasco in the new century. If you like, it signaled John Bull's transition from biggest beneficiary among the 27 countries in the EU to a relative have-not. That's as we speak. And investment, as you said, in the UK since the referendum has either declined or showed no improvement. In addition, the country's diminishing trade with Europe is still less than its deterioration with the U.S. So it belies the lever's insistence that transatlantic commerce would boom after Brexit. And if you look at sterling these days, exchanged at $1.50 per pound. The year before the referendum, it's averaged $1.29 since June 16. That's 7% less than the financial crisis low of $1.38 in 2009, according to Bloomberg data. So any way you look at this, it's been a collapse of UK business. A reduction of 15% in trade is translated into a reduction of 4% in gross domestic product since then. That's according to Jonathan Portis, who's a professor of economics and public policy at King's College. If you look at it another way, as you said, investment in the UK is either, declined or it's flatlined.
Okay. Now, if you're looking for Brexit dividends, then a lot of people pointed to that brief period where the UK was going to get a lower tariff than Europe. Since then, of course, we've seen a stay on that higher European tariff. But for a brief period, some were saying, look, this is an example of the way that the UK now has more flexibility. So with the context of President Trump now in office for a second time, what opportunity does that give Prime Minister Starmer around freedom to move, I suppose?
Well, the real obstacle all along, unfortunately, for the UK has been Vladimir Putin. And so when Starmer initiated the coalition of the willing recently, safeguarding the peace in Ukraine, he created an opportunity to transform his policies. The Trump tariffs, which, as you say, punished the UK as much as the EU, prompted investors to dump U.S. assets. That, by the way, was a force reminiscent of the 1956 Suez Crisis, which everybody in the UK, of course, knows about. Also, the U.S. regime's asymmetric sympathy for Putin. Polls show American voters support Ukraine and remain opposed to Russia. It means there is much more than enough moral and economic force for Starmer to say, you know what, times have changed since he took office in July. Unwinding Brexit when the nation of shopkeepers is simultaneously promising to boost Ukraine's defenses would be very consistent with his penchant for pragmatism. So the Prime Minister's situation, if you like, it recalls a very famous quote back in the 1920s from John Maynard Keynes, who said essentially, look, when the facts change, you need to change your mind, you need to change your policy.
Okay, Matt, thank you very much. Matt Winkler, Bloomberg's editor-in-chief emeritus, with his thoughts on the transatlantic relationship between Britain and the United States and where Britain should go from here with its relationship with Europe. And we watch with interest as actually conversations around migration and cooperation on migration, what that can deliver between France and the UK. Now, let's pivot to technology. Generative AI could be a golden ticket for businesses and economies across the globe. LinkedIn's latest AI and global economy report reckons it could unlock $6.6 trillion in productivity across the US, UK, France, Germany, and India, so across some fairly large, sizable economies. The company's vice president and head of global public policy, Sue Duke, joins us now. Sue, nice to have you with us. So where will this come from? How big a gift to the global economy and these big economies will we get from AI, according to the research that you've done?
At a time of slowing growth and slowing productivity, what we see from today's report is the enormous potential of AI to unlock innovation gains, productivity gains, and growth gains. As you said, we're seeing across those 5 large markets the potential of $3.3 trillion to be unlocked. And what's really interesting is we're seeing the potential for those gains to come right across the board, across a whole range of sectors, and across companies from small, medium, and large. And so if we can get the conditions right, crucially, if we can put the workforce in a spot where it has the skills it needs to tap into this potential, we are in a great position to be able to channel the productivity gains from this technology into growth, into productivity, and into innovation.
Okay, and talk to us about the skills that businesses are going to require, Sue, to make that happen, because you talk not just about AI technical skills, but AI literacy skills. Now, is that meaning people who know what to do with the technology once they get it? So talk us through the skills that businesses need.
That's exactly right. There's 3 categories of skills that come out loud and clear from today's report and from our platform that are going to be critical to tapping into this potential and driving forward the economy with this technology. First, AI technical skills. Think of those as the skills that are needed to build this technology. AI engineering, natural language processing, those kind of skills. Second, AI literacy skills. Think of those as the skills that are needed to leverage this technology. Microsoft Copilot, ChatGPT, those kind of skills. And then the third all-important category of skills are those essential people skills. They remain absolutely at the heart of this transformation. Skills like communication, leadership, team building, they will remain critical and put alongside the technical skills and the literary skills. That is going to be the key to unlocking the productivity gains, those innovation gains that this technology clearly can bring for companies of all sizes across all sectors.
Okay, and you have an interesting detail too in your research. It says that half of businesses using generative AI for 2 years have seen their revenue go up by 10% or more. Now, I wonder how that compares to the amount of money they're having to spend on AI technology. This isn't free necessarily for these businesses and requires quite a lot of investment. So do we get a sense of just, what kind of returns businesses are getting from this?
Massive returns. What we're seeing, and particularly actually for those small businesses, there is a lag in smaller businesses adopting this technology. But when they do, what we see is that they are refocusing their energy into making sure that this technology works, not just in gaining productivity for them, but in getting innovation and getting growth. They're putting those savings into product development, into accessing new markets, into getting their people in front of customers so that they can grow their business. And that's precisely why we're seeing that companies who are using and adopting this technology are seeing typically a 10% increase in growth over a 2-year period. So it speaks to the enormous potential for all of these businesses to be able to expand and grow if they have the skills they need. But that has to be at the heart of this transformation and at the adoption of this technology if we're going to be able to realize those gains.
And so you talk about different markets and where they might benefit from this technology, different geographies. So Germany, it's around manufacturing. In the UK, it's actually a lot of public services that you quote here. Is that really where the UK finds the upside?
It's one of the sectors that really sets to benefit from the application and the widespread diffusion of this technology. We see it, as you say, in health, social and education, all systems that are under increasing strain in the UK. And what this technology can do is put in the hands of workers. It frees them up to do things like personalized healthcare, bespoke tutoring, so that we are able to untap that unique human value in sectors like education and like health.
So thank you very much. Thanks for joining us. Sue Duke, Vice President and Global Public Policy Head at LinkedIn. Thank you very much for being with us. Let's have a quick recap of the markets as we bring this hour to a close, just approaching 10 a.m. here in London. And European equity markets are in retreat a little bit, echoing the selling that we saw middle of the day, towards the end of the day yesterday in the United States. So that's some of the story there. There's also an earnings story, though, to be factored in. And we see construction and materials is the weakest sector here in Europe. The likes of Heidelberg Materials, Saint-Gobain, weaker on that front. Healthcare, telecoms, travel and leisure, all of those a little weaker. Consumer products and services was an early area of weakness as we saw the negativity around Hermes and the story around luxury. But some of that has actually unwound as we've gone through the morning, and actually a better performance coming through from some of those luxury names. Now, energy stocks doing really well on the back of the Siemens energy numbers. Looking ahead then, let's have a look at the US futures picture. We are seeing some positivity there. Yesterday we saw selling on the NASDAQ and E-minis and the S&P as a result primarily of concern around technology. That NVIDIA story weighed on things in the States yesterday. Today we see a different outlook, perhaps some of the headlines, progress being made around the trade conversation with Japan, perhaps that boosting sentiment just a little, and we go towards the US session with some positivity. That is us done here on The Pulse, so I'll hand you over to Bloomberg Brief. That's coming up next. This is Bloomberg.
Influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
And Davos, you were asking a question of President Trump, and he didn't quite answer the question, and he asked you a question. So the question he asked you was something like, why are you not banking certain groups? What is the answer? I don't think he gave you a chance to really answer that question, but what is the answer to that question?
Well, first off, the Bank of America has 70 million consumer customers and millions of small businesses all over the country, all over the world. And so we bank everybody. But the real question was about overregulation, frankly. And so as you look, what's happened is because the interpretations of AML, anti-money laundering, BSA, Bank Secrecy Act, KYC, know your customer, know your customer's customer. You know, there's a lot of burden upon the banking system to both report suspicious activity reports and do a lot of analysis. And we have to close accounts, so we can't tell people why we did it. And often we're told by authorities to close accounts. That creates confusion. Another area that comes out in this discussion is in the crypto area where the regulator said you can't bank crypto operating companies, employees of crypto companies, et cetera. We are allowed to do, we bank everybody, but the operating company, they said that's a high-risk activity. Ask us for authority, and guess what? You would have never gotten the authority. So that came up as an issue. So at the end of the day, it's about getting these regulations right.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Good morning from our global headquarters in New York. I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda. Throwing cold water on the Fed put. As tariffs take hold, Chair Powell hints that inflation is the #1 concern. Big progress in Japan. The president touts trade talk momentum. Next, Italian Prime Minister Meloni heads to D.C. And earnings season kicks into high gear. TSMC beats estimates. Up next is Netflix after the bell. Aren't you happy it's a holiday-shortened week? It is the last day of trading after 3 consecutive days of losses. An ugly day yesterday that started off the back of chips selling off of Powell's speech, which suggested that a Powell put remains well out of the money. We try to come back today. It is the trade talks in Japan going well, relief rally. NASDAQ 100 futures lead those gains, up 0.8%, 0.7% for your S&P 500 futures. Similarly, Treasuries also gained for 3 straight days. That eases this morning. Your front-end yield up 4 basis points. It's called 3.5 for your 10-year yield at 4.33. It was the front end that suffered the most yesterday as we priced out further odds of a Fed cut. Those are your overall markets. Let's get some stocks to watch. With that is Bloomberg's Joe Easton. Good morning, Joe.
Morning, Danny. So TSMC bringing some well-needed positivity to the chip space today after a difficult day yesterday. We can see the ADRs on Taiwan Semi up around 3.7% at the moment. $29 billion in revenue expected in the quarter, more than analysts expected. However, downplaying talks of a potential joint venture with another company, and that is hitting shares of Intel in the pre-market. We're seeing that one a little bit lower today. There, we've got that price on the screen there. We're down around 2% on Intel at the moment. Then take a look at Alcoa, a little bit weak in terms of some of the impact of the declining aluminium price on the company's forecast that they gave last night. So that one down 3% in the mining space. And then finally, check out Hertz, up again, rallying following that huge gain yesterday as Bill Ackman's Pershing takes a stake in the car rental company. Very powerful move from Ackman on that one. All of this available on the before the opening bell wrap on the terminal, Danny.
Joe, great work as always. Bloomberg's Joe Easton there. Coming up on the show, we're going to be speaking to George Saravelos of Deutsche Bank, and later in the hour, Rob Casey of Signum Global Advisors. Now, in his latest report, George Serravelos looks at just how overweight the world is in U.S. assets. He found that Japan's holdings of American assets have doubled since 2010, while in Europe, the figure has quadrupled. He writes, a sustained shift in foreign investor U.S. dollar allocation closer to historical norms has the potential to generate huge negative dollar flows. I'm pleased to say that George joins us now. George, again, just such fantastic work you've been doing over the past couple weeks. And this study in itself is really interesting. So we have to ask the question, are we getting that now? Are we getting a sustained and structural shift towards something that looks more like what was the norm?
Thank you very much for having me on the show, Danny. I think it's very early days, of course. We're still only a few weeks away from the very big announcements from President Trump at the start of the month. And I think only time will tell if these big shifts will happen. But our view is that the preconditions are being set for these shifts. On the one hand, you've got a general weakening in the U.S. economic outlook. This is on the back of all the policy back and forth, worries from the market around bigger fiscal tightening. And then the second driver, which is a bit more structural, is this challenging of all those post-World War II norms, which the world has known, U.S. leadership in terms of the global trading rules, the global geopolitical rules. And to the extent that leads the market to reassess how willing it is to hold such a large portion of its global assets in the US, that could also start some of that unwind. So we're very cautious in making big, bold predictions given how things are changing. But I would say if the probability of some of these bigger capital flow shifts is going up.
Hey, I mean, companies in this environment aren't even willing to give their outlook for the year, so I understand not wanting to forecast and what things look like in years from now. But George, there is a difference between just diversifying outside of U.S. assets versus a real threat to the dollar as reserve currency status. How do you distinguish the path that we're heading, in which way it takes, whether, again, it's just diversifying, getting back to something normal, or a true threat to the dollar and what it represents?
That's a great question, Danny. I think in real time, it's very difficult to distinguish between the two. I would say probably the key variable in trying to see whether we're seeing a very sharp disinvestment of U.S. assets is just the level of volatility and the sharpness of the moves. And the market was worried about such a sharp divestment last week. So number one is just the level of volatility, which has since calmed down. And number two, and this is absolutely critical, is the relationship between fixed income and the dollar. And if you're in an environment where yields are going up and the dollar's weakening at the same time, that points to a much more disorderly market dynamic. Now, are we going down that route or not? Is the route going to be more orderly? I would say at the core of whether this happens is how extreme is the U.S. policy mix. If the market perceives the U.S. is going down a very extreme policy route, and by extreme, I'm referencing extreme levels of tariffs, I'm referencing a challenge to Fed independence, large additional fiscal easing with deficits already being very wide. If the policy mix ends up being very extreme, then the probability of more extreme capital flow developments goes up. And I don't think it's by chance that the reason the market stabilized over the last few days is precisely because the Trump administration stepped back from some of the more extreme tariff policies.
Even if we don't get the extreme scenario, George, but one that still does assist this rotation out of U.S. assets, does it imperil a treasury market that is ballooning in size and becoming more dependent on ever than foreign buyers to fund it?
That's another great question. And at risk of oversimplifying, if I think about the global financial system over the last 20 or 30 years, the core has been the following transaction. It has been the American consumer essentially buying European and Japanese cars in exchange for selling treasuries. That is at the core of the global imbalance, so to speak, over the last few decades. And I think the US is going down a route of wanting to change that. And it's been focused on wanting to change the trade imbalance. But the two go hand in hand. If you've got a trade imbalance, it must mean someone is funding those deficits. And I think the risk that seems to be materializing is that by challenging these global alliances, by changing the rules of the game on trade, the market is changing its perception and its willingness to fund the other side of that ledger, which is the capital account and treasuries. So I think it is a risk. It most certainly reduces the scope of fiscal space in the US. And again, it goes back to how extreme and confrontational our policy is going to be. If you're down the route of negotiating, as we're now seeing with the headlines around Japan, it makes the world a bit more comfortable. But if we go down the route of disruption, then you may apply tariffs, but then that leads the market to question the funding of the deficit, and then you lead to the more disorderly dynamics.
Okay, that brings us to another question then, George. If that all is the case, does this just end up on the Fed's balance sheet? Are we headed towards QE infinity yet again?
You're right that it all ends up being part of the same story. I do think if you're in a situation of outright market disruption, and I would call that a sudden stop of capital, which the market was fearing to some extent last week with the Treasury sell-off, then the Fed would have no choice but to intervene. And here we should understand that as a market stabilizing role rather than a monetary policy easing. Remember, during the crisis in the UK a few years ago, we had the Bank of England still on a hiking cycle, but they did intervene to absorb the gilt selling that was taking place. So I think in that extreme scenario, we should be expecting the Fed to be intervening. Now, what is the ultimate impact of that on the dollar? Well, it depends on the broader policy picture, because if the Fed is intervening and the US policy mix is stepping back and becoming more conventional, so to speak, then that should help stabilize things. But if the Fed is intervening in the context of policy staying very extreme, then that could potentially lead to an even bigger drop in the dollar in the context of the overall policy mix.
Well, George, to that point, I can't let you go without getting your thoughts on Powell yesterday, saying without price stability, we cannot achieve long periods of strong labor market conditions, essentially saying that it is the price stability which is more important than unemployment at this point. To your point of what you were just saying, in terms of if the Fed is intervening, it is something about stability. It is something about these markets. Do you just assume that this is a Fed that will need to sit on its hands for the time being?
I think as far as monetary policy goes, that's true, because we've still got a tremendous degree of uncertainty. And remember, there's uncertainty on tariffs, but there's also very large uncertainty on the budget negotiations that are taking place in the US. I can come up with very different inflation scenarios depending on how US budget negotiations go. Imagine a world where all the tariff revenue is used for stimulus paychecks, for example. That's a completely different monetary conclusion to one where you get a large fiscal tightening. So it makes sense, I think, for the Fed to be on hold, but I'm also not surprised that the Fed and Chair Powell was very much emphasizing this question of Fed independence, because this is also at the core of keeping the bond market stable. And if we're thinking about tail risks outside of tariff policy, I would definitely say this question of Fed independence, especially in the context of some of the Supreme Court decisions that the market is awaiting over the next few weeks, this question of the Fed independence is very important for the market.
George, such an important conversation and fascinating as always. Wonderful to have you on. George Saravelos of Deutsche Bank, please come join again soon. Okay, coming up on the show, big progress. That's how President Trump describes trade talks with Japan. We'll have the details for you next on your Bloomberg Brief.
countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
The strategy of President Trump is a strategy, in my opinion, against globalization, and that is a problem for us.
That was the former Italian Prime Minister, Matteo Renzi, speaking to Bloomberg earlier today. Now, the current Prime Minister, Giorgia Meloni, is in Washington to meet President Trump to talk trade. In the meantime, a delegation of Japanese trade officials were in Washington this week. President Trump met with them yesterday and said there's been, quote, big progress, a lot to unpack. Our team coverage starts now. Bloomberg's Brendan Murray, who leads our global trade coverage, joins us. And from Rome, Bloomberg's Alessandra Migliaccio. Brendan, let me start with you and this supposed big progress being made with Japan. What do we know?
Yeah, so the Trump administration tells us that there are dozens of countries that want to come to the negotiating table. So Japan is the first one to arrive, and it's important for both sides to show that there's progress being made, regardless of the fact that we didn't get any details about what that progress was. But I think what you're seeing here is Trump trying to set the optics for these negotiations to show that this isn't a Zelensky in the Oval Office. White House that the country's trading partners are dealing with, and to hopefully in their view to bring other countries to the table. South Korea is coming next week. India a couple weeks after that. So the tone from the Trump administration is very much rolling out the red carpet for a close trading partner like Japan, and some optimism that a deal can be done in the next couple months.
Rolling out the red carpet for Japan, but does Meloni get the same treatment, Alessandra, given some of the back and forth we've seen between the EU and the U.S.?
Well, I guess that's what she hopes. Meloni is, let's say, ideologically in line with Trump a little bit. So she sort of hopes that she can be the bridge between the EU and the Trump administration. Of course, it's a risk. A lot of her EU partners have warned her that it's a risk. They've warned her that it's maybe not a good idea to go it alone because, Trump has shown contempt for the EU and a desire to split it up, to speak individually to countries. And of course, that's not possible because on trade, it's the EU Commission that deals with these matters. So we'll see what happens. There is some optimism. She did speak to Ursula von der Leyen. She did speak to the EU saying, I am going for you. I'm not going it alone. So there's some optimism that she can sort of find a way to speak to Trump and be a Trump whisperer for the EU.
There's a question of who's doing the talking from the U.S. side. Brendan, we know that the ultimate decision comes down to one person, and that is the president. But there seems to be a desire to get the Treasury Secretary more involved in these conversations. Do we know who is leading at this point?
Yeah, exactly. That's one of the conditions that China has set for it to come to the negotiating table is who's the point person. We hear Treasury Secretary Bessent say that he wants to make a deal, and there are deals to be made. But then you listen to other trade advisors like Howard Lutnick, who says who will tell you that tariffs are here and they're here to stay, regardless of how the negotiations go. So it's interesting to see the Italian leader in Washington today. The week started out with the European Union's trade team talking with Howard Lutnick and the USTR, Jameson Greer. They walked away from that meeting scratching their heads, thinking they don't know what the U.S. wants out of these negotiations. So it's an interesting contrast that we're seeing between the European Union's trade team and the Italian leader trying to break through in some way on a personal level, at least, with Donald Trump.
Well, how much unity is there in Europe right now, Alessandra, for Meloni to go in there? Because we've heard varying accounts from Ursula von der Leyen in terms of how they respond, whether it's one of negotiation, whether it's one of pressure being put on. Is Europe coalescing around Meloni as its Trump whisperer of sorts?
At this time, not really. There was actually, I was recently in Warsaw for the finance ministers meeting over the weekend, and there was doubt that this was possibly not a great idea, but she did speak to Ursula von der Leyen. I think they've found an accord. They will let her try this. She said she's going for the EU. She's not going it alone. I think at this point, the attitude is more like, you know what, if it works, good. Because it's very hard to know what Trump will do. It's very hard to know what will happen. And I think Meloni she's very intelligent. She knows what she's doing. She's really trying to just boost her own role, but at the same time, do something useful. The problem is, again, Trump is unpredictable. So it's a big risk she's taking, and, we'll have to see how that pans out.
Brendan, let me just give you the last word, because we had the timeline of 90 days to get deals done. I think we're something at like 84 days away from that deadline now, with something like 75 trading partners. Just how monumental is the task ahead for this administration to get those deals done?
Yeah, I think it depends on how you define a deal. As some sort of commercial arrangement where a country buys more natural gas and kind of those kinds of things. But in terms of redoing trade deals, free trade deals, those take months, years, to hammer out. And even the Treasury Secretary said these will most likely be agreements in principle rather than full-fledged free trade deals. So I think there's some optimism that a few deals can be done, but I think the expectations ought to be tempered about just how monumental those will be. They're more likely to be moderate than monumental.
Brendan, Alessandra, thank you so much for your contributions and work this morning. Bloomberg's Brendan Murray and Alessandra Migliaccio there. Coming up on the show, the IRS is said to be considering taking away Harvard's tax exemption. We'll have more on the administration's attempts to choke off Harvard's federal money. That's next. This is Bloomberg.
Behind the bright lights and adrenaline of pro sport is an equally exciting world of negotiations and deal-making.
That's what we cover each week on our podcast, The Deal.
I love the fact that you have, we say the cojones, I can't say that in Bloomberg.
Maybe moxie.
Yeah, moxie. I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Billie Jean King.
Well, what should I learn? What should I do? I said, learn the business.
Jay Williams.
You're the asset, but how do you become the principal?
Paul Rabel.
We're going to be the league of digital, and that's why you're going to invest.
Adina Friedman.
I definitely am competitive.
David Rubenstein.
People don't come up to me on the street and say, let's talk about this private equity deal you did recently. Nobody does that. They say, let's talk about the team.
And so many more.
You need a clap?
No, I never
Go.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people,
the tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. Season is here.
Earnings season begins. Is corporate America in a good place?
Wall Street is bracing.
Bloomberg is first to break the numbers.
We got Delta, Constellation Brands.
The wave of big tech earnings.
We've seen a re-rating of earnings estimates.
I got to pay special attention to all this.
With the smartest insights.
Given the degree of uncertainty, you haven't really cut earnings estimates that much.
Anyone who says they have certainty on where the growth outlook is going, where earnings are going, is probably exaggerating.
Continuing coverage on Bloomberg.
It's your Bloomberg Brief. I'm Danny Berger in New York. Let's take a look at what's on the front pages this morning from different outlets around the world. First up, the FT is leading with Chair Powell saying that Trump's tariffs are likely going to put inflation goals and the Fed's job in conflict and at risk. Powell spoke at the Economic Club of Chicago yesterday. He also said that the president's tariffs announced so far have been significantly larger than anticipated, sort of painting a stagflationary type of environment that keeps the Fed unable to cut. Next up, the New York Times leading with the IRS weighing whether to revoke Harvard's tax exemption. An IRS spokeswoman declined to comment to the Times. Harvard then pushed back in a statement saying that the move would be unlawful and there's no legal basis for doing so. Finally, the Washington Post leading with the Trump administration seeking to slash budgets for federal health programs. According to a prelim budget document seen by the Post, it calls not only for cuts, but also a major shuffling and restructuring of health and human services. Coming up, trade negotiations are underway in Washington. Rob Casey of Signum Global Advisors will join us next on your Bloomberg Brief.
Illiteracy is a big problem in the United States. I think 14% of adults are functionally illiterate, which means they can't read past the 4th grade level. That's a large percentage of the population. Nothing the Library of Congress can do can completely solve that problem, but are you surprised at how many people still cannot read in this country, and how many people have another problem called illiteracy or illiteracy, right, which means they can read, but they don't choose to read?
It's a challenge with the digital age because they're reading on tablets, so we do count that as reading. If you have an ebook, you're reading the book, and I've been often asked, if I'm listening to a book, are you reading? Does that count? But there is a concern that the amount of reading, actual text that people are doing, is diminishing. And so how do you work with other organizations? So the Library of Congress connects to public libraries, school libraries, and we do joint programming with them.
Why do we actually have all these thousands of libraries anymore when people are often doing things digitally and they don't need to go to a physical place to get a book?
People are using public libraries and someone has said, as opportunity centers. And libraries are offering collections that are beyond books. So libraries are circulating and responding to communities in so many ways.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
From our global headquarters in New York, welcome to Bloomberg Brief. I'm Danny Berger. Let's set your agenda. Throwing cold water on the Fed put as tariffs take hold, Chair Powell hints that inflation is the #1 concern. Big progress in Japan. The president touts trade talk momentum. Next, Italian Prime Minister Meloni heads to D.C. And earnings season kicks into high gear. TSMC beats estimates after the bell, Netflix reports. Aren't you happy it's a holiday-shortened week? It's the last trading day of the week, and we look to break 3 consecutive days of losses. It was an ugly day yesterday off the back of chips selling off the back of a Powell speech, which suggested that the Powell put remains far out of the money. We gained some 1% on the NASDAQ 100 this morning, same for S&P 500 futures. It is the trade talks going while relief rally. For your bond market, we're also snapping 3 straight days of gains. For the Treasury market, up 4 basis points, just thereabouts for your 2- and 10-year yield at 431 this morning. Let's get underneath the surface with some stocks to watch is Bloomberg's Joe Easton. Good morning, Joe.
So TSMC looking pretty strong in the pre-market trading on the ADR. Danny, we're up around 3.3% at the moment. The company projecting $29 billion in revenue for the quarter. Not too bad despite those trade war issues for the company. But separately, they are downplaying talk of a partnership with another company. And that is hitting Intel this morning because it had been speculated that the two companies would team up on a venture. And we can see Intel coming down 1.8% in the pre-market. Then we've got Alcoa in mining, the old bellwether from that sector, looking a little bit soft on some of their aluminium projections. Have seen the base metal prices coming down recently, and we can see Alcoa slipping in the pre-market. And keep an eye on Hertz, once again surging as Bill Ackman takes a stake in the car rental company. A second day of gains following a 50% move in that one yesterday. Set to continue that huge rally, Danny. Keep an eye on Hertz in the pre-market this morning.
Joe, thank you very much, despite the fact you almost called me Dowie, but I'll take it. A Dowie rally. Joe Easton.
It's been a long week.
Bloomberg's Joe Easton. It's basically Friday, it doesn't matter. So anyway, back to our top story. Trade talks are underway in Washington. President Trump says that there's been big progress in talks between the U.S. and Japan. Next up, Italian Prime Minister Giorgia Meloni, who's in Washington now, will also discuss trade with Trump. Joining us now is Bloomberg government reporter Jonathan Tamari. Jonathan, what do we know about the big progress that's been made with Japan?
Yeah, both sides put out very positive sounding statements yesterday after Japan's lead negotiator had a meeting with President Trump and other officials. They both sound like they're moving in a broadly positive direction, but nothing is finalized yet. And I think if you talk to the Trump administration, they would say this is the plan all along, that they were going to force people to the table and get better deals for Americans. I think the lingering concern is going to be that how many deals can you really do within these 90 days before the full tariffs kick back in? And is there a systematic process here? Is it just going to be kind of country by country?
So far, it looks like something akin to country by country, Jonathan. What should we expect out of Maloney's visit today?
Yeah, it's another one where I think the president often operates based on not necessarily international relations, but more his personal relations with people. And Maloney has a lot of ideological similarities to Trump. So I think that's something that she will probably play up and hope that she can get a good deal for Italy. And I think a lot of Europe is going to be watching to see how this works out, because she's one of the leaders in Europe that I think might have the best or the closest affinity or most similar relations to Trump. So if she can get a deal, that might be a positive sign. If she can't, it might be pretty concerning to people who are less close to the president.
Jonathan, thank you so much for your reporting this morning. Jonathan Tamari of Bloomberg Government. For more on Trade Talks, pleased to say that Rob Casey, partner and senior analyst at Signum Global Advisors, joins me now. Rob, great to see you. Thanks for so much for coming into the studio this morning.
Of course. Morning, Danny.
So, okay, the market trades basically on every trade headline. We're excited this morning that there's big progress with Japan. How much confidence can you take in that?
You know, I don't think a lot of confidence. And I say that because the President Trump's team has to strike, 60 plus deals over the course of the next, not even 90 days now, right? 80 some days. So, we hear progress on Japan, and we expect to hear progress on the UK. Beyond that, I just think it's probably too much to do in 3 months, and so we do expect to see more negative headlines as we get out to that July 8th date.
Does that mean as we get to July 8th, we might see more delays to the delays of trade talks? If the Trump administration has this huge task of kind of getting deals done with 75 different trading partners?
Yeah, I think we could see more delays, but I think that honestly the scarier idea and what we think is base case expected is that we will actually see some of these tariffs put back on July 8th, right? I think the point we're making to clients, and it's an important one, to your point, stocks are up and down depending on even the most minute headlines around these trade talks. But I don't think we can forget that in President Trump's first term, he canceled tariffs on steel and aluminum only to put them back on later, right? So we're not out of the woods. A cancel or a delay, right, a pause, is not necessarily a cancellation.
Yeah, fair enough. Something important to keep in mind. But it also feels like everybody wants Scott Bessent in the room for their trade negotiations. China talking about a point person, you'd have to assume that maybe that's who they're speaking about as well. Do we have any idea as to who is actually leading on this front, whether Scott Bessent has become the proverbial adult in the room leading these conversations?
Well, I think he's definitely the adult in the room. I think he probably has always been the adult in the room, right? And markets certainly have taken some comfort, really, since President Trump's inauguration, in that Bessent is in the room. Now, I think there have been moments where Peter Navarro, Commerce Secretary Lutnick, they have been the loudest voices in the room. But I think since, the unwinding of Liberation Day, it does feel as though Scott Bessent is in the driver's seat, right? That's not to say he'll be in the driver's seat forever, and there's sort of this Kremlinology or White Houseology about who is the last voice in the room, who is the loudest voice in the room. I think that the truth of the matter is there is not going to be one consistent final or loudest voice, but for the time being, it does seem to be Scott Bessent.
Again, that just kind of leads to the volatility. And I wonder when you hear from these various cabinet officials, whether it be Lutnick, whether it be Bessent, speaking with Bloomberg's Anne-Marie Horderin this week, whether you look at them as spokespeople actually for the administration or almost just kind of wish casting what they want the policy to be. How seriously can you take every word that they say?
I think the truth is when you're working for President Trump and you're on television, you're speaking to an audience of one, right? You're speaking to the president. And that's not a knock on any of these folks, any of these secretaries, and it's not a knock on President Trump. I mean, if you take him at his word, what he's trying to roll out is something that the country really has never done before, right? This is bigger than Smoot-Hawley, and that was 100 years ago. So I think it's fair to say that the team is still working through maybe what their strategy will be, what they're going to ask for in trade negotiations. What we don't expect is for them to just take the quick win, right? There's this thesis out there that, since Liberation Day and the turmoil that we saw, in particular in the bond market, now President Trump's team is just looking for quick wins, right? Any trade deal where they get some concessions, they will take. I think that they're going to stand firm and request more and higher concessions than a sort of quick win thesis would indicate.
Well, as that's going on, we've seen some legal challenges start to mount. We had yesterday California, Gavin Newsom, and the Attorney General suing in order to try to block the tariffs. Do you think any of these legal arguments will have legs to them?
I don't think that California's suit will have legs. We haven't seen suits to this point that we expect to have legs, which is not to say that the suits are bad or poorly written or poorly argued. It's just to say that IEEPA is very vague and very broad, right? And some of these suits, the point that they make is that IEEPA itself doesn't list tariffs, right, as a presidential action or authority. But the fact that tariffs aren't listed is not a reason why the president can't use tariffs under emergency economic power. So the suits that we've seen so far, I would not expect to be successful because IEEPA has been so broad. And just to state, if I'm wrong about that, right, and one of these suits does prove to be successful, the president can just come back the next morning, right, and start a new tariff process through 232, 301, right? There are a number of presidential powers at President Trump's disposal to reapply tariffs, right? So this isn't necessarily a one and done. There are a number of tools he can use. If one gets struck down, he'll just use another.
So the legal system can't necessarily serve as a circuit breaker in here. And the thing that we have seen serve as that has been the market, has been when bond yields went higher. For now, they've kind of been at bay. And there seems to be this idea that the market has regained this confidence that it can indeed push around the Trump administration. Should it be that confident? Do we understand that to be the circuit breaker? Well,
I think pretty clearly the bond market has been, the Trump put so far, right? Yeah. It seems as though everybody over the past couple of weeks has been asking, where is the Trump put in the equity market? And I think that the truth is there may not be one until we get to the bond market. So that's what I would start looking at in terms of, response vectors from here. But I will say President Trump, and I think it's probably true that anybody sitting in the Oval Office doesn't like to be made a fool of, right? Doesn't like to stand down from what they had announced, right? So this isn't necessarily just a point about President Trump. I think it's a point about anybody in power. Now that President Trump has had to take one step back, we think it's less likely that he will take a second step back, right? As we get closer to July 8th, maybe this is a moment where President Trump wants to push, right? Maybe push his advantage, maybe push his perceived advantage, and if he does that without having the leverage over other countries that he thinks he does, we could be looking at tariffs on July 8th.
So for big international companies that have to deal with this, is there a threat that they get pushed further away from the U.S.? And I ask this because the FT had a really interesting story out this morning, basically saying that NVIDIA's Jensen Huang is in Beijing right now and that he's been holding talks with the Chinese vice premier. And this, of course, comes off the back of NVIDIA also warning the fact they're going to take this huge charge because of increased export controls from the Trump administration. Is there a risk that we are pushing not even just countries, but companies into China?
I think that there is a risk of that, right? And what we've heard from the Trump team over the course of the past week is actually quite the opposite, right? There's this idea that actually this, the whole Liberation Day, the whole tariff agenda has been meant to pull companies and countries away from China, right? And that is it's a gamble, right? It's a gamble for the United States because there are certainly countries and companies who are as exposed to China as they are to the U.S., if not more, right? And I also think it's a gamble because, if I'm a company or a country, and I think this is new, right? What I'm seeing in the U.S. is instability, and what I'm seeing in China is relative stability, right? So if I'm making those bets, all of a sudden the U.S. doesn't look like, the shining trading partner that it once did, given all of this instability. If we get beyond July 8th and there are still no tariffs on, I think maybe we can get back to, status quo ante, back to normal. But, I mean, for the time being, the U.S. does not look like a stable, reliable trading partner.
Well, kind of on the same note, Peter Schiff of Academy Securities has been talking about this idea that the brand of America is tarnished in this. Whether it's this type of volatility for companies, whether it's actions taken against Ivy League schools that are these big beacons of American institution, and it means that abroad the American brand is less attractive in terms of coming over here, in terms of buying goods. Would you agree with that? Is there a threat of brand America?
Well, I think that the brand of America remains strong, right? and President Joe Biden always used to say, I would never bet against the American consumer, the American manufacturer, et cetera. So I think that there still is some of that, right? But I honestly, in this moment, I think that is because there is a lack of a suitable alternative, right? We can talk about how China looks relatively good in this moment, relatively stable for sure. It's stable because it's an autocracy, right? It's stable because it is one man with an iron fist, holding a country at bay. And the U.S. remains a democracy. The U.S. remains a relatively open market. It's easier. It's a little bit, muscle memory to say that the U.S. remains an open market today, which it wasn't last week. But I think that being said, right, there's no obvious safe haven other than the United States. So I think that the U.S. benefits from, nearly 100 years of being way out in front of everybody else. I think we will continue to be way out in front of everybody else, despite this, instability, volatility, because I'm just not sure that there's anybody sort of stepping into that vacuum.
Yeah, it's a very similar conversation we've been having about the dollar, too, and its reserve status. Yeah. Rob, thank you so much for coming in early for us. Really wonderful to see you.
Danny.
As Rob Casey of Signum Global Advisors. Let's get you some other top stories that are trending on the terminal this morning. TSMC is keeping its growth outlook for 2025. It still expects mid-20% growth this year, despite tariff uncertainty. It also stuck with its capital spending projection. TSMC expects AI revenue to double. Chinese President Xi Jinping is promoting the idea of a, quote, Asian family, calling for regional unity. It's an apparent effort to counter U.S. pressure on nations to limit trade ties with Beijing. Xi has been touring around Southeast Asia this week, starting with Vietnam, then Malaysia, and Cambodia. Hermes shares sinking this morning after the maker of Birkins reported weaker China sales. It will also increase prices in the U.S. by May 1st to compensate for the impact of new tariffs. The company said it hasn't noticed change in U.S. demand trends. So get your Birkin now, I guess is the moral of this story. Coming up, the ECB is expected to cut rates for the 7th time. More on how tariffs are weighing on policymakers in the EU. We go to Frankfurt next. This is Bloomberg.
Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
What is the issue between the type of information that's being collected by investors and the marking issue that you're describing?
What mark-to-market assets do is it forces honesty into the situation. We're talking right after the DeepSeek model surprised everybody in its efficiency. It took hundreds of billions off of market caps because it legitimately raised concerns that maybe the future of AI was different. I guarantee you that if you look at other portfolios that aren't marked, they didn't move. If private assets are going to eat the world, as they say, with the equity market halving in the number of names, you come to a world that is increasingly an echo chamber. Imagine you have a firm that has some public assets and some private assets. If you see your public assets in AI going down by 20%, you're going to be thinking very, very deeply about what your private assets are worth differently than someone who just has the latter.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
You're watching Bloomberg Brief. I'm Danny Berger in New York. Now to Frankfurt. The ECB is set to cut interest rates for a 7th time, a move that comes after President Trump's tariffs shook markets and darkened the economic outlook. Bloomberg's Lizzie Burden is at the ECB headquarters in Frankfurt. Lizzie, what are we expecting today?
Well, Danny, I'm not going to lie. This meeting was really nail-biting. It was meant to be, but actually now it looks like it's going to be a bit of a no-brainer, especially for most of the Governing Council, at least, because, of course, as you say, Donald Trump's tariffs mean, in the eyes of economists at least, it's going to weigh on growth and inflation here in the euro area. On top of that, yes, we've had this 90-day reprieve on 20% levies on the EU, but the talks, as you were just discussing in Washington this week, haven't yielded much. And actually, the EU hasn't retaliated yet. So the ECB doesn't need to deal with the potentially inflationary impact of that retaliation. There's been this whole debate about whether the fiscal boost to growth would outweigh the tariff threat to growth. But what we've heard from policymakers since the last meeting is, look, one's long-term, one's short-term. And yes, we need to be vigilant about balancing the two. But what they need to deal with in the here and now is, first of all, this rapid rise in euro dollar, and that making imports cheaper, exports more expensive, and then potentially hurting the industrial base, so needing to support growth. Lower oil prices, deflationary, and then on top of that, the chance that China floods Europe with all of these cheap goods to circumvent its own tariffs. So all roads point to a quarter-point cut today, especially, by the way, because you've got inflation comfortably moderating towards that 2% target.
Lizzie, we heard from the Fed yesterday about this concern of unknowingness of what happens if you do have inflation at the time that growth is weakening. For the Fed, it really meant that they are staying on pause, that they're taking their time. What about for the ECB, that path ahead when there is so much uncertainty about what things look like?
Well, yeah, and the fact that Jay Powell has kind of dashed hopes of a Fed put really puts the pressure on Christine Lagarde today, Danny, to calm these markets, especially after everything that happened last week, and especially when you've not got a Bank of England decision this month or a Fed decision. So the focus very much on the path ahead, given that a quarter-point cut today seems pretty much nailed on. And that puts a lot of onus on the commentary around this decision. There is no way, I reckon, that they will drop the language about it being data dependent and meeting by meeting. But what will be interesting is whether they drop this language about monetary policy having become meaningfully less restrictive. They added that on last month, but if they drop it, it would be a hawkish signal, and it doesn't seem like that's something that Christine Lagarde is going to want to send today.
Lizzie, fantastic reporting. Looking forward to your reporting throughout the morning as we get closer to that ECB decision. That is Bloomberg's Lizzie Burden in Frankfurt. Elsewhere, Netflix will be reporting its first quarter results after the bell. Analysts expect the company to weather the macroeconomic climate better than its competitors. Joining us now is Bloomberg Intelligence tech analyst Matt Bloxham. Matt, we also heard from the Journal yesterday, or the day before rather, that Netflix was targeting some pretty big goals in 2030, something like a $1 trillion market cap. Are we headed into an earnings season with a very confident Netflix despite the economic environment?
Yeah, I think we are. Obviously, those kind of 2030 goals are pretty ambitious, and quite a big transformation in what the company is, and particularly with advertising revenue. I think certainly it's going to have been a strong quarter for the company. There's some kind of really good TV launches, particularly Adolescence, which has kind of been a really big success, certainly here in Europe, and they've been extending more into kind of live content too. So, I think it's going to be a strong quarter. Interestingly, from this quarter, they will no longer report subscriber numbers, or average revenue per subscriber, which has always been a massive focus for investors. And I think they're trying to take away the focus on that kind of short-term volatility in those numbers and make people look more at the overall kind of revenue growth, which is probably going to be in the kind of low to mid-teens, about $10.5 billion of revenue markets expecting it in Q1. And I think Netflix is probably the one streaming platform that the majority of people would be really reluctant to say goodbye to. So I think even to the extent that we get a recession, I think customers are going to hold on to Netflix, and if anything, it may well prompt people, to stay at home more and seek entertainment at home. So I think it could become an even more important part of people's lives, as we saw in the pandemic. So I think, they're in a good spot right now.
Matt, before we let you go, I want to ask you about the chip sector too, because it was a really rough day after yesterday's news of restrictions to NVIDIA's H20 chips. We heard from TSMC overnight, a strong set of results. How much reassurance can we take from it?
I think some, but not a huge amount. Yeah, obviously they've kind of got strong growth in Q1. They're reporting a better than expected outlook for Q2, but the full year sales growth guidance, kind of around 25%, is unchanged. So it's very much a pull forward. People stockpiling before the tariffs hit, and they seem very upbeat about the demand for AI chips. That kind of makes sense for 2025, given all the capex we're seeing going in from the hyperscalers. But the tariff story can turn on a dime, and if things change tomorrow with details of the specific chip and smartphone tariffs that Donald Trump has kind of flagged, then the outlook, and concerns could come back again. So, I think they're doing everything they can. They're a great company, really leading the semiconductor space. But, there's still a lot of uncertainty out there that's going to take quite a while to play out.
Matt, thank you so much. That is Bloomberg Intelligence's Matt Bloxham. Coming up on the show, we're going to wrap up the week with a rate decision and earnings. Congratulations. It's Thursday, but it's also your last trading day of the week. We're going to break it down for you coming up next on your Bloomberg Brief.
Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Versace in Davos, Switzerland, and this is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
You're watching Bloomberg Brief. I'm Danny Berger in New York. Let's get you set up for your trading day. The ECB will be announcing its rate decision. That comes at 8:15 a.m., followed by a news conference by Christine Lagarde at 8:45. Plus, American Express results come before the bell. Netflix, meanwhile, is after the bell. And markets are closed in many countries for Good Friday tomorrow, including the U.S. So enjoy this, the last trading day of the week. You are looking at equities attempting a rebound after a sell-off yesterday, first led by chips, and then Powell talking about inflation as the #1 concern. U.S. futures up about 0.8%. All right, that's it for your Bloomberg Brief. Surveillance, take the reign from here.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turned a profit.
Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
Bloomberg has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
There is real damage happening today, right now.
There's a lot of bad sentiment, and that's helped the market recover. People are looking for some amount of clarity.
Markets are very jumpy and very uncertain these days.
The appetite for U.S. assets could be something that is a question.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get you to a long weekend. Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Thursday, and Chair Powell isn't coming to the rescue.
Some people believe the Fed will intervene if the stock market plummets, the so-called Fed put. Are they correct?
I'm going to say no with an explanation. Markets are struggling with a lot of uncertainty, and that means volatility. But having said that, markets are functioning, conditional on being in such a challenging situation. Markets are doing what they're supposed to do.
Stocks are heading for a week of losses as the Fed chair looks through market dislocations, focused on anchoring inflation expectations.
Our obligation is to keep longer-term inflation expectations well anchored and to make certain that a one-time increase in the price level does not become an ongoing inflation problem.
Tariff anxiety fueling the fastest retail sales growth in some 2 years as consumers look to get ahead of potential price increases. Ford is preparing to do just that as soon as May if the president doesn't deliver on the relief that the auto sector is hoping for. The clock is ticking.
The clock is ticking, Jonathan, and we see these negotiating teams arriving in Washington, try to strike a deal. Yesterday, we have the Japanese negotiators in town. The president joined that meeting. He said there was progress, but yet they have to schedule another meeting. And that is really going to be the litmus test for what other trading partners should be doing. Scott Besson had said to me earlier in the week, first mover advantage. If the Japanese come out and are able to strike a deal, everyone is going to be looking to them. What were they able to extract? What kind of concessions also do they have to give in order to get this over the finish line before those 90 days are up?
Chair Powell isn't blinking. Is it fair to say the president is taking a softer tone with allies over the last week?
I think it is fair, given the fact that he joined those negotiations yesterday, came out and said, I'm going to be part of the negotiations. I believe they sat with the president himself for 50 minutes before sitting down with Scott Besson and Commerce Secretary Howard Lutnick. And then today, who do you have arriving in Washington, D.C. to try to have an olive branch, this whisper of Europe, Giorgia Meloni, the head of Italy, coming to town. She is going to try to help the European Union get over the finish line with some sort of deal for this reprieve that they're dealing with right now, these 90 days.
Some kind of deal, some kind of relief. The auto sector's looking for the same thing. What we saw yesterday in retail sales were consumers front-loading purchases, and you saw that in sales of autos as well, specifically. Purchases of autos up more than 5% in the month of March. Ford getting ready to raise prices on cars coming out of the factories as soon as May. That's how much time we've got here.
I think the issue you take with this, if you look at, say, Ford having to do this, Ford is looking at raising prices. Ford is the best positioned auto manufacturer in the United States because some 80% of their cars are made in the U.S. And even they're saying, we are unable to withstand this 25% levy. And we're going to have to look at, and all these tariffs, we're going to have to look at potentially raising these prices. It also comes at a time the president insinuated earlier this week that he may give the auto sector a reprieve. Still, corporate America is saying, we don't know yet, so guess what? We're going to have to put the prices higher on consumers.
This market whipsawed right now between trade talk hopes, trade talk fears. This morning, trade talk hopes. It's frustrating, isn't it? Futures are up by about 0.75% on the S&P 500. Later on this morning, at 8:30 Eastern Time, you'll have jobless claims. Before that, an ECB rate decision. So a couple of things to look for going into the long weekend. Coming up this hour, we'll catch up with Sharon Bell of Goldman Sachs as the volatility continues. Tobin Marcus of Wolf Research as Trump signals progress in trade talks. And Angelo Zeno of CFRA on the latest tech sell-off. We begin this hour with stocks rising on positive signs from US-Japan trade talks. The team over at Goldman Sachs staying somewhat cautious, writing the following. We would argue that we're in an event-driven bear market triggered by tariffs. However, it could easily morph into a cyclical bear market given growing recession risks. Goldman's Sharon Bell joins us now for more. Sharon, welcome back to the program. Let's sit on those recession risks. Is it fair to say that they're receding over the last week, or are they still elevated from your standpoint?
I think they're still elevated. Whether they're absolutely at peak, perhaps they've receded from those peak levels when there was no scope for negotiation on these tariffs. Now that clearly has started, but they're still relatively high. I think we regard it as 45% chance of a recession in the US over this next year. That's a relatively high chance versus a standard year, and that's because of all this volatility and all this uncertainty.
This market lost a lot of confidence in US policy at the start of this month, Sharon. In the eyes of the Europeans, can you talk to us about changing perceptions of US assets? Have they been damaged over the past few weeks, and how repairable is that damage?
So Europeans have loved US assets in the last 10, 15 years. You've absolutely seen Europeans pivot towards the US, and you see this in many different guises. For example, companies, corporates invested more in the US. They moved more of their divisions to the US, etc. over time because the US has had much better growth. But also investors as well have loved the Mag 7. They've loved the opportunity to invest in tech stocks. They've loved the fact the dollar's been very, very strong. So Europeans absolutely love the US market. They've been one of the reasons that the US has done so well. You've seen a lot of flows into the US over time. That is being questioned a little bit, yes. I mean, not completely. I still think that the US over the next few years will outgrow Europe, but perhaps the gap will narrow a bit.
Can the flows make a U-turn if we get deals done within these 90 days?
I don't know if they will make a complete U-turn because there's a lot going on here. It's not just the tariffs. For example, it's the dominance of US tech globally. Is that now being questioned a little bit with competition, lower cost models coming from elsewhere, the extra capex and investment these companies are having to put in? They're no longer capital-light businesses, for example. It's other issues in Europe itself. For example, fiscal spend by Germany boosting growth in Europe. So I think that there's a combination of things here, and tariffs are just one part of that.
When it comes to looking at the entire policy perspective from the United States, I talked to the Treasury Secretary about this, and he said his advice to the investment community would be you have to look at everything together, the entire stool, which is tariffs, deregulation, and tax cuts. Do you get more bullish on the U.S. as we go down the calendar?
Because you're starting to see some of those other things come through, maybe tax cuts, etc. I think most of the tax cuts that we expect to happen will just be extension of the ones that are already in place. And I think most expect that to happen. So yes, there may be a little bit of relief on that side, but the more that's done on that side, because the tariffs, whatever ultimately comes through, are probably inflationary. Whatever relief you give the economy on the fiscal side will probably mean less relief on the monetary policy side. So no, I don't necessarily think that that means a huge boost to growth.
Sharon, can we just sit on monetary policy? What are you expecting from monetary policy on either side of the Atlantic? We heard from Chairman Powell yesterday. We'll hear from President Lagarde later on this morning.
Yeah, well, we do expect the Fed to cut rates 3 times this year. We're not looking at a recession scenario. If we were, it would be deeper rate cuts. But we think that the Fed has got room to cut rates modestly from here. Although it's a balancing act, as Powell's pointed to, because the tariff and the tariff uncertainty is really causing a little bit of inflation risk to seep through into the US economy, even if there is lower economic growth. But the ECB, I think the equation's much easier, as we've been discussing earlier. I think the ECB will cut this week. Today, you've also got, in our view, more rate cuts to come from the ECB down to about a rate level of 1.5% this year. And the reason for that is economic growth in Europe is not that strong, but you've not got the inflationary impulse from the tariffs that potentially you've got in the US.
If anything, Sharon, they might face a disinflationary bust. Now, I'm not sure that's anyone's base case right now, but let's say the walls stay up in the United States and the tariffs stay on. China's got a lot of overcapacity and Europe might have to eat it. What does that mean for some of the earnings across the continent and the prospect of disinflation in the months and years to come?
Yeah, I mean, not all things about disinflation are good news for Europe. Europe has suffered under too much inflation in recent years, and that's been a hit to the consumer. So obviously, if there's more imports of low-priced China goods into Europe, it's great for the consumer. Also, energy prices have come down. That's good for the consumer. So there are plenty of good things, but there are also some risks for, say, European manufacturing if you see more imports from China. So I agree it's a balance. I actually think European earnings this year for stock 600 companies, for example, won't be that strong. The reason for that is weaker global economic growth, but also tariff risk, falling energy prices hitting the energy stocks, and the stronger euro hitting all the dollar earners in the index as well.
But when it comes to consumers, hasn't the euro appreciating actually helped them? Because right now the Commission hasn't retaliated against the U.S. tariffs.
I know, look, the European consumer has been very beleaguered in recent years, particularly around COVID, around the energy crisis, incredibly high inflation, negative real income, generally weaker European currencies and a stronger dollar. All of it's been bad news for European consumers. But actually now I think we're starting to see the reverse of that. So definitely some winners in Europe from this. Lower cost goods potentially coming in, but also lower energy prices as well, and a bit of a stronger currency giving them more purchasing power. I couldn't agree more with that. But it's a bit of a balance here. Consumers do a little bit better, but then other parts of industry may suffer. Having said all that, not super negative on European manufacturing. Obviously, you've got the fiscal spend and the defence spend coming through in Europe as well, which will give a boost to that.
Sharon, let's just finish on earnings season. On this side of the Atlantic, the financials projected confidence. We saw that from JP Morgan and for the institution you're a member of as well. What are we hearing on your side of the Atlantic? Because what we've seen from the luxury players, LVMH, Hermes, maybe a struggling Chinese consumer. What do you hear on your side of things?
Yeah, I don't think this is going to be a brilliant season for European companies. I think financials actually will do okay. Rates are still generally relatively high in Europe. Even if rates start to come down at the shorter end, long end rates still being relatively high, so steeper yield curve, not such a bad thing for some of the banks out there in financials. They're also often quite hedged for rates coming down too. So I'm not too worried about that group of companies, but there are others that perhaps will see a weaker first quarter. Those exposed to China you mentioned, energy, for example, given energy prices have fallen through the quarter. So there are aspects, for example, of European earnings which are probably not going to see a stunning first quarter. Another sort of element of exposure is the dollar having fallen over that period of time. That's bad news for dollar earners, and they're a big portion of those in the European index.
Sharon, appreciate your time. As always, good to catch up. Send our best to the team. Sharon Bell there of Goldman Sachs on the latest over in Europe and their views on what's happening right here in the United States. Euro dollar at the moment, euro dollar 113.68. We heard it from LVMH, Pernod Ricard, seen it from Hermes as well. Bit of a struggle over in China.
Absolutely. That Chinese consumer is not holding up when it comes to luxury space. You know what's interesting as well about Hermes? They're talking about the fact that they're raising their prices as of May 1 in the United States to deal with the tariffs, because there's still a 10% tariff. Even though there's a reprieve on the higher reciprocal level, there's still a 10% tariff for those European goods coming into the U.S.
Some companies can get away with it, and I would say that's a company that can get away with it. We'll talk about them a little bit later. Let's give you an update on stories elsewhere this morning. Here is your Bloomberg Brief. President Donald Trump sharing on Truth Social that trade talks with Japanese officials have led to big progress. A deal has not been reached, but preparations are underway for a second round of talks later on this month. Elsewhere, Ford is preparing to raise prices on cars if President Donald Trump doesn't deliver on tariff relief. The price increase would affect vehicles built in May, but wouldn't change pricing for those already in inventory. And finally, NVIDIA in the crosshairs of US-China trade tensions. The CEO, Jensen Huang, is in Beijing after the Trump administration curbed the sale of its H20 chips to the country. Huang reportedly meeting with clients, including DeepSeek's founder. This is going to be very interesting today at a time when the Chinese leader is going around meeting with Asian allies, trade partners, talking about one big Asian family.
And it looks like Jensen Huang is trying to get ahead of what is going on in the U.S. The fact that they're looking to curb more of their exports to China, and also they're looking into potentially if any of those chips, Jonathan, were used when it comes to DeepSeek.
More on NVIDIA later on this morning. Equity futures so far in the S&P, nicely elevated going into the long weekend. Up next, the yard of the trade deal.
The tariffs are larger than forecasters had expected, certainly larger than we expected, even in our upside case. We looked at a range of cases. All of this is highly uncertain. That's why we're waiting really to see what the policies ultimately are.
Up next on the program, Tobin Marcus of Wolf Research, live from New York City this morning. Good morning.
Brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Equity futures on the S&P positive here by 0.6% as the president says we get closer and closer to potentially a deal with Japan. Talks making, quote, great progress. Equity futures elsewhere on the NASDAQ up by about 1 full percentage point. In the bond market, yields declining for 3 consecutive sessions, so a bit of stability returning to the bond market. This morning, though, we snapped that streak. Yields high by 3 basis points at the front end of the curve on a 10-year up by 2. And the euro in focus with an ECB rate decision just around the corner. Euro dollar negative by 1/3% to 113.65. Good morning, Mr. President. Putting this out on social media this morning. The ECB expected to cut interest rates again, and yet, too late. Jerome Powell of the Fed, who is always too late and wrong, yesterday issued a report which was another and typical complete mess.
So basically, he's once again jawboning Jay Powell, this time comparing him to Christine Lagarde. How come she's cutting rates and you're not? Too late should have lowered interest rates like the ECB long ago, he goes on to say, but he should certainly lower them now. Powell's termination cannot come fast enough. I spoke about this with the Treasury Secretary. He says nothing to worry about right now, but in the fall, Jonathan, they're going to be interviewing candidates to take over when Powell is over in May 2026.
Do you think it's fair that Chairman Powell won't get an interview? Do you think that's fair to say?
I think that's fair to say at this point, especially when the president is literally saying in black and white to the world, his termination cannot come fast enough.
Termination's a very interesting word. Does that mean we allow the term to expire, or do we explore something else? I think people will be thinking about that this morning. What does that word actually mean?
I think people will be thinking about that. And I will say, before I sat down with the Treasury Secretary, because we were promoting it, I actually got asked. People were asking me, because of that Supreme Court decision that said the president at this moment was entitled to oust those top officials at 2 independent agencies, there was concern in the market about whether or not he would try to oust Jay Powell. We have to remember the independence of the Fed is a cherished pillar of why you invest in the United States.
It will be interesting to see how the market interprets those comments and what kind of clarification we get from the administration later on this morning. Equity futures still just about positive by 0.5%. Under surveillance this morning, the art of the trade deal.
The tariffs are larger than forecasters had expected, certainly larger than we expected, even in our upside case. We looked at a range of cases. Our role is to make sure that this will be a one-time increase in prices and not something that turns into an ongoing inflation process. All of this is highly uncertain. We're thinking now, really before the tariffs have their effects, how they might affect the economy, and that's why we're waiting really to see what the policies ultimately are.
Here's the latest this morning. Chairman Powell isn't blinking, keeping the focus on President Trump, stating, quote, big progress was made in the latest round of trade talks with Japan. Bloomberg's Tyler Kendall joins us now for more. Tyler, encouraging on the trade front between the United States and Japan. But that headline that just crossed the Bloomberg terminal, those comments from the president on Truth Social, referring to the chairman of the Federal Reserve, Jay Powell. Your thoughts on that this morning, please?
Yeah, hey, John. Well, President Trump saying that Powell's termination can't come soon enough. Of course, we know that he's expected to leave his post in May of 2026. And as Anne-Marie said, she asked Scott Bessent earlier this week, who said no need to worry right now, but that they are going to start to look at other candidates starting in this fall. President Trump has long suggested that he should have some sort of comments over input when it comes to FOMC decisions. And he's really linked this directly to his tariff policies, often saying that lower interest rates would go hand in hand with him upping tariffs on our trading allies. So while, of course, President Trump has continued this trend, this perhaps appears to be the staunchest rhetoric that we have heard from him when it comes to an actual termination. Of course, NEC Chair Kevin Hassett has repeatedly said that this White House will respect the Fed's independence, but it remains to be seen if the rhetoric's going to keep ramping up as President Trump tries to imply that Powell is behind the curve.
Well, Powell yesterday said the tariffs are even higher than their upside scenario the Fed was modeling. Tyler, we had the Japanese delegation in yesterday, and today we have Giorgia Meloni visiting Washington, D.C. What does she come with?
Right. Well, Anne-Marie, this is largely seen as a test as to whether or not Meloni can use her affinity with President Trump to try to advance trade talks, particularly when it comes to the European Union. Of course, we know Meloni was here for President Trump's inauguration, considered to have a relatively good relationship with this White House, as President Trump says that he will be directly involved in all of the negotiations going forward. It's our understanding that Meloni is coordinating closely with European Union officials, which their negotiations haven't necessarily gone as well. Bloomberg News reporting earlier this week that the EU trade chief left talks in Washington with very little clarity on exactly what this White House needs to get a deal done. Now, our reporting does indicate that Meloni is expected to propose that all tariffs should be eliminated on bilateral trade between the EU and the U.S., essentially creating a free trade zone. Really remains to be seen whether or not that's something that this White House would entertain. One proposal, though, that might actually get a little bit more traction, Meloni is also expected to suggest that there should be a EU and U.S. trade summit where allies can come and talk directly with senior administration officials, both on trade but also defense, because, Anne-Marie, we know that this administration in particular is pushing for our NATO allies to boost their defense spending, and that likely will make their way into the talks today.
Tyler, appreciate the update. Tyler Kendall in Washington, D.C. I think we've got a new top story. This from the president this morning. The ECB expected to cut interest rates once again, and yet too late, Jerome Powell of the Fed, who is always too late and wrong, yesterday issued a report which was another untypical complete mess. The president goes on to say, too late should have lowered interest rates like the ECB long ago, but he should certainly lower them now. Powell's termination cannot come fast enough. Joining us now to discuss, Tobin Marcus of Wolf Research. Tobin, I would love your response to how you're interpreting that post from the president this morning.
Yeah, termination is not really the word that you necessarily would want to read from the President of the United States about the Fed chair. I do think that as a matter of prudence, it's still not likely that Trump is going to make a move to actually fire Powell. You know, as a legal matter, I do think that there's no real distinction between the Fed and the agencies where he has tried to establish a new right to dismiss independent agency heads like the FTC. So there's going to be litigation about that. To the extent that the administration succeeds in that litigation, that would establish his right to dismiss Powell. But I think that they're just not going to do it based on the market reaction. I mean, similarly, in their executive order asserting regulatory control over independent agencies, they made a point of saying the FOMC is not covered by this when it comes to monetary policy, and I think we're going to see the same approach in terms of personnel.
Tobin, are your clients concerned about Fed independence?
I think there are enough other things going on in markets that are concerning institutional investors that this is, at worst, kind of a vague worry in the back of people's minds. There's so much noise out of this administration, as we've seen in the tariff roller coaster since Liberation Day, that I think for the most part, this is going to need to be seen to be believed in terms of markets, like really trading this like it's materially impactful for their portfolios.
Do you have a sense who some of the administration's top candidates are to replace Jay Powell?
You know, I think there's a lot of overlap with the names that were in conversation for the Treasury Secretary job last fall. I think Bessent is certainly a possibility. We could see the old Dick Cheney move of sort of recommending yourself after interviewing various candidates. And then Kevin Warsh is a name that I think continues to be in the mix as well.
Toby, speaking of the Treasury Secretary, when he spoke to Anne-Marie earlier this week, and she talked to him about the potential timeline for replacing Chairman Powell, he talked about interviews later on in the fall. There was a conversation in the campaign trail, going into the election, that maybe they'd select almost a shadow Fed chair, someone they'd select ahead of time who would go around making speeches, and maybe the market would cue off what that individual was saying versus saying what Chairman Powell would say. Is your base case that they will not do that, or is that something you're still open-minded about?
So I'm not sure that they're going to formally designate a shadow Fed chair, and I recall that proposal came from Bessent, I believe. It was first anonymously sourced and then kind of reported from his own mouth. So obviously in a position to try and effectuate that plan from his current seat if they want to. So, you know, I don't know that it's going to be that formal, but I wouldn't be terribly surprised to see them making a relatively early decision about who it is that they're going to put up for that job, trying to run the confirmation process essentially in advance, and, you know, trying to turn attention to that person a little bit rather than the actual outgoing Fed chair in Powell.
Tobin, appreciate your update and your reaction to this one as well. Thank you, sir. Tobin Marcus there of Wolf Research. If you are just joining us, these are the headlines that come from the president this morning. He's complaining about the Federal Reserve not doing enough to reduce interest rates. Looking at the ECB, who's about to cut interest rates again, and I imagine it's annoying the president this morning, and going on to say too late, which is a new nickname, I suppose, for Chairman Powell, should have lowered interest rates like the ECB long ago, but he should certainly lower them now. Powell's termination cannot come fast enough. Now, how this market interprets this story is important, and at the moment it's not interpreting it in a too negative fashion. Equity futures still positive by 0.6%, but that's a very loaded, powerful word to use on a morning like this morning.
The start of his truth, we've heard this before. He's annoyed with Jay Powell for not moving and cutting interest rates. It's that last sentence, this termination. Is he talking about May 2026 when Powell's term is up, or is he talking about doing something sooner, which would definitely unnerve investors because that would blunt the independence of the Fed?
As we look for clarity on that, equity futures right now still positive across the board, on the Nasdaq higher by about 1 percentage point. Up next, Angelo Zeno of CFRA on the latest tech sell-off from New York. This is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
What's the hardest part of being a CFO?
It's hard to come up with that.
It's the vast responsibilities, the need to be engaged in different topics.
It's remembering which audience I'm speaking to and what I can say in that context.
The job is not just being the executive of the finance function, it's being an executive for the company.
I would say it's prioritization.
Complete the sentence. The hardest part of being the CFO is?
Telling people no. It's hard. It's the right thing to do, but it's always hard.
So being just like a touch of a heartbreaker, basically.
Yeah.
We have a plethora of good opportunities. Some are really, really good, but as we strive for the great ones, sometimes those really, really good ones have to be left behind.
New episode premieres April 23rd, only on Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Interesting start to this morning. Equity futures still positive by 0.6% on the S&P. On the Nasdaq 100 up by 1%. The president saying they've made great progress with the Japanese in talks so far this week on the trade front. This is what the president said just moments ago and on Truth Social, complaining about the chairman not reducing interest rates over at the Federal Reserve, unlike the ECB, which is expected to cut interest rates later on this morning. He should certainly lower them now. Powell's termination cannot come fast enough.
So I think market participants will say, we've heard the president talk about the fact that he's allowed to have an opinion. He thinks he understands where the economy is better than anyone else, especially monetary policy. So maybe they understand why he's voicing his concern about being too late. What is going to unnerve investors is the fact that last sentence, he says his termination cannot come soon enough. Is the president willing to wait till May of 2026, or is he going to do something else that is going to make a lot of people very concerned because they want to see an independent Fed in the USA?
Mike McKee's in the building. We'll catch up with Mike a little bit later this morning to get his thoughts on all of this. I want to get to some movers just briefly. Nvidia down almost 7% in yesterday's session, bouncing back just a touch this morning, up by 0.6, down 22% on the year so far, as the US slaps more curbs on chip sales to China. Interesting to note that Jensen Huang, the CEO, landing in Beijing today, so look out for headlines from that. I want to turn to Hermes and get you an update on luxury. Hermes this morning, negative by 2.5%. A rare sales disappointment from the luxury goods maker. Chinese shoppers reining in spending. Saw something similar from LVMH earlier this week. Plus, price rises coming in the United States at the start of May.
So you saw a lot of these luxury players actually double down in the U.S., say the U.S. is where we can make sure we have these luxury consumers, especially if China's looking a little bit weak. Now they have to deal with the fact that, are these luxury consumers still going to buy when prices go up? And Hermes is saying prices are going up May 1st because of tariffs. The issue is they're in a league of their own, and I think if you can already afford a $20,000, $25,000 handbag, you could probably afford it if it's going to go up 10%.
Can you say the same thing about Ford? We'll get to price hikes there in just a moment. On our radar this morning, President Donald Trump saying, quote, big progress has been made in trade talks with Japan. Japan's lead negotiator meeting with Trump for 50 minutes and U.S. negotiators for 75, with another round of talks expected later this month.
This is really important because Besson has said to me that the first mover advantage potentially is the one that's going to get the deal at the start of the day. So you have to imagine those 70-plus partners are looking at how the Japanese are dealing with this administration. And if they are going to get a deal first, what are the contours of that deal? The concessions, the extraction, does it have to do with non-trade barriers, or is it really just about tariffs? That is going to be key for everyone else. They're really writing the pathway for success, potentially. We have to see if the deal comes in the end.
Auto's a big feature of this conversation. I mentioned Ford, so let's get to it. Preparing to raise car prices if President Trump doesn't deliver on tariff relief. The company planning to make adjustments for cars rolling off assembly lines starting next month, with the vehicles set to arrive in U.S. showrooms in late June or early July.
This is what they said in the memo. We anticipate the need to make vehicle pricing adjustments in the future, which is expected to happen with May production. Why is this? Because right now, they still have the tariffs in place, some of these tariffs, even though, Jonathan, there is full court press lobbying from the automakers to the White House trying to get some more reprieve. At the end of the day, if they don't have clarity, what we've seen, whether it's Hermes, whether it's Ford, they're moving ahead and raising prices to make sure they're not impacted on their bottom line.
The stock is up by 0.6%. Elsewhere, Taiwan Semi keeping its growth outlook for 2025 despite tariff uncertainty. The company expecting AI revenue to double and reiterating a goal set in January for mid-20% growth this year. Staying on tech, NVIDIA looking to recover from Wednesday's declines after the Trump administration restricted its chip sales to China. Angela Zeno of CFRA writing, we estimate that this development puts about 8 to 10% of the country's revenue tied to China servers at risk and could empower domestic China competitors, specifically Huawei. Angela joins us now for more. Angela, welcome to the program. What was your reaction to that news yesterday? And what do you anticipate Jensen Huang's going to do in China later on this week?
Yeah, so thanks for having me, John. You know, when I look about what happened yesterday, interestingly, you know, I'd say about 2 or 3 weeks ago, we had an internal meeting, and my belief was probably at some point in May, we'd actually see a GPU ban into China. And I'd say that kind of really fell off the table really quick after, you know, there were reports that Jensen had met with President Trump at a Mar-a-Lago dinner. And, you know, essentially that was almost kind of put off the table, right? So you kind of sit here yesterday, we look at the 7% pullback in the shares. That's probably about right in terms of the risk exposure, in terms of from an earnings trajectory for NVIDIA here, as far as the H20 is concerned. When you start thinking about the lack of exposure now in China, that meeting that Jensen had in China. Again, I mean, what Jensen has done here over the last couple of years is he's fought really hard to stay into China. There's been a number of export restrictions out there. They've had to continue to temper the performance on those GPUs, and really kind of the H20 is a China-specific GPU. So really, I think the meeting there is for Jensen to kind of just continue to say, hey, listen, we're committed to China. We're going to have to try to do it maybe another way. But, you know, it's an important market. It's the second largest market out there. You've got some major hyperscalers in the likes of Alibaba and Tencent out there. So Jensen wants to be out there in terms of the NVIDIA exposure.
Angela, the good news for NVIDIA is they don't have a demand problem. They've got a supply problem. Can you say the same about all the other chip makers?
You can't, you know, in some respect, in the near term, I'd say, you know, NVIDIA is best positioned, even when you kind of hear Taiwan Semi's call just a couple hours ago. They kind of alluded to the fact that they are still supply constrained on the AI side of things. So that does bode well for NVIDIA. But it isn't necessarily about NVIDIA's prospects here over the next 2 to 3 quarters. It's about the sustainability of demand as we go into 2026. And you do see some risk of that now, or increased risk, if you're not able to play in that China market, which again, you know, potentially is about 8 to 10% of their current revenue, at least on the data center side of things.
Angela, do you think the company is thinking about developing a new chip that can go to China, given the fact that the H20 was manufactured and developed so that it was able to export to China, given the U.S. export controls?
Yeah, I mean, I think we have to see what those new export controls look like, and you know, if there's any way that NVIDIA and AMD can circumvent some of these, you know, new restrictions or what have you. But when you start looking at this new administration here, there's a part of me that thinks that they don't want NVIDIA to have any exposure, at least kind of on the AI side of things in China. Again, remains to be seen. We'll see. They'll try to some extent, but I don't know if they're going to be successful this time around the way they were successful under the Biden administration.
How are you thinking about the sectoral tariffs when it comes to semiconductors that the president promises that we're going to see?
Yeah, I mean, and that's a good question. You know, you look at right now, there's a Section 232 investigation that's going on. We're expecting some sort of implementation at some point in the second half of the year. Our base case right now is the fact that you're going to see some sort of tariffs. That is going to be a permanent effect on the semiconductor industry and the broader hardware industry. But our view is the base case is somewhere along the lines of a 25% tariffs. Obviously, anything significantly above that is going to be a risk. And there is, you know, hopeful some hope on our end that it's going to be less than that. But when you look at the semiconductor industry specifically, one area that does have pricing power is the chip industry. They've been able to kind of pass higher prices on over the last couple of years, obviously on the leading edge side of things specifically. So our view is any type of tariffs that are announced or put in place is going to get passed through to those hardware manufacturers, which ultimately, if you're a company like Apple, will push that down to the onto the consumer themselves.
Angelo, just before you go, how are you navigating earnings season so far? TSMC came out projecting some confidence, keeping their guidance basically unchanged. ASML, some disappointing orders from them. Do you put more weight on one versus the other at the moment?
Yeah, I mean, I think Taiwan Semi is the bigger play as far as kind of gauging the demand prospects across the broader semiconductor industry. I think, you know, as far as going through earnings season is concerned, I think most of these companies will be relatively in line on as far as semiconductors are concerned. I think the guidance also is going to be roughly in line. Most companies are probably going to keep a lot of their guidance in place, but most investors out there probably won't believe you know, what the outlook is going to be, because it's more along the lines of what the second half in 2026 is going to look like. As you kind of go into the second half of the year, if the consumer doesn't show up this holiday selling season, you're going to start seeing inventories build, and that's going to end up being an issue for the semiconductor industry. So I think all eyes right now is going to continue to be on the policy side of things, and really, that's really going to dictate how these semiconductor stocks move here over the next couple of weeks and months.
A tough 24 hours for the chip makers, that's for sure. Angelo, appreciate your time, sir. Thank you. Angelo Zeno there of CFRA on NVIDIA and a whole lot more. If you are just tuning in, welcome to the program. Some very strong words coming from the president aimed at Fed Chair Jay Powell. This line right here, Powell's termination cannot come fast enough. With more, here's Mike McKee. Good morning, Mike.
Good morning, John. This does appear to be the first time that the president has actually threatened to fire Jerome Powell. He's criticized him since he returned to office, but hasn't said anything about terminating him. Now, the question is, of course, can he? Powell has said he won't leave if the president asks him to, and that he would fight any kind of termination. This all gets back to a case that's being fought over the head of the National Labor Relations Board, Gwynne Wilcox, whom the president fired. The argument is that under, you've heard the term Humphrey's executor, that the president can't fire somebody except for cause, the head of an agency, independent agency, except for cause. The administration argues it can. So the question is now before the U.S. Appeals Court for Washington, which has let Wilcox go back to work while they figure this out. But it's anticipated to go to the Supreme Court. Now, the question is, would it get to the Supreme Court and would they make a decision in time for it to really matter with Powell, whose term is up in May of next year?
Mike, Powell talked a little bit about this yesterday. What was his response?
Well, he was asked about it again, and he said no, he has no intention of leaving. He's going to serve out his term. The interesting thing, Anne-Marie, is that he hasn't defined what his term is, because he has two. He has the chairman's term, which expires in May of next year, but he's also a member of the Fed Board of Governors until 2028. If he were to leave the chairman's job right now, there would be no openings on the board, and the president couldn't appoint anybody. So it's going to be a very interesting situation, shall we say. I don't want to say it's a court case yet, but very interesting situation as this plays out.
Potentially. Mike, thanks for the update. We'll come back to you later on this morning. Mike McKee there on the president's words this morning. Language is important. That would be my question to the press secretary today. Termination. What did the president mean by that? Did he mean the expiration of his term as Fed chair in May of next year, or did he mean something else?
I think that's a great question, because he just said termination cannot come fast enough, meaning I'm waiting out these next 12 months, or I am prepared to take action because I'm annoyed that he has a new nickname for him. Too late, Jay Powell is taking too long to cut interest rates.
You probably want to know how the market is interpreting this morning. So far, okay, still just about positive on the S&P 500. The S&P is higher by 0.4%, but rolling over. If you check out the bond market on a 2-year, 10-year, and 30-year maturity, yields just a little bit higher, up by 2 or 3 basis points on a 10-year at 4.30. I imagine if we were in a situation where the President of the United States fired the Fed chair, we'd have a very different market reaction to the one we've got right now.
Absolutely. I think the market's looking at this and they're saying this is the rhetoric we have heard from Trump in his first administration, and we've heard it from him again as he's president in his second administration. He jawbones, he likes to have an opinion about the Fed, where interest rates are going, and about the individual himself, Fed Chair Jay Powell. If he was to do something, I really think you will have a market reaction, because before I sat down with the Treasury Secretary, this was something individuals were messaging me about. Please ask Scott Bessent what he makes of the Supreme Court ruling that at the moment, the president can oust of top officials at independent agencies.
Certainly given up the gains this morning. Still positive, but only higher by 0.4% on the S&P. Let's get you an update on our top stories this morning. If you are just joining us, our top story, President Trump with strong remarks for Fed Chair Jay Powell this morning, posting on Truth Social, he's too late and too wrong, calling on the Fed to cut interest rates. Trump adding that Powell's termination cannot come fast enough. Elsewhere, United Health shares are down after reporting first quarter earnings below expectations. The health insurance giant cut its earnings outlook for the year. The company now missing targets for medical costs several quarters in a row. Their stock is down by 19%. And your final story, Meta CEO Mark Zuckerberg wrapping up 3 days of testimony in the FTC's antitrust trial. Zuckerberg responding to evidence suggesting Meta bought Instagram and WhatsApp to eliminate competitive threats, arguing the acquisitions did not harm competition. Their stock is just about positive in the pre-market. Up next on the program, the president sticking to his words.
People are looking for some amount of clarity. I look at this term of the Trump administration somewhat differently than the way we looked at the last one, in that almost he is sticking to his literal word when we're talking about tariffs and trade here.
In just a moment, we'll catch up with the former senior Trump trade advisor, Kellyanne Short. She joins us next, and we'll give you an update on the president's comments this morning on Fed Chair Jay Powell.
Let's cut right to it. This is Bloomberg's new show, Primer. Technology is $1 trillion game. Won, lost, won again, just by backing the right science at precisely the right moment.
My life has been focused on how can you elicit intelligence from brain cells in a dish.
This is the fundamental building block of our fusion technology.
We're doing things that have never been done by anybody, ever.
Everyone is selling the future. If you want to understand what's coming, you'll want to watch Primer, because details matter.
Lasers on.
So do lasers.
There we go.
Oh, and it's on all these lovely channels. Hope you're jotting this down.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Equity futures still just about positive here, up by 0.4%. On the Nasdaq 100, up by 0.7%. Just got a message about the Dow. Why don't you quote the Dow? Because United Health is 9% of the index and hardly anybody owns the Dow. And if someone's screaming at you this morning talking about the Dow being down, seriously, choose a new TV network. The Nasdaq right now positive by 0.75%. That is why we don't talk about the Dow on this particular program. All right, rant over. Let's get to another rant from the President of the United States. This is what he's got to say. Powell's termination cannot come fast enough. What a line by the President of the United States.
I'm thinking he's the one that actually messaged you, because we do know that he is one of those individuals that actually likes quoting the Dow, and in his first term used to use it all the time, depending on how good his presidency was going. This line, Jonathan, is very hot, because it is not just saying, I can't wait for Jay Powell to not have that job anymore. His termination cannot come fast enough. Is the president talking about the end of his term as Fed chair in 12 months, May 2026, or is he talking about something a little bit more nefarious in terms of firing Fed Chair Jay Powell?
If you want to take the temperature of the bond market this morning, there's no freak out to this headline. I think that's important. How is the market interpreting that headline this morning? Yields are up by 2 basis points on a 10-year to 4.30. At least for now, no real drama.
I think so now the market participants, I think, are seeing this as just Trump rhetoric. Trump taking the truth, voicing his concerns. He probably saw what Powell said yesterday. Definitely different than, say, what Governor Waller was talking about in terms of where he's leaning on with the mandate, the concern he has about inflation and about tariffs. So the market right now is just viewing this as Trump's voicing his opinion. He's done this before, he'll do it again. But if this was to move into potentially a firing, I think you'd have a very different market reaction.
Mohammed Al-Arian, 11 minutes away. He's going to have his reaction to that story in just a moment on this program. Under surveillance this morning, the president sticking to his word.
People are looking for some amount of clarity. I look at this term of the Trump administration somewhat differently than the way we looked at the last one, in that almost he is sticking to his literal word when we're talking about tariffs and trade here.
Here's the latest this morning. President Trump signaling big progress in trade talks with Japan, fueling Wall Street hopes that agreements can be reached to avoid higher tariffs on trading partners. Kellyanne Shaw, the former senior Trump trade advisor, joins us now for more. Kellyanne, it's good to see you.
Good to see you as well.
What are the prospects of making a deal in this smaller time frame with this many countries?
Well, I think the chances of making a deal with Japan seem pretty high, right? Like, you've heard Bessent talk about the fact that there are about 15 countries with whom they're close to making a deal. I don't foresee 90 countries in 90 days, but certainly with some of our major trading partners with whom we have some of these significant issues, I do think the administration is very optimistic.
Let's talk about the one that's a little bit harder, China. They came out this week with a number of demands they'd like to see a response. By the way, we should note this was a Bloomberg scoop, according to someone familiar with the CCP thinking right now. Do you think this administration is ready to appoint a point person for Beijing to deal with?
Well, I think both sides are looking to see if there is an off-ramp, right? Like last week, we backed ourselves into a trade embargo between the two world's largest economies. So there has to be a way to resolve this at some sort of political level. And I think appointing someone seems like a reasonable way forward. But that said, the president has said that he wants to negotiate directly with Xi Jinping. So there's going to be some negotiations behind the scenes to see if they want to back off that approach or if they're willing to delegate one level down.
Do you think the likely scenario here is that there's a call and then they appoint someone, and then who do you think that individual is going to be?
Well, of the constellations of actors who it could be Secretary Bessent, could be Secretary Letnick, it could be someone like Jameson Greer. But I do think that in the last week or two, we've seen Bessent really take the lead publicly in terms of advancing some of the president's trade agenda points. So he would be a likely interlocutor with the Chinese.
When it comes to the other deals, and speaking of China, the secretary has insinuated he wants to shore up some of these other deals and then confront China together. Is that the kind of concessions they're looking for when they talk to Japan or the European Union or Vietnam?
Well, I think, like, taking a step back, this is existential from the perspective of the administration, that we are overly reliant on China, that the Western world has become overly reliant on China. And so it makes sense from their perspective to look at building alliances with other countries where they adopt some of the same measures that the United States does. And even from the perspective of third markets, if the United States and China are in this posture of not trading with one another, those goods are going to go somewhere else. They're going to flood other markets. And so I think that's what they're trying to get to. But the question for me is, some of these Asian nations in particular, are they going to pick sides? Are they going to be willing to put up some of these barriers on China or not?
So when it comes to other investigations the administration is launching, we learned this week there is an investigation, a Section 232 on pharmaceuticals, on semiconductors, that was launched April 1st. Why did we learn about it this week?
Yeah, I have to say, I spent 10 years in government and have never heard of a secret 232, but that's effectively what we saw happen. Well, there is no legal obligation to notify the public that an investigation has been launched. There is a legal obligation to give the public an opportunity to comment. But some of this may have just been, there's so much going on that they failed to alert the public. Could be that they were just investigating and sort of got out over their skis, but for whatever reason, it's neither here nor there. We're in an active investigation, and the administration has 270 days to complete those investigations.
They have 270. How quickly can they wrap it up?
As soon as almost humanly possible. So that comment period is, I think it's going to be May 7th when all those comments are due. They could potentially announce the results as soon as May 8th. Now, I don't think it will be that soon. I think they'll give themselves another month to digest some of the comments. But we've heard Secretary Letnick say that within a month or two, we're likely to see some of those measures.
A couple of names in the mix right now. Who do you think's running the show at the moment?
I think Donald Trump. I think President Trump is running the show. He has always been his own trade advisor. But of the economic advisors who seem to be in the mix, Secretary Bessent, Secretary Letnick, Jamieson Greer.
Does it surprise you that the Treasury Secretary has almost made a U-turn when it comes to these negotiations in the past 2 weeks? When I spoke to him after what Trump called Liberation Day, he said he wasn't part of the negotiations. He then clarified to me this week he meant he wasn't in charge or a part of the negotiations regarding the tariff rates on that big chart. How big of a disagreement was those reciprocal tariffs?
Yeah, in Trump 1, it was very clear that we had different advisors on different spectrums. So we had the free traders, we had the protectionists. In Trump 2, the difference between them is much smaller, right? So I think you have advisors who might have different perspectives, but their view is largely rowing in the same direction. So I don't see the same break in the same way, but I do agree that Secretary Bessent is much more active now in terms of driving some of the agenda, at least in terms of the public voice of the administration.
And this is certainly something market participants wanted to see, including Jamie Dimon at JP Morgan, who basically said that in a Financial Times interview earlier this week.
He said he's an adult in the room and he likes that he's now taking a louder voice when it comes to these trade negotiations and thinks he should be the point person. Neil Dutta has talked about this, the ascent of Bessent, and he said Trump has cracked a lot of eggs and now it's up to the secretary to make an omelet. So Wall Street is definitely feeling more comfortable that the Treasury Secretary is the one who's a bit more careful with his words when it comes to these negotiations. He's in driving seat.
Kellyanne, it's good to see you. Thanks for dropping by. Thank you. The former senior Trump trade advisor, Kellyanne Shaw there. The president breaking some more eggs this morning with this headline on the chairman of the Federal Reserve, Jay Powell. Powell's termination cannot come fast enough. Those comments dropping in the last hour.
Parsing through these words, it's confusing. Does he mean the termination of the end of his term, or actually, I will do what I can to try to terminate this individual from that job? His term is up May 2026. Scott Bessent said, nothing to worry about here. We will start interviewing candidates in the fall, and we have some names that we're thinking about constantly in these conversations he has with the president. So at the moment, I'm going to go with what Bessent said.
More reaction to those headlines in just a moment. Equity futures on the S&P positive by 0.4%. Up next, Mohammed Al-Erin of Queen's College, Cambridge, Michael Zezas of Morgan Stanley. Will catch up with Alicia Reese of Wedbush and Jean Bavin of BlackRock. From New York, this is Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
2000 post-Napster, generally everybody wrote off the recorded music industry, including the investment community. And I didn't mind that chapter because then I got left alone. And actually, I think out of that period, we started to create better art because the pressure wasn't on from the technology to be the most powerful chapter. And then iTunes came in, and iTunes, to Apple's credit, did have a boutique taste mentality about the store, which meant that I think they understood. I can tell you from that period that the artists that came through were of a very high quality because it was encouraged to be boutique. Now, ironically, this chapter has made us more money times 5 than the iTunes chapter and the post-Napster chapter. But an algorithm tells you what you want, not what you might like. And there's a difference between what you want, but with streaming, the downside is you have incredible penetration, and we have hundreds of millions of people around the world. And so that has been very lucrative as a business.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
I'm concerned that you might have a freezing in the real economy here. The risk is real, and I think it's happening right now.
It really doesn't seem like there's any sort of catalyst that is going to change that narrative very easily soon.
The baseline is that we don't get a deep, lasting recession in the U.S.
The actual brunt of all of this, is likely going to be seen in the data in the early summer, even midsummer.
You got an economy that's probably in recession today, but I think as you get into the back half of the year, things can really evolve.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance starts right now with equity futures still elevated by 0.5% on the S&P 500. On the Nasdaq 100 up by 0.7 as the president stresses great progress has been made in talks with the Japanese over trade. Coming up later on this morning, you'll get jobless claims, another read on the labour market at 8:30 Eastern Time, and an ECB rate decision at 8:15, followed by a news conference at 8:45. The president of the United States with some thoughts on the ECB and the Federal Reserve this morning. Why is the ECB cutting interest rates and the Federal Reserve isn't? That's a question he's got, and he stresses the following. The Powell's termination cannot come fast enough. That line from the president on social media in just the last hour.
It's the most important line. It's the line that's getting the most questions. Is Trump talking about Powell's end of term in May 2026, or is he talking about doing something else, trying to remove Jay Powell from his post, which Powell said would be illegal and he has no plans on leaving? It is not clear what the president meant when it comes to that term termination, and so far, Jonathan, we have not gotten a response from the White House.
Well, the chairman quoted Ferris Bueller just yesterday in an address at the Economic Club of Chicago, saying life moves pretty fast. For the time being, we're still well positioned to wait for greater clarity before considering any adjustments to our policy stance. The Fed chair's not blinking here. hasn't really blinked at all in the past few weeks, and I think he doubled down on that in yesterday's speech.
And I also think he doubled down on the fact that these tariffs, he was talking about they're even higher than what their base case was, or their highest case scenario. I thought it was interesting, Jonathan, that he quoted Ferris Bueller, because there is a famous scene in Ferris Bueller when the teacher is asking about tariffs and the economic calamity it caused. It's that Bueller moment. And I think he quoted Ferris Bueller, a different part of the movie, but my head went straight to that scene.
You can ask him if that was deliberate or not the next time you see the Fed chair. Big hour coming up. In just a moment, we'll catch up with Mohammed Al-Erin of Queen's College, Cambridge, on America's uncomfortable tariff journey. Mike Zezas of Morgan Stanley as President Trump signals progress on Japan trade talks. And Jean Bavin of BlackRock as Fed Chair Jay Powell stays on the sidelines. We begin this hour with stocks higher as the President signals positive US-Japan trade talks. Mohammed Al-Erin of Queen's College, Cambridge, writing, the US has taken its economy and those of other countries on an uncomfortable journey to an uncertain destination. This will severely test the financial system and America's global standing. Mohammed joins us now for more. Mohammed, looking forward to spending the next 2 hours with you. Good morning.
Good morning. Thank you, John.
Want your reaction to this headline here from the President in the last hour. So out on Truth social media platform, the President's following maybe some of the ECB commentary this morning, expectations that they'll reduce interest rates, and complaining, why isn't the Federal Reserve doing the same thing? And he ends this post with this line here, Mohammed, Powell's termination cannot come fast enough. Now, the debate we've had around the table is, how do you interpret that line? Is that someone waiting for the expiration of a term that takes place in May of next year, or someone who's thinking about doing things sooner?
So only President Trump knows what that means, but it should come as no surprise. We know that President Trump has been frustrated at the absence of interest rate cuts. I suspect he got very angry when he heard Chair Powell yesterday. Chair Powell really put all the blame on tariffs, gave no possibility to the better outcome, zero, give it zero possibility. And then there's one thing you have to remember. I know that the conventional wisdom is that this is an attack on the independence of the Fed. There is another way of looking at this, which is this Fed has sacrificed people in the past. If you remember, the president of the Dallas Fed, the president of the Boston Fed, the vice chair were sacrificed ahead of Congress looking into allegations of insider trading. If you remember, the potential side was sacrificed to protect the monetary policy side. And it wouldn't surprise me if President Trump is pushing on this, because there's a real question for Chair Powell. Should he step down to preserve the independence of the Fed? Because otherwise, the Fed will be the subject of a lot of attacks going forward.
If he did step down, would that call into question even more the independence of the Federal Reserve? What's the optimal outcome here?
So this is a judgment that has to be made, and has to be made by Chair Powell. There are credible candidates. Kevin Walsh, for example. The markets would be very comfortable with Kevin Walsh as the Fed chair. He has tremendous experience. He understands the markets. He understands economics. He has expertise. So, you know, I could see a scenario in which what Secretary Bassett said before the election plays out, where they pre-announce Kevin as the next chair, and then that puts tremendous pressure, and then Chair Powell has to make a very difficult decision.
Let's say that happens. And I know that's not your base case right now. You can tell us if it is, but it hasn't been before. Let's say it happens, though. How do you think the market would respond to that?
So I think the market would look at Kevin Walsh and think he's a very credible Fed chair. And I think the market would rather have a credible Fed chair that's not in continuous conflict with the White House than being in continuous conflict with the White House. The Harvard example is an illustration of what can happen. You can suddenly have all sorts of other things questioned about the Fed if it's in direct conflict with the White House.
Isn't this conversation alone putting in question the independence of the Fed? You're talking about scenarios where we could basically get around the White House to placate the president.
But we've seen that. Scenarios where they've gone around to Congress to placate the Congress. We've seen a situation where in the beginning they sacrificed the prudential side. Michael Barr was the vice chair, and he stepped down. So I don't think this is much a structural break, but I do think there's a very delicate judgment, Anne-Marie, here, very delicate, and I'm glad I don't have to make it.
Well, it almost sounds like you agree with the president in this sense. His termination cannot come fast enough, meaning when Powell's out of the job, it cannot be soon enough. It sounds like you agree with that.
So the word termination is a very strong word, right? That word, I must say, I looked at it and I thought, wow, that's a really strong word. But we do know that in a year's time, Chair Powell will step down. We know that. We know that he's not going for a third term. We know he's not going to get a third term. So, that issue is out there. We also know the president is really frustrated about interest rates not being cut. And I go back, yesterday's comments by Chair Powell, which he went well beyond what he's said in the past, were like a red rag to the White House.
You've been critical of the Federal Reserve before. You've referenced this address a couple of times now. What stood out for you yesterday? Where do you think the chairman went wrong?
So actually, I think the chairman yesterday was less political than he normally is. I do think that we all have to give the possibility of the good scenario. The market certainly does. You heard me say the market is 50-50 as to which of the two outcomes in the destination is going to play out. Is this going to be a Jimmy Carter moment with prolonged stagflation? Or is this going to be a Margaret Thatcher, Ronald Reagan moment where you rewire not just the domestic economies, but you rewire the global economy?
Isn't the Fed chair basically acknowledging that by saying we've got to wait for more clarity before we can decide what we need to do?
Yes, but he went much further. I mean, I have all that. He certainly said we have to wait for greater clarity, but he kept on pushing on the challenges to dual mandate. He kept on pushing that inflation may be persistent. He hasn't said that in the past. 2 meetings ago, he reintroduced transitory. 2 meetings ago, he reintroduced transitory when talking about tariffs. And then last meeting, he walked it back, and now he's gone one step further and made a very strong statement.
So let's talk about the optimal outcome. What does it look like in the months to come?
I think I am in the same boat that everybody else is, saying this is a really highly uncertain time. I think this is an uncertain journey to an uncertain destination. And the market has been swinging one way and the other. You said it this morning. Depending on the tariff news, it's either excitement or fear.
Yesterday, we did also hear Jay Powell talk out the Smoot-Hawley levies of the 1930s, 95 years ago. And he said there isn't a modern experience for how to think about this. Do you agree with him, or can you draw some modern experiences to deal with this time right now?
No, it's hard. I mean, by the way, that was a strong statement as well, something that he hasn't gone anywhere near before.
And that was the Ferris Bueller scene I was alluding to earlier.
Correct. And I remember that scene that he should have referred to in the movie. No, we haven't had this before. This is an attempt to rewire the global economy. And we haven't had this in an integrated, globalized economy.
Are you surprised by how different Powell sounds from Waller?
Yes, I do. I'm surprised how different Waller sounds from Waller a year ago.
Think he's running?
It's been quite a transformation, let's put it this way.
Do you know who did do a good job yesterday? Raghu Rajan.
Oh, he was great.
He was absolutely fantastic. And he asked this question, I'm pleased he asked it. He talked about the difference of a challenge to the cycle and a challenge to the system. And you and I have reflected on this too. The challenge to the system here, how are you thinking about that challenge at the moment?
So first of all, let me say Raghu was great because not only did he keep the flow going, but for those who are not very familiar with economics, he explained why he was asking the questions, and he did it really well. We've put it slightly differently, is that normally advanced economies live in cyclical space and developing countries live in structural space. Now suddenly we have advanced economies living in structural space, so the boundaries to the cyclical fluctuations are no longer holding, or they are much wider than they were before. So we have a whole range of potential outcome. I love the United earnings call when they came out with two scenarios. It's a bimodal world. Amex today came out with a huge qualifier saying it's subject to the global macroeconomy. So companies are not only thinking internally about a range of outcomes, they're expressing it in their earnings calls.
Asset allocators need to do the same exercise. They need to work out what the future looks like. And Rajan talked about a change in US philosophy. So in the post-war system, as you know better than most, US assets are at the very heart of it. And the interpretation of this administration appears to be that their responsibilities are a net burden and not a net benefit. And they're trying to rebalance that. They look at the FX so-called distortions, that's what Stephen Myron called them, and they don't look at the benefits that come from this structural bid for US assets that deliver lower interest rates than maybe they'd otherwise get. What are the dangers of trying to rebalance that over the period of, say, 3.5 years?
So whether it is the US, whether it is the UK with the EU, this integration does two things to your balance sheet. It increases the gains and increases the potential losses. So you now operate at a higher level of both. And if you don't manage the potential losses, then people will focus on that and forget about the gains. We saw that in the UK with Brexit. So I think the more integrated economies come, the more you have to manage the downside risks. I say this because AI is really critical in this. We've got to manage the downside risk to exploit the enormous benefits that come from that.
Mohammed, you said when you look at developing economies, it's structural, and like the United States, we're cyclical. Is everyone just viewing this moment wrong? Should we be thinking about a developing economy when looking at what is going on right now in U.S. in terms of policy?
Well, some have tried to make that parallel when saying it's highly unusual to see the U.S. having higher interest rates and a weaker dollar. That happens in the developing world. That doesn't happen in advanced economies. I think that's a step too far. I think what we're seeing is a portfolio reallocation from an overweight to the U.S. to more balanced globally. That is what we're seeing. And I thought Rick Reeder yesterday on the show was great with that.
Mohammed, you're going to be sticking with us, and pleased to say we'll be talking about the Federal Reserve and the ECB, that ECB rate decision, about an hour from now. Equity futures on the S&P 500 still just about positive by 0.3%, but rolling over well off session highs. That's the story in the equity market. Let's get you an update on our top stories elsewhere. Here is your Bloomberg brief. President Trump with strong remarks for Fed Chair Jay Powell this morning, posting on Truth Social that Powell is too late and wrong, calling on the Fed to cut interest rates. Trump adding that Powell's termination cannot come fast enough. Elsewhere, the president sharing on Truth Social that trade talks with Japanese officials have led to, quote, big progress. A deal has not been reached, but preparations are underway for a second round of talks later this month. And finally, Eli Lilly shares soaring after its latest weight loss pill met its efficacy goals, showing promise it could become the first approved oral GLP-1 treatment. Lilly saying trial users lost an average of 16 pounds at the highest dose. That stock is up by 13.5%. That right there is your Bloomberg brief. Up next on a program, Trump versus Powell.
People can say whatever they want. That's fine. That's not a problem. But we will do what we do strictly without consideration of political or any other extraneous factors. We're never going to be influenced by any political pressure.
The political pressure is climbing. Mike Zezas of Morgan Stanley joins us next for more. Live from New York City this morning. Good morning.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now. We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Krishna Gu at Evercore, just nailing it. This line right here. If you like the tariff debacle in markets, you'd love the loss of Fed independence trade. Equity futures right now in the S&P. We'll let that one breathe a little bit. Positive by 1/3%. On the NASDAQ, up by 0.5. Under surveillance this morning, Trump versus Powell.
Our independence is a matter of law. Fed independence has pretty broad support across both political parties. Generally speaking, Fed independence is very widely understood and supported in Washington, in Congress, where it really matters. People can say whatever they want. That's fine. That's not a problem. But we will do what we do strictly without consideration of political or any other extraneous factors. We're never going to be influenced by any political pressure.
So here's the latest this morning. President Trump with strong remarks for Fed Chair Jay Powell this morning, posting on Truth Social that Powell is too late and wrong, calling on the Fed to cut interest rates. Trump adding that Powell's termination cannot come fast enough. Bloomberg's Tyler Kendall joins us now for the latest. Tyler, what do you make of that one?
Yeah, hey, John. Well, while President Trump has long been critical of Jerome Powell, this does appear to be an escalation. Of course, big interpretation questions, though. Is President Trump pointing to the end of Powell's term as chair in 2026, or is he threatening to fire the Fed chair altogether just one day after Powell said that the central bank would have less flexibility to cushion the economy amid tariff fallout, and also that he thinks market volatility is understandable because there's just so much uncertainty here when it comes to the tariff plans. Now, President Trump has long suggested that his tariff policy would go hand in hand, as he says, with lower interest rates. And we should keep in mind that up to this point, senior administration officials have largely brushed aside President Trump's prior criticism of Jerome Powell, saying that it's just his opinion and that they do respect the Fed's independence. But we'll have to see if we hear any stronger stances from administration officials today, particularly after Treasury Secretary Scott Bessent told Amory earlier this week that he thinks monetary policy is a jewel box that needs to be preserved, as he said. So really some big questions going forward. And you had mentioned earlier in the program that Bessent actually was the one that had floated the idea of potentially a shadow Fed chair on the campaign trail. Powell was asked about that back in December, 1 month before Trump took office. And he said that he didn't really think that was an option on the table, and also that he doesn't think President Trump has the legal authority to fire him. John, President Trump previously has said that he would let Powell serve out his term. But of course, big questions here in Washington about the future of independent federal regulators, particularly after last month, 2 FTC commissioners were fired, they say, without cause.
Tyler, appreciate the update. Tyler Kendall in the nation's capital. To extend the conversation, joining us now, Mike Zezas of Morgan Stanley. Mike, welcome to the program, sir. Not the news I imagine you thought you'd wake up to. What do you make of that last line by the president? The termination can't come soon enough.
Yeah, I mean, I can't parse precisely what he might have been talking about there, but I mean, listen, I think the issue of concern here for investors is one of whether or not you feel like you own too many U.S. dollar-denominated assets, and there does appear to be kind of this rebalancing trade going on where kind of the world was overweight this, and for very natural reasons, and there's probably some risk mitigation going on here. And so to the extent you see statements like this, or maybe you're concerned with the case in front of the Supreme Court right now, challenging whether or not President Trump has the authority to fire independent agency heads, you know, all of it suggests that there might still be some rebalancing, kind of getting more to a neutral stance with regard to global U.S. dollar-dominated assets. It's the type of thing that we think can still create some near-term U.S. dollar weakness.
When it comes to this potential that this is more than just Trump waiting out Powell's term and actually he wants to do something about it, if that were to happen, what would that mean for the dollar, for treasuries as these safe haven assets?
Yeah, I mean, listen, Powell's statement yesterday about broad legal authority, broad legal protections, that seems to be the consensus, and I'm not a legal expert, but that seems to be the consensus, and it seems to be pretty stable. So any action against that would sort of raise questions. Whether or not it's succeeded, I think you introduce that question into the market. Then if you already have a basis where investors are kind of overweight or over-indexed to U.S. dollar assets, then more of this risk mitigation trade that you're seeing probably continues.
So, Mike, let me just get more clarity from you on this. You said rebalancing to a neutral stance. How far along this journey are we, and what does the destination look like?
Yeah, I mean, I don't have a precise answer to that question because I think we're still collecting fund flow data and asset allocation data. I just know we're not all the way there, right? So, again, I think this is really about what you sort of assess the probability of institutional controls breaking down are. And I wouldn't say it's our central case that we're going to have a problem with institutional independence in the U.S., but statements like these, the existence of this case in front of the Supreme Court obviously raised the question further. And so even if you're only partway through that trade, there can be more U.S. dollar weakness without there having to be an expression from investors of a general loss of confidence.
Mike, this builds on the conversation we started having last week in a much more material way when we saw Treasury yields higher by 50 basis points and the dollar weaker. And we asked the question coming into this week, what's the alternative? Where can you find the depth, the liquidity, the predictable issuer with dependable, credible institutions around it? What is the alternative?
Yeah, I mean, let's say your near-term alternatives are the yen's the most obvious one. Euro would kind of be second there. They are insufficient alternatives to the point that you just made. But this is why I think for the moment we can avoid this kind of more existential question and look at this as more of a rebalancing trade and say there's still potentially strength to go in those two currencies relative to the dollar.
It seems that another alternative has been gold. Gold has defied every single correlation. Risk on, gold higher. Risk off, gold higher. Weak dollar, strong dollar, gold higher. And you get a bit of profit taking, but gold continues to go from record to record. How long can this process go on?
Yeah, I mean, I don't think we have a high conviction view there, but to your point, I mean, there is this sort of, whether or not you want to view it as a kind of fundamental pressure or kind of a mix of fundamental and technical pressures, which is the way I would describe it. It is sort of a pressure that sort of leads to demand for a broad array of assets. And again, I think like the yen, the euro, those are places you might look. Is there still positive pressure going into gold? Very likely, but I wouldn't say that we have as high a conviction there.
Well, every day it seems like gold is, having this new record high. We had one just yesterday. Is that a place just to hide it out if you're unsure what to do in this moment, Mike?
I think for some investors it is. I'm sure we hear from some clients who are more sort of, true believers in this as store of value. But at this point in the debate, you don't necessarily need to pick whether or not this is just kind of a flight to safety or whether or not you have a more secular case for the breakdown of the U.S. dollar. So again, I think we're kind of in the zone of this trade right now where the uncertainty introduced by the fact that we're even having this conversation is plus the kind of let's call it the positioning that's been heavy for U.S. dollar-denominated assets, kind of allows you to not necessarily have to choose whether or not this is a technical trade or a fundamental trade. There's just more flow in the direction away from dollars.
Mike, appreciate your view. As always, Mike Zuzas there of Morgan Stanley. Gold coming up in that conversation. What a run it's had. So far year-to-date higher by 27%. And this rally, Mohammed, we've talked about this a few times, predates this trade tension. This has been building for quite a while.
It has, and it's gained a lot of momentum. And a lot of people have tried to fade it, only to see gold go higher and higher. I do think that central banks, foreign central banks, at the margin, are looking to diversify away from the dollar. And they're doing it slowly, and gold has been a recipient of this of flows.
Gold just pulling away from all-time highs. We're down about 0.5% this morning. Up next on the program, we'll catch up with Alicia Reese of Wedbush, previewing Netflix earnings. Those results coming out after the closing bell, and we'll have more on these comments from the Federal Reserve, or rather at the Federal Reserve, from the President of the United States. Powell's termination cannot come fast enough. That conversation continues from New York. This is Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
2 hours away from the opening bell, equity futures positive here by 0.5% on the Nasdaq, elevated as well, up by 0.7. Encouraging words from the president on trade. Not so much on Chairman Powell. We'll get to that in just a moment. Some moves to look for. Taiwan Semi, TSMC, projecting confidence, keeping its growth outlook for 2025. Still looking for growth in the mid 20% for the year ahead. The CEO saying demand has remained resilient. The stock is up by about 3%. I want to talk about Ford, down about a third since the high of the last summer. It's positive this morning by 0.2%, threatening to raise prices. We anticipate the need to make vehicle pricing adjustments in the future, which is expected to happen with May production. Important move from them.
I think it's an important move, and I think it's a really important signal and significant because Ford builds 80% of the autos that they sell in the United States in U.S. factories. So Ford is saying, we have to come out and raise prices because it's so uncertain and we're going to be hit with some tariffs regardless, even though we're lobbying the White House. What does that mean for the others, like GM?
That's the latest on the autos. On our radar this morning, our top story, life moving pretty fast for Fed Chair Jay Powell.
As that great Chicagoan Ferris Bueller once noted, life moves pretty fast. For the time being, we are well positioned to wait for greater clarity before considering any adjustments to our policy stance.
It's moving fast this morning. President Trump with these remarks, posting on Truth Social that Powell is too late and wrong, calling on the Fed to cut interest rates. Trump adding that Powell's termination cannot come fast enough.
Big question if he means the termination, the end of his term, May 26th, or the termination like he's going to do something about it. So I think we're waiting on some clarity. We have to, depending on what the president, I'm sure he's going to be asked about this today. Neil Dutta nailed it yesterday. He probably picked up on what Powell was talking about when it comes to tariffs, how he kept coming back to tariffs, how it's on the high end of the Fed analysis, and quote tweeted a Trump tweet from 2019 where Trump said, my only question is who is our bigger enemy, Jay Powell or Chairman Xi? And he wrote coming soon, question mark, meaning is Trump going to come into this fight and push back on Jay Powell? Well, he did this morning.
We mentioned this note from Chris Nagua over at Evercore, so let's go back to that note. If you like the tariff debacle in markets, you'd love the loss of Fed independence trade. Mohammed, can you just reflect on that a little bit? What would that look like if we did lose faith, confidence in Federal Reserve independence?
I want to say if, because I'm looking at the bond market right now, it hasn't moved. It has not moved. Yields were up 2 to 3 basis points. Yields are up 2 to 3 basis points. So the bond market has completely brushed aside this issue. But if, I say if, the people will go back to the 70s and will remember what happened then, and there would be much bigger inflation premium in markets across the board. But I want to say if, because with the exception of the word termination, which is a very strong word,
true,
nothing is surprising in that post.
We've said it repeatedly this morning, it's difficult to know how to interpret that word. Is that word basically referring to the fact that his term expires in May next year, or does it mean he's willing to go much further, do something far more drastic?
And I think that ambiguity is purposeful. I think the president is trying to have this debate and maybe have individuals that are renowned, like Mohamed El-Erian, come on and say, actually, maybe for the best of Fed independence, maybe Jay Powell should even consider stepping down. He is starting a debate now by just the use of this one word, and I think he knows what he's doing.
Well, let's explore the if. Let's explore that a little bit further. How do you think the international community, international investors would view that move? How would they treat treasuries and dollar-denominated assets if that happened?
What is the if? The if is really important.
If they fired him.
Without announcing the replacement immediately, who is credible like a Kevin Walsh?
Oh, you think the replacement's just as important here?
Oh, absolutely. You cannot replace something with nothing. Britain learned this during Brexit. We're learning this during the tariff thing, is if you don't have something credible to replace what you are bringing down.
But to extend it, Mohammed, because this is important, once you've fired one, it would open the possibility that the next one could be fired too, which opens the idea that they're just going to do whatever the president would like them to do. I think that's the issue really at play here.
It is, but it's the counterfactual. What if the Fed ends up in a Harvard situation, whereby every day there's a new attack coming from a different angle? So this is why I say this is a really difficult judgment. You've got to sort of guess what the counterfactual is likely to be, and then decide if your objective, which all our objectives should be to preserve the independence and integrity of the Fed, what's the better outcome?
Yeah, but the precedent this sets could be catastrophic. To John's point, it could be a domino effect where every single person can maybe get fired.
True. Alternatively, they could find different ways of eroding permanently and structurally the independence of the Fed. So this is a really uncertain time.
But to the rest of the world, doesn't it just look like the Fed chair now just does the president's bidding, and then we look like Russia or any other economy where there's that relationship?
That is certainly the risk. And I'm just saying, I said during the break, I love this quote from Justin Fox, that uncertainty has never felt this uncertain. And that's the world we're living in, sort of uncertainty being even more uncertain than uncertainty normally is.
It's what the last couple of weeks has felt like, that's for sure. This story is going to dominate the conversation this morning, no doubt. I just wanted to fit this in as well, that the president's also saying his administration made, quote, big progress on talks with the Japanese so far this week. The lead negotiator saying preparations are underway for a second round of talks later this month.
So these talks with the Japanese are being closely watched. It's been insinuated by the administration they could be one of these first countries to get a deal. Scott Besson told me the first mover advantage is going to be that individual. Well, it does feel like they have the first mover advantage. They're the only ones that have gotten a sit down with the president himself. But no deal yet, Jonathan. They still have another negotiation to go through. My question is, they only have 90 days. We're talking about July 8th, just after July 4th and that holiday weekend. Can they get even a dozen of these deals done? Usually trade deals take years to hammer out.
Clock is ticking, and certain companies are stuck between a rock and a hard place. The Infosys CEO, Jensen Huang, visiting Beijing at the invitation of the China Council for the Promotion of International Trade. His visit coming as Trump administration slaps China export curbs on NVIDIA's H20 chip in the last 24 hours. Mohammed, we've had this conversation in the past. Choosing between one and the other. You wrote a piece a number of years ago. I forget the precise phrase you used, but it was the so-called fence sitters. Certain countries that wanted the trade relationship with China but wanted the security umbrella from the United States. How sustainable is that now?
It is much less sustainable. It's much more expensive. I called it the dual option model, that you have an option on the U.S. for national security, you have an option on China for economic prosperity, and the cost of that option was extremely low. Now the cost of that option is going up, and most countries are terrified of having to make a choice between the two. Some countries will remain swing states. Brazil, India, Saudi Arabia, UAE, they have something special that allows them to be swing states, that allows them to maintain that dual option at a low price. But others, Philippines, Japan, etc., will find it much harder.
When it comes to things like chips, though, you see the Trump administration doubling down even further than the Biden administration did when it comes to these export control and chips. This H20 was produced and manufactured just so they could go to China. But you're going to find bipartisan support for things like this. De-risking from China, making sure they don't have access to high technology. But I have to think, with Jensen Huang going over to Beijing, this feels like Tim Cook and what he does and goes over to Beijing. And when China comes out and says, we want a point person for trade, I wonder if it's these diplomats, these corporate executives.
You've got to think about what she's doing. And yes, corporate America have been great diplomats for the objectives of the Chinese over the last few years, and that's a very separate story. And the administration, quite rightly, has been unhappy with them on that front repeatedly. The Chinese are also doing their own diplomacy. She's been visiting various countries, speaking to various nations, Malaysia, Vietnam in the last week. Mohammed, as you know, this president would like our trading partners, allies, the likes of the Europeans, to put the walls up for the Chinese. They'd like the Vietnamese to do the same. Do you think that's possible in the year to come?
It is possible. I mean, there's two big games of chicken going on right now. One we've already talked about, the administration versus the Fed, and the other one's US versus China. And US versus China visibly is a tariff. Behind the scenes is trying to get a coalition of countries against the other country. So you've seen this in China. They are doing a lot of diplomacy, quiet diplomacy, trying to say, we are the reliable, we are the dependable superpower here. Let's have more trade links. Let's talk about payments links. And then you have the US saying, let's unite all these countries, starting with the 17 we're talking to now, not only to ensure low tariffs, but to ensure that they put tariffs on China as a way to protect themselves from Chinese dumping. So you have, it's fascinating to me that you have a very visible war going on, tariffs, and then you have a less visible war going on, which is for the other countries.
The Europeans certainly stuck in the middle here because they'd have to eat the overcapacity coming out of China if the wars stay up here in the United States. More on the ECB later on. That decision is about 35 minutes away from the European Central Bank. We need to talk about earnings later as well. Netflix reporting earnings after the closing bell, with analysts expecting it to weather the macroeconomic climate better than competitors. Alicia Reese of Wedbush writing, while massive subscriber growth was the primary driver in 2024, we expect price increases to drive revenue growth in 25 and the ad tier to drive revenue higher in 2026. Alicia joins us now for more. Alicia, welcome to the program. There is some pressure on consumers. Sentiment is absolutely cratered. Alicia, as we saw in retail sales, though, they are still spending, but some of that spending is about fears of higher prices in the future. What do you think this will mean for discretionary growth on things like Netflix?
Well, I think for now, the key driver is content. There certainly comes a time where people will cull their budgets and stay home, skip a vacation, maybe buy a few less new items. And what they'll do instead is stay home and watch content on Netflix and other streaming services. And so whoever has the best content gets the most eyeballs, and whoever gets the most eyeballs can get the most advertising dollars. Netflix doesn't have a lot of people yet on their advertising tier, but they're certainly trying to grow that, and they will over time. But still, this year, they are not going to give subscriber numbers, and what they're going to do instead of giving subscriber numbers is, they increase their tier pricing, and so they're going to be able to give quite a bit of revenue growth still.
I understand.
On top of that, and it's going to be really positive for them.
Alicia, I understand people may stay home if they're worried about going out and spending in this time of uncertainty and tariffs and potentially prices going up, but advertisers, are they going to have the money in this uncertain environment to want to spend?
They're certainly going to cull their budgets and pull back pretty significantly. So they have to be more accurate. So they're going to want to move a lot of advertising dollars from linear TV that is less targeted to connected TV that is highly targeted, on par with or better than social media targeting. Connected TV has significantly more targeting capabilities, and that's really where the eyeballs are, especially in an environment where, people are staying home a bit more. And as sports continue to shift towards connected TV from linear channels. So, advertisers are just going to be a little pickier about where they put their dollars, and they know people are on Netflix. So that should insulate Netflix to a degree.
So, Alicia, I hear you say that we're going to get an acceleration of a secular move. So how does linear TV respond?
So linear TV has to keep sports as much as possible. What Disney's doing is taking ESPN and just creating a lot of different outlets for it. And
I think we lost that connection there with Alicia Reese of Wedbush, looking ahead to Netflix earnings after the closing bout. Exciting stuff, Anne-Marie.
Exciting
a bit
stuff,
later.
I guess, when it comes to sporting and whether or not you get that on Netflix. I've been thinking about this when it comes to Netflix earnings, because the Wall Street Journal recently had a piece saying that they aim for $1 trillion market capitalization. How do you do that at a time when people are uncertain. Are they going to be spending more? If you don't already have a Netflix subscription, why are you going to sign up now when you see poll after survey that people might be holding back?
How many zombie accounts do they have? Just people who are signed up, still paying, but never watch the thing?
Oh, I don't know about that.
I asked that question because I'm one of them. I've got one of those zombie accounts.
Well, how many people are some of those password cheaters? Because I'm one of them.
I know you're one of those too. They're clamping down on that, as you know.
I'm stunned between the two of you.
I want to know what Netflix version of White Lotus is. What's their hot new... Are you watching anything?
Someone else can tell you that.
I am, but why don't you take his account, which he's not using, and you don't have to see... I mean...
You're right.
What, and I keep paying?
Yeah.
No, Mohammed, that doesn't make sense.
You're paying anyway.
No, and the first thing that will go when things really start to bite is the Netflix account, which is why I ask how many zombie accounts are out there.
It's probably a bunch, I imagine.
I think a lot of people just have accounts and don't watch anything. Anyway, let's give you an update on stories elsewhere this morning. Here is your Bloomberg brief. Goldman Sachs looking at the worst-case scenario for US and China decoupling. US investors may be forced to sell around $800 billion of Chinese equities, and Chinese investors might need to offload $1.7 trillion of US financial assets. Elsewhere, New York Congresswoman Elise Stefanik is weighing a run for governor in her home state. Stefanik's allies confirming her interest in the race, with the Republican lawmaker increasingly outspoken in recent weeks with criticism of Governor Kathy Hochul. And finally in sports, the Champions League semi-final matchups are set. Arsenal taking on PSG after besting Real Madrid to reach their farthest in the tournament since 2009. Elsewhere, Barcelona facing Inter Milan, the next round kicking off on April 29th. And that right there is your Bloomberg brief. Up next, a hawkish Chair Powell.
Some people believe the Fed will intervene if the stock market plummets, the so-called Fed put. Are they correct?
I'm going to say no with an explanation.
That explanation up next. We'll catch up with Jean Bavard of BlackRock.
Behind the bright lights and adrenaline of pro sport is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I love the fact that you have, we say the cojones, but we can't say that in Bloomberg.
Maybe moxie?
Yeah, moxie. I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Billie Jean King.
Well, what should I learn? What should I do? I said, learn the business.
Jay Williams.
You're the asset, but how do you become the principal?
Paul Rabel.
We're going to be the league of digital, and that's why you're going to invest.
Adina Friedman.
I definitely am competitive.
David Rubenstein.
People don't come up to me on the street and say, let's talk about this private equity deal you did recently. Nobody does that. They say, let's talk about the team.
And so many more.
You need a clap?
No, I never.
Ready? Go.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Bloomberg has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
Equity futures just about positive this morning. We're up by 0.4% on the S&P, on the Nasdaq higher by 0.7. Under surveillance this morning, a hawkish Chair Powell.
Some people believe the Fed will intervene if the stock market plummets, the so-called Fed put. Are they correct?
I'm going to say no with an explanation. Markets are struggling with a lot of uncertainty, and that means volatility. But having said that, markets are functioning, conditional on being in such a challenging situation. Markets are doing what they're supposed to do.
So here's the latest this morning. Stocks are heading for a week of losses as Fed Chair Jay Powell pours freezing cold water over the so-called Fed put. Joining us now to discuss is Jean Bavin of BlackRock. Jean, good to see you, sir. Some reaction by the President of the United States earlier on this morning, which I'm sure you saw, complaining that the chairman had not cut interest rates, unlike the ECB, which is set to do in about 30 minutes' time, and saying at the end of his social media post this morning that Powell's termination cannot come fast enough. If clients asked you about that line this morning, what will you tell them?
Well, I spent a week in Europe last week, and I'm going to tell you that the discussion about like U.S. asset and how we should think about this environment is totally different than everything I've seen. And I think that kind of development in the context that is already one that investors are shaky, I think will require quite a bit of work to reassure. I think what I would say I would fall back to, I think there are immutable laws that are at play here. We're going to be bumping into them. We need to be ready for some chaos along the way, but we're going to be bumping into some pretty immutable laws, and I think that's what we need to get a handle on.
We've said repeatedly on this program this morning that we'd like clarity from the White House what termination actually means. Does it mean the expiration of the term, May next year, set to take place, or moving that forward and doing something more dramatic? But you've touched on something important. The erosion of trust in U.S. assets that we've seen. Some people have made the case that over the last week, all we saw was Treasury markets responding to the unwinding of trade, some hedge funds blowing up, and maybe it was nothing bigger than that. What do you think it was?
I think there's a broad story here, and if I had to say one word, I think it's debt. It's the large U.S. debt that is a big part of the story here. But I think what we've seen, we were of the view, we've discussed that before, that we were in an environment shaped by supply. I think the tariff discussion we're having here is very much an example of another supply shock that is leading Chairman Powell to be more hawkish than people expected, I guess. But there is a really real story of a supply shock that is putting pressure on rates to go up. So I think there was already pressure for long-term rates to go up. But you add on top of that, questions about tariffs that are really like, if you really are trying to decouple from the rest of the world quickly, that also means that you're cutting yourself out from a source of funding for your debt. And the debt is large, and I think this is the key thing that is driving here is that, the financiers of that debt, the people financing it, are looking at this differently now. And I think that's adding another kind of risk premium, if you will, in terms of long-term rates. And so that is the dynamic at play. It's not about one player. It's not about one official government selling or not. I think this is a broader kind of sentiment story.
So Jean, you told us about what you heard. You told us about the sentiment. How far are we in this rebalancing from the U.S. to the rest of the world?
I think we're pretty far. I mean, if the real intent of reducing current account deficit and surpluses and balancing these things, we're very far from that objective and decoupling. And in fact, I don't think that can happen very quickly. So to me, this is more that there's a very near-term kind of immutable kind of constraint that we're going to be bumping against, as I said before. And it's going to be materializing by rates going up, which will make the debt look very different for the government, I think, themselves. I think the biggest challenge for them is rates at 5% in 10-year changes completely the budget arithmetic going forward. And I think that will have to be confronted at some point. So that's why, I mean, no matter the intent, I think we're going to be stopped along the way. It's a many years process as opposed to a many months process.
That goes against a key objective from this administration, which is to keep rates much lower. They want to see it going lower to 4%. When it comes to things like who is dumping these assets, the Treasury Secretary didn't seem to think it was foreign governments. Do you think it's sovereigns?
As I said, I think this is a broader global reassessment and thinking. I think there is broad fundamental reasons for rates to go up, and then you get an events like we got last week, and it adds to this narrative. So I think it's difficult to pinpoint like a single source. I think this is broader. And then when these things happen, there's always other things that happen at the same time. So you get like the dynamic deleveraging in the market that gets triggered by this. So I don't think we'll ever pinpoint one, but I think we should take note that there is a sentiment story that is playing out.
So John, one of the things that is really debated right now among global macroeconomists is what is the beta of the rest of the world to U.S. growth? So some people feel that it's 0.5, others feel it's more than 1. Where would you put the beta, the growth beta of the rest of the world relative to the US for Europe and for developing countries?
I think there's a distinction between where this administration might want to go in many years from now and where we are right now. I don't think the world has changed materially yet. I mean, yes, the tone and everything has changed like drastically, and the uncertainty is as uncertain as we've ever seen it, as you said before. But right now, the fundamentals, where the U.S. is still very much as linked as it was, and I think we've seen it, right? When we've seen Liberation Day, we've seen the U.S. market tank. It's not like Europe has outperformed during those days or other markets. So the beta is still very much as strong as it was. Over time, it might change.
More than 1 or less than 1?
I think we're looking at something that looks like 1 right now. So I wouldn't take a big bet on either side, but I think it looks like it's very much correlated with.
Does that mean you can't take as big a bet for Europe against the United States and vice versa, if they're all in the same boat?
Yeah, so I think it's tempting to say U.S. is risky, so let's go elsewhere. But because of that beta, I think we're still in a world where all boats will be moving together. But there is one thing happening, though, is that in this environment, clients have always been having a home bias, right? It's easier to invest closer to home. I think that exacerbates that home bias that we have. So it's in this environment.
Your high conviction view is actually in the Treasury market. So shall we finish on that? Underweight Treasuries. Is it for all the reasons we've discussed or something missing?
We had on top of that the inflation story that is not resolved. It's actually being, fueled somewhat more with those measures. So we have been on the way to U.S. Treasury. This is the highest conviction we've been having for the last many months, even I would say many years. We're resetting to a higher rate environment. Everything we see confirms that, and the latest development, I think, add to that as well.
And the latest communication from Chairman Powell would reinforce it too. Jean Van of BlackRock. This Federal Reserve not in a rush to do anything anytime soon.
Rates on hold, quote, for the time being. It seemed like Chair Powell was not in a rush to even give the market a little bit of a Powell put, saying we're going to step in. He was leaning on the fact that the inflation story, they just don't know yet. Looking at the survey data, they just don't know how these tariffs are going to complicate price pressures.
The President of the United States watching the ECB of all things this morning. The European Central Bank set to cut interest rates in about 20 minutes' time. Widely expected to anyway. The President unhappy that the Chairman of the Federal Reserve is not considering doing the same thing. Big hour coming up. An ECB news conference just around the corner. Decision 20 minutes away. And we get some data at 8:30 Eastern Time when we have jobless claims in America. Up next on the program, Alex Altman of Barclays, Bloomberg's Lizzie Burden, Pooja Kumar of TD, and Lauren Goodwin of New York Life. And Mohammed sticking with us for another 60 minutes.
You have had a number of games overseas in recent years, and in fact, you opened the season going to the opening game in Brazil. So do you expect to do more overseas games, and is that a part of your strategy?
It is. We had 5 last year. We expect to have 8 this year, which will be the highest we've ever had. Our hope would be at some stage to get to 16 games in the next few years. We think we could do that. I think it's an indication of the popularity of our game. Every time we take our game to a new market, Brazil's a great example of it, the fans go crazy for it. They sold out the tickets in less than 90 minutes. People had a wonderful time. It was the talk of the town. And I think it will be the basis and the sort of the match that lights the excitement and the popularity of the game in that market, as well as what we're doing around the world. So we're very excited by it. It's just one element of that strategy. You need to have television. You need to have activity and participation in the sport, and flag football is a big part of that. So all of those factors, I think, are going to be what we think will be a very successful formula to be a global sport.
Do you ever envision having a team that's based overseas in Mexico City or in London?
Listen, we've talked an awful lot about it, and I think there are markets that could, without question, support an NFL franchise.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
What is the issue between the type of information that's being collected by investors and the marking issue that you're describing?
What mark-to-market assets do is it forces honesty into the situation. We're talking right after the DeepSeek model surprised everybody in its efficiency. It took hundreds of billions off of market caps because it legitimately raised concerns that maybe the future of AI was different. I guarantee you that if you look at other portfolios that aren't marked, they didn't move. If private assets are going to eat the world, as they say, with the equity market halving in the number of names, you come to a world that is increasingly an echo chamber. Imagine you have a firm that has some public assets and some private assets. If you see your public assets in AI going down by 20%, you're going to be thinking very, very deeply about what your private assets are worth differently than someone who just has the latter.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
There is real damage happening today, right now.
There's a lot of bad sentiment, and that's helped the market recover.
People are looking for some amount of clarity.
Markets are very jumpy and very uncertain these days.
The appetite for U.S. assets could be something that is a question.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The third hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures positive on the week so far, heading towards a week of losses. On the S&P at the moment, high by 0.5%, attempting to take a bite out of this weekly loss. The Nasdaq up by 0.8%. As the president says, talks are going well. We're making big progress with the Japanese. That's opening the door maybe to a trade deal before this 90-day pause expires. Coming up later on this morning, this hour, 8:30 Eastern Time, jobless claims just around the corner. Before we get there, an ECB rate decision, then a news conference 30 minutes later at 8:45. The president watching the ECB rate decision, unhappy that the ECB is expected to cut interest rates and this Federal Reserve isn't set to cut anytime soon. Complaining about the Fed chair and saying this at the very end, Powell's termination can't come fast enough.
A rare applause from the president when it comes to Europe and the ECB. A dose of uncertainty he throws in about the independence of the Fed, using the term termination. We need some clarity from this White House. Is the president talking about May of 2026 when Powell's term is up, or is he talking about actually trying to oust the Fed chair?
Based on the market reaction this morning, I'd say that most people are saying it's the former and not the latter. Mohammed, futures up, bond yields not doing much. We've barely blinked in the face of that statement.
Right. As I said, I don't think anything is surprising other than the word termination in that statement.
I've been surprised by a lot over the last 2 weeks.
That's true. We don't know. I will say the Secretary, Scott Bessent, Treasury Secretary, said to me earlier in the this week, I believe that monetary policy is a jewel box that has got to be preserved. There is context that you brought up earlier, Jonathan, that's really important to this moment. It's the fact that we do have two top officials that were ousted from independent agencies, and the Supreme Court came out and said, at this moment, we're going to let the president do that. And that is why investors have been concerned about the independence of the Fed. Can the president do what he did say to the FTC?
The ECB decision about 13 minutes away. Coming up this hour, we'll catch up with Alex Altman of Barclays as stocks look to snap a two-day losing streak. We'll speak to Pooja Kumar of TD Securities, reacting to the ECB rate decision, and Lauren Goodwin of New York Life on why it's a vital time to reconsider asset allocation. We begin this hour with stocks higher on rising optimism over trade talks. Alex Altman of Barclays writing, investors are very much at the mercy of the policy path of President Trump. And with that heightened uncertainty, the opportunity set to run a large portfolio inevitably shrinks. Alex joins us now for more. Alex, good morning. Good to see you.
Good morning. Good to see you.
Better time since we last spoke.
Marginally.
Have things settled down from your standpoint?
In some ways they have, and in some ways they have not. Of course, we can think about the fact that the level of markets is lower than where we last spoke. But at the same time, volatility has also come off the ball a little bit. And so I think the key message, though, is what's happening in the bond market. Has that sort of began to stabilize from last week's jitters? And at the margin, I would say yes, but we're very much still on tenterhooks.
Stability this morning and certainly this week, jitters last week. What did you think the jitters were about?
It wasn't one specific thing. It was a multitude of things. So of course, people were looking at pointing at foreign selling of it, and then there was a specific focus on, say, the fast money community and the levered community that had, like, whether it was bond basis trades or SLR relief trades on the swap spreads. But in truth, it wasn't one specific thing. We actually hosted a large call with our US rate strategy yesterday just to examine and do a deconstruction of this point. And what we found is that it was a combination of both technical and fundamental factors, and including, let's not move away from the fact that this decline in US exceptionalism, which obviously we discussed last time as well.
So Alex, you used the word marginally in responding to John's, it's a better time. Drill in a bit marginally, what are you looking for?
Well, so what our big focus has been is uncertainty. Right, so uncertainty for us is really, especially within equities, is a compression of the multiple. And so what we think has happened within the US equity market, really year to date, is just price in that uncertainty. But we haven't priced in really a recession. We haven't priced in a meaningful decline in earnings. So what we're looking for is either removal of that uncertainty, which will obviously drive, I think, equity markets back up. I don't think they're going to go back to all-time highs in the near term, and that's just because we're still dealing with an administration that could be perceived as quite volatile. But at the same time, we haven't seen that precipitous drop in the economic data as well, which would drive the S&P down to some of the more bearish targets that we're seeing.
So give us your probability distribution between a good removal of uncertainty and a bad removal of uncertainty.
Right now, I would say that we're leaning more towards the bad removal.
By how much?
In terms of the S&P levels.
Yeah.
So I think that if you start to look at, say, a 2022 analog where we didn't actually have a recession, but the market was quite vehement in pricing one in, we troughed it around about 15 to 16 times. If you put that on, say, an unadjusted earnings of, say, call it 255 or 260, which is still growing year on year, just might I add. That's down a lot from where we were, say, at the beginning of the year in the 270s for the S&P. Then we're looking at probably still around about between 4,000 and 4,200 in the S&P.
When you say uncertainty, do you mean tariff policy?
I mean tariff policy, but we've also discussed other aspects of uncertainty, whether it's monetary policy as well. And indeed, I think we've also got to put on the table geopolitical uncertainty as well. We've got to think about what's happening with Iran. We also have to put on the table as well, potentially, if there is an escalation with China that moves beyond just tariffs into more economic warfare, or dare I say even kinetic. And I think that's something that's very hard to discount, but nonetheless, it's something which, again, if we're going to put within the realm of possibilities, I think you have to put everything on the table.
Hearing from the president again this morning, saying I had a very productive call with the president of Mexico just yesterday. Likewise, I met with the highest level Japanese trade representatives. It was a very productive meeting. Every nation, China, wants to meet. Today, Italy. Is there any evidence that China wants to meet?
Not at this moment. I think what China has put out, and this is also through a Bloomberg scoop, this is based on our reporting, is they put out a number of parameters they want the administration to meet before they're even willing to have these conversations. That means reining in some of the hot rhetoric we've heard from cabinet ministers, and also for the president to appoint a point person, put someone in charge of these negotiations.
I know this is frustrating, trying to read the tea leaves of all the communication coming from the White House, but it's interesting. When the president says China wants to meet, and there's no evidence of it, I think maybe spend less time questioning that and question why he's saying it when there's no evidence of it. Because I remember in the first term, and I always repeat this story, when markets were in a pretty volatile period and the president came out and said, just had a call with China, and there was no evidence of the call ever taking place. But the real point was that he said, I've just had a call with China, which gave you the impression he was worried about how investors were responding to the news. Do you think it's important that we're hearing more about negotiations and exemptions and less about punishment of allies?
I think it's very important because at the margin, it's telling us two things, one of which I think you've answered, which is when as much as they say we're not looking at markets, they are looking at markets. And I think last week's bond wobbles was evidence of that. And then, sorry.
I was going to say the president's doing two things at once. He's talking down the market, potentially, talking about the termination of Fed Chair Jay Powell. He's talking up the market about all these calls, the negotiations, and how he's personally involved. Do you think we're at peak uncertainty? The Treasury Secretary told me he thinks the VIX has peaked. Do you think that's true?
I think that the VIX is not really a reflection of uncertainty. I think the VIX is a reflection of many things within the equity market and a function of skew and obviously volatility and whatnot. Do I think we're at peak uncertainty? We may be close to peak uncertainty, but I think you've got to delineate that from, are we at peak, say, negativity? And that's not necessarily the same thing. And that's kind of back to my point in terms of, I think the S&P, or just US markets in general, have done a lot to reflect the fact we're in a new regime of uncertainty. But it definitely has not done all the heavy lifting to reflect all that negativity.
So you're worried about the downside to US equities. If I listened to you and I sold some of my US equities, where would I go?
So this has been obviously the question all year is where do you go? I think there's a couple of things you have to keep in consideration. First of all is the opportunity set. So you have to go where there is genuine valuation opportunities, and that is not necessarily that obvious. We've had a kind of an everything rally for a long period of time. However, there are pockets, and this is something which we discussed last time. For example, some of the LATAM countries are actually behaving incredibly well. You've also got to think about the fact, I mentioned Mexico last time on this panel. And Mexico is a very interesting beneficiary, I think, of what's happening with regard to potential sort of protracted trade war with China. But on top of that, I think we've got to look back again at pockets of Europe as well. For example, Europe trades on 13 times, not particularly cheap, but at the same time, it is embarking upon a fiscal expansion process. And so if you compare that to the US on 21 times, which is going through, at the moment, fiscal neutrality or even fiscal contraction, then you have to sort of start weighing up the odds, okay, where do I want to be? The other point, though, is liquidity. The biggest challenge for investors right now, this is back to the fact that the opportunity set shrinks just simply because the US still represents the best part of 2/3 of global market capitalization.
So the first part of your answer, I hear keep your equity beta where it is, just reallocate from the US to the rest of the world. The second bit of your answer is reduce your beta, your equity beta. Which is it?
I think you reduce equity beta. I don't think it's a prudent place to be in US equities when they're on this valuation with this level of uncertainty. And I think that we have to consider the reality that the longer that this tariff uncertainty goes on, the more damage it's going to do to the economy. If it's resolved quickly, then great. But I think that if we're in it for the long haul, then we have to accept the fact there will be implications to the economy.
Alex, appreciate your time. Great breakdown. Thank you, sir. Alex Ullman there of Barclays on the latest. An ECB rate decision just around the corner. That drops in about 5 minutes' time, 8:30 Eastern time. You'll get jobless claims. And then at 8:45, so in about 40 minutes from now, you'll hear from the president of the ECB, Christine Lagarde. Let's give an update on stories elsewhere this morning. Here is your Bloomberg brief. President Trump with strong remarks for Fed Chair Jay Powell this morning, posting on Truth Social that Powell is too late and wrong, calling on the Fed to cut interest rates, adding that Powell's termination cannot come fast enough. Elsewhere, Taiwan Semi reporting better than expected quarterly sales and maintaining its revenue growth outlook despite tariff risks. The chip maker stressing demand has remained resilient and expects AI revenue to double. And finally, the LVMH CEO, Bernard Arnault, saying the luxury group's demand trends are worsening as aspirational shoppers cut back more than higher-end consumers. Arnault adding tariff talks are also weighing on the outlook. That stock is down just a touch this morning by 1/10%. Up next on the program, we'll catch up with Pooja Kumar of TD Bank with an ECB rate decision just around the corner, and we'll head over to Frankfurt, Germany to catch up with Bloomberg's Lizzie Burden from New York City. You're watching Bloomberg TV.
brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
ECB rate decision about 60 seconds away, so look out for that. In just a moment, we'll head over to Frankfurt, Germany, and catch up with Bloomberg's Lizzie Burden. Equity futures going into it, just about positive on the S&P by 0.5%. On the Nasdaq 100, up by 0.75%. The headline coming from the President of the United States is that Chairman Powell's termination can't come soon enough. Had a bunch of messages from terminal subscribers looking through this, seeing it as noise. And you see that reflected in the bond market. Mohammed, you were talking about this too. Bond market's hardly moved. Yields are higher by 3 basis points. If you really thought that the independence of the central bank, the Federal Reserve, was about to collapse, I imagine you'd be picturing different moves in the bond market this morning.
Oh, totally. You'd see yields higher. You'd have a different reaction, and you would see a lot more disorderly volatility. But you're not seeing that.
Certainly don't have that right now. Anne-Marie, we're going to be waiting for that clarity that comes from the White House. What did he mean by that? What is he talking about? Terminating him or just waiting for the expiration of his term?
We're either going to have to wait for Caroline Leavitt, or at some point if the press sees the president today, which I'm sure they will as he greets Georgia Maloney, they're going to want to know, did you mean the end of May 2026 or do you plan to oust him?
This comes from the ECB. We're getting that cut to interest rates, as expected, 25 basis points. The deposit rate drops to 2.25 from 2.50. The estimate was 2.25. A range of headlines coming from the ECB, not pre-committing to a particular rate path. This is something we've heard repeatedly from the Governing Council and the Central Bank President, Christine Lagarde, not pre-committing. And how can you pre-commit when you don't know what the policy is going to look like elsewhere in the months to come? Joining us now to break this down is Lizzie Burden, live from Frankfurt, Germany. Lizzie, welcome to the program. What do you make of the early headlines as they cross the Bloomberg?
Well, John, Donald Trump made this decision pretty much a no-brainer for the ECB, didn't he, with his tariffs, because the expectation is that they're going to weigh on euro area inflation and on growth. And we haven't seen a retaliation from the EU yet, so they haven't had to deal with the potentially inflationary impact of that retaliation. So given this was well priced, words are more important than actions today, and I'm waiting to see whether they drop this language about monetary policy becoming meaningfully less restrictive, because they added that at the last meeting. Dropping it would be a hawkish signal, and if they drop it, it would signal that maybe there won't be more cuts to come. So we just wait for that now. At the moment, traders have been pricing a 70% chance of a June cut. If Christine Lagarde at this press conference really goes to town on just how bad the growth hit is going to be, you could see traders thinking about a 50 basis point cut when it comes to that June meeting. But I also wonder, how much is she going to address euro-dollar strength head on? Because, of course, it makes imports to the euro area cheaper, disinflationary. It makes exports out of the euro area more expensive, supporting that case to buttress growth. Yeah. And traders are really going to be listening in for this, because today's been such a volatile day for the euro. I think it's the second most volatile on an ECB day ever in history.
Lizzie, you wanted that headline. It just crossed the Bloomberg terminal. They've dropped that word restrictive from the decision statement. I've got the statement in front of me. I just wanted to share this quote with you as well. On trade, the Eurozone economy has been building up some resilience against global shocks. stocks, but the outlook for growth has deteriorated owing to rising trade tensions. Increased uncertainty is likely to reduce confidence among households and firms, and the adverse and volatile market response to the trade tensions is likely to have a tightening impact on financial conditions. These factors may further weigh on the economic outlook for the euro area. Lizzie, what we've seen from a range of officials and from companies, particularly on this side of the Atlantic, is offering dual scenarios. Do you think that's something the ECB president could lean into in the news conference in the next 30 minutes?
I think the fact that they've kept the language about going meeting by meeting and data dependent shows, of course, that they want to hedge their bets at this point, keep their options open, not commit to a particular rate path, because in an environment like this, John, they just don't know what lies ahead, do they? If you think about how much pressure there is on Christine Lagarde today, she's got to try and calm markets, though, because we haven't got a BOE decision this month, we haven't got a Fed decision this month, and you heard Jay Powell last night basically, of course, saying that you can't rely on the Fed for the Fed put. So it's a huge job for her at this press conference to calm them, but I am shocked that they have dropped that language at this meeting.
Lizzie, appreciate the input. Lizzie Burden there, Bloomberg's very own. Look out for Christine Lagarde a little bit later on this morning, 8:45 Eastern time, so in the next 30 minutes or so. If you are just joining us, the ECB reducing interest rates by 25 basis points on the deposit rate, widely expected. The rate was 250, it's now 225. Joining us now to discuss, Pooja Kumra of TD Securities. Pooja, welcome to the programme. I'm sure you've gone over the statement very quickly. What do you make of this decision?
As you said, I'm also surprised that they removed the word restrictive, but we also note that they have downgraded the growth forecast. They are worried about growth. And I think that was maybe a balancing act between, satisfying both the doves and the hawks. And I think we and markets know that in case of Fed, we have a challenge for upward risk to inflation and downward risk to growth. But when it comes to ECB, we have a downward risk to growth and inflation. If you look at the move in euro-dollar, you look at the move in oil prices, you look at the move in financial conditions, ECB is going to be below its inflation target than what they had expected in March. And I think that's very much obvious. And I don't think that ECB can actually turn their eyes with respect to that. And also when it comes to the general policy, they have told us 1.75 to 2.25 is kind of the neutral range. But I think when we think about neutral, we should also think about the circumstances behind that. And if things continue to deteriorate, especially what we saw last week, I think ECB has no choice but to continue with a series of rate cuts.
So, Pooja, they are acknowledging that the financial markets, financial conditions are doing the tightening for them, which is maybe something they've got to lean against. And there's also the prospect, I would say, of them and the continent needing to eat overcapacity out of China, which could be a big, big disinflationary problem down the road. Do you think that's the focus now? Do you think that should be the key risk that they focus on in the year ahead?
Yes, certainly. They have to find a mid-path between how to deal with the US as well as with China. And I think both ways, Europe is getting squeezed right now. The issue is that, does this retaliation turns up into negotiations? So far, when it comes to Europe, we have seen that they do not want to retaliate against Europe. And with respect to China, they're really not telling us any stance. I think at this stage, ECB, especially when as EU is concerned, they like a slower approach. So I think they are just trying to see how US and China evolves in the coming weeks. But I think they have just bought themselves time. In June, we will have the updated forecast, and which will show us a very grim picture if this uncertainty continues.
Pooja, take us inside the Governing Council. How wide do you think the range of views is?
So even, ahead of the Liberation Day, not everyone was expecting an April rate cut, right? We know that there are lots of ECB members that now are getting very careful as to how much they want to cut rates. So there is a lot of disagreement when it comes to this decision. But I think right now, even when you see the risk to the growth, Christine Lagarde herself has mentioned that a 25% tariffs in total could actually mean up to 1% hit to growth. And I think in that case, both doves and hawks will have to agree to the fact that they will need to cut rates. But I think a more effective tool here will be more from the fiscal side, i.e. we see more loan programs from EU, or ECB doing another TLTRO loan targeted program for banks. I think that is more of an effective way of actually supporting all the companies that will be getting hit by this additional tax, which is the tariff tax.
So, Pooja, you raised the issue of other policies, which would be much more effective than the ECB could end up pushing on a string yet again. How risky is it that other policymakers in Europe will slip back into the ECB is the only game in town, let the ECB do all the heavy lifting?
I think everyone expects it's a central bank that needs to do the heavy lifting, and same for the case of Fed. Everyone thinks that Fed will have to actually support the economy ultimately. I think they will need to find a balance here. For me, the key for ECB is how we stand on the financial conditions, because last week we actually thought that this is when you saw the movement in credit spread widening, it's hard for ECB to ignore all these things, even if the hawks think that inflation is not in the right path. Because what we are doing is the supply side and demand side both are getting hit with this entire shock. So I know ECB will be the key player of how things evolve. If they don't, the financial markets will force them to. But I think ultimately the key solution to target this issue will be a proper targeted support to these companies that will actually get the effect from the tariffs.
Pooja, I know people think that it's a joke, but in all seriousness, is the President of the United States basically deciding monetary policy over in Europe?
Unfortunately, not directly, but we can say indirectly, yes, right? The hit to growth, inflation, financial conditions, like whatever you talk about, it's got hit after the Liberation Day.
Pooja, we've got to leave it there. Thanks for dropping by. Important conversation. Pooja Kamran there of TD Securities nailed it. Last time the ECB met, we thought maybe they'd go on pause.
Yep.
We didn't know when the next interest rate reduction was coming or if it would come at all this year. I think people thought it might come maybe later on in the summer. Here we are now. This has changed, Mohammed, because of one reason. The announcement on trade on April 2nd.
It has. But, John, let me ask you a question. I can't remember the last time a federal official referred to the ECB. Can you remember any case of a U.S. president referring to the ECB?
This is new territory.
Yeah.
Without a doubt.
What's so interesting is the president really wants the Fed to cut, but his policies has made it easier for the ECB to cut, which is the point he's making this morning.
And this is going to be the confusion. So if you're sitting here watching this program right now and you're thinking, well, why is the ECB kind of in response to this? Why isn't the Federal Reserve? And I think the explanation is quite simple. The chairman at the moment, ECB has to face something very, very different. And this is something we touched on in that conversation there. If the walls go up in the United States, and you've got this overcapacity issue from China, and China exports all of that, and they only have one major destination to export it to, and it's not the US anymore, Europe has to eat it. The price pressures, the risks in Europe are way, way different versus the United States. You've got upside risk to inflation in the United States. I would say off the back of this, you've got downside risk to inflation in Europe, surely.
Yeah, but that's the wrong response, okay? If you're worried about dumping by other countries, monetary policy is in there. I think I would
put tariffs up, don't cut rates.
A weaker dollar opens the door to other central banks to cut rates.
And we're going to see more of the same in emerging markets as well. This conversation is going to continue. Breaking jobless claims just around the corner. From New York, this is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
The opening now 60 minutes away. Equity futures on the S&P just about positive by 0.5%. On the Nasdaq higher by 0.8. In the bond market, your scores look like this: 2-year, 10-year, and 30-year. One yield to higher by a single basis point across the curve. No drama here whatsoever. The 10-year 429. The 2-year 378. Jobless claims just around the corner. The estimate in our survey 225. The previous number 223. With an update, here's Mike McKee. Good morning, Mike.
Good morning, John. Well, we're waiting for the numbers to drop here. They haven't quite yet, but we do have housing starts down 11.4%. Get back to that in a minute because jobless claims are down 215,000. That's down from revised 224 last week. So there's no news in jobless claims other than what Jay Powell said yesterday. The labor market seems to be in reasonably solid shape. 1,885,000 continuing claims. That is up a little bit from 1,844 in the prior week. 546 federal workers filing for jobless claims. That category so far telling us nothing about what's going on in the federal government firing space. Back to housing starts, down 11.4%. Building permits were up 1.6%. It doesn't look like this was a particularly good month for housing, but every time you talk housing these days, you hear the hold music in the background. There isn't much to say about what housing's contributing to growth. The Philadelphia Fed is one that we really kind of care about today. It may be an unusual day where it's really important, but prices received for the Philly Fed at 30.7 versus 29.8. So more inflation in the Philly Fed numbers. If you're Jay Powell, why would you want to cut rates right now? The prices paid index there at 51, up from 48.3. So inflation in the Philly Fed numbers, Philly Fed overall at 26.4, negative 26.4, down from 12.5. So we are talking about a real collapse of confidence in the manufacturing area around the Philadelphia Fed. This is not good news for the Fed, and it makes the argument both ways. For the Fed. Cut rates because confidence has collapsed. Leave rates where they are because inflation is up.
And Mike McKee, in many ways, the conversation hasn't really changed. Soft data not great, hard data okay. When you look at continuing claims, Mike, it's something that labour market economists have been referencing in recent weeks, that maybe there's evidence that once you're out of work, you can't get a job. What do you see this morning?
Not a whole lot of difference. I mean, what we see here is about a 40,000 increase. It doesn't tell you that there's any significant jump in the number of people who haven't been able to find work. And this number has gone up and down over the last couple of weeks. So labor market, as far as claims are concerned, is still showing the kind of strength it has been showing. And that doesn't give the Fed any reason to think that on a hard data basis, the economy is rolling over.
Mike, where are you on the debate of soft versus hard? Is it just a lag issue, 3 to 4 months, and then the hard data will reflect with the soft data, or is the soft data distorted?
The soft data is probably an indicator of how people are feeling at the moment because the headlines are all so bad. Will that carry through? Probably that depends, Mohammed, on what the president does. If he actually imposes higher tariffs and people see prices going up, they'll react. I'll go back to post 9/11, when consumer confidence cratered and then came right back up again, and people stopped spending for a little bit, but that recession was not a serious one because the country recovered fairly quickly from it. And do we see the same thing happen this time?
Mike, appreciate the update on the economic data there. Mike McKee, equity futures still positive by 0.6% in the bond market. Not much of a move, some stability here. Yields are up at the front of the curve by 0.1%, or rather 1 basis point. We're higher to 378. I'm getting tired. Yields unchanged on a 10-year, 428. Well, a turn to foreign exchange, and we'll talk about percentage point changes. Euro-dollar negative by 0.4%. Euro-dollar down to 115.30.51. The ECB rate decision out just moments ago, cutting interest rates once again, Mohammed, by 25 basis points. They seem to be in a very different position compared to, say, the Federal Reserve and Chairman Powell.
They are. They are at the opposite end of the Fed, and the Bank of England is in the middle of that distribution. But the press conference will be key here, because how President Lagarde conveys the inflation dynamics, not just the growth dynamics. I think the growth dynamics are clear, but the inflation dynamics is going to be very important.
I couldn't agree more. The ECB president kicking off that news conference in about 11 minutes' time. The New York Fed president, John Williams, speaking at the moment, just said this: the economy is in a very good place. Lauren Goodwin of New York Life joins us now for more. Lauren, can I ask you, is the economy in a very good place?
Ooh, I think the economy is in a pretty precarious place, but we're starting from a really strong base. Our economic scenarios coming into this year, we expected growth to slow from around 2.5% to just below 2%. We're now looking at 0.5% of GDP growth out of the U.S. this year. So it's not a recession, but that's a much more worrisome position, let's say, than we expected just a couple of months ago. And perhaps more important than that, though we have about a 50-50 percentage on recession versus not, we're pretty confident that we'll end the year with inflation higher than it is. And so as I see investors look around and say, maybe we'll wait and see how tariffs develop, see how monetary policy developed, I look at that expectation for higher inflation and I say, even if you were going to wait and see, do you have the portfolio that you need to wait and see when we have such inflation volatility?
Let's get into that in a second and just focus on the economy and monetary policy, and then we can get to the market calls. If you think the growth's going to come down from 3 to 0.5 and inflation by the end of the year will be higher than now, Chairman Powell is not giving us any clues on when he'd reduce interest rates. When do you think he'd reduce interest rates, if at all?
I think that the Fed will do as much as it can to do as little as possible. It's just very difficult to change policy credibly in a position where inflation expectations are so on the line. I completely agree with Mike that short-term inflation expectations that we're seeing out of consumers, out of businesses, have de-anchored in a meaningful way in reaction to how people feel right now. I expect that those will come down as reality proves to be less dire. But we're still in an environment where, in order for the Fed to avoid some of the worst case scenarios for the economy, cutting rates doesn't get you there. I don't think cutting rates does much to shore up supply chain challenges. Cutting rates certainly doesn't do much to manage inflation expectations in both short and long-term market interest rates. And so they're going to do everything they can not to move.
So your base case is stagflation?
Stagflation light, where you have a little bit of growth, but inflation moving up. And the difference between being in recession and not in recession, I think, is meaningful for the markets. But when we're looking at the economic scenario, not a whole lot of daylight between a sort of muddle through with inflation as opposed to an outright recession. Our lowest probability, about 15%, is for a recession that's deep enough and demand destruction is pronounced enough to actually bring inflation lower. I think that's the least likely scenario.
You mentioned things like trade and supply chains. The president was out this morning with a few different social media posts, but one of them was about the fact that he talked to Mexico, he talked to the Japanese negotiators, he says even China's waiting to come in, the Italians are here today. What if all these trade barriers and concerns are actually solved within 90 days?
For one, I think it's very unlikely. and expect that the average tariff rate will be higher in a couple of months than it was a couple of months ago, which has a meaningful impact on inflation. But perhaps more important, tariffs are a negotiating tool, but they're also a policy in themselves. We've been hearing from the administration that trade deficit is perceived as a sign of global economic weakness, and it's a challenge that the administration is looking to resolve. On top of that, if the goal of those policies in the end is to reshore some important supply chains, how far that goes remains to be seen. But even so, that's a very capital intensive trend that, frankly, even if tariffs were completely rolled back and we shook our hands of the last couple of weeks, those capital intensive trends are happening. They're underway. And so I see that as an environment where outright disinflation is unlikely.
So Lauren, you teased the portfolio implications of everything we just discussed at the beginning of the interview. So what are they, and how far are investors from where you think they should be?
For starters, the 60-40 portfolio, and look, not all investors use it, but just as a baseline, the 60-40 portfolio was designed for a period where inflation and inflation volatility were low. That's not the situation that we're in right now, and so it's not the benchmark probably that investors should be using. For two, if you think about the last 15 years, the most effective asset allocation, if we're all honest with ourselves, would have been to be 90% invested in U.S. large cap growth equity. We got a couple of extra years of that, even as inflation rates have been higher because of the boom from AI. But as I look forward, I don't think that that's the allocation, that overweight U.S. equity allocation, that makes the most sense moving forward. So geographic rebalancing, I think, is important. We're definitely seeing that out of ex-U.S. investors already. I think U.S. investors need to do the same. We're also looking at building inflation resilience, whether that's in dividend payers or income generating equity, or by taking equity-like risk in credit or in the bond market. And we're considering some hedges for inflation volatility, those moments when you get inflation surprises, so including gold, real estate, other inflation-aware asset classes.
So the one thing you didn't mention is government bonds. You completely avoided government bonds. So let me take you there. What about government bonds?
So I have very high conviction that duration is a tactical bet at best for the foreseeable future. Now, we know that taking the 10-year Treasury bond as an example, there are three things that move the 10-year Treasury. The path of the Fed funds rate over that 10-year period, we're not seeing a lot of price expectation or changing there. Inflation expectations, which have been pretty well anchored, but there's a wide dispersion of estimates so that it moves a little higher. And then the term premium, supply and demand issues. And not only in moves in the 10-year, but also in moves in currency, tell us that demand for treasuries is fraying a bit on the margin. And that makes sense to me, given what we're seeing globally. So that's an environment where I think the 10-year treasury yield is absolutely live between 4 and 5%. So if you can be in the market tactically and trade those moves, sure. But for the average investor that's making, 1 month, 3 month, 2 year changes, duration is not our favorite place to take risk.
Lauren, appreciate the clarity. It's good to see you. As always, thank you. Lauren Goodwin there of New York Life. Just finishing up there on the bond market. The bond market at the moment looks like this. Yields higher by a single basis point across the curve, up by close to 1 on a 10-year to 428. At the front end of the curve, 378. That's the price action. In just a moment, 5 minutes away from a news conference with ECB President Christine Lagarde following an interest rate reduction of 25 basis points. With an update on stories elsewhere this morning, here is your Bloomberg Brief. Recapping the data out just moments ago, initial jobless claims falling to the lowest level in 2 months, coming in lower than expected at 215K. Continuing claims rising to 1.89 million, slightly higher than estimates. Elsewhere, the ECB cutting rates by 25 basis points, citing a deteriorating growth outlook thanks to rising trade tensions. President Lagarde speaking momentarily. We'll bring you those remarks live right here on Bloomberg. And finally, NVIDIA. In the crosshairs of US-China trade tensions, the CEO, Jensen Huang, in Beijing after the Trump administration curbed the sale of its H20 chips to the country. Huang is reportedly meeting with clients, including the founder of DeepSeek. And that right there is your Bloomberg Brief. Up next, we'll set you up for the day ahead, and we'll catch up with ECB President Christine Lagarde. We'll take those comments live from Frankfurt, Germany.
Today's CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders.
What's the hardest part of being a CFO?
It's hard to come up with that.
It's the vast responsibilities, the need to be engaged in different topics.
It's remembering which audience I'm speaking to and what I can say in that context.
The job is not just being the executive of the finance function, it's being an executive for the company.
I would say it's prioritization.
Complete the sentence. The hardest part of being the CFO is
telling people no. It's hard. It's the right thing to do, but it's always hard.
So being just like a touch of a heartbreaker, basically.
Yeah.
We have a plethora of good opportunities. Some are really, really good. But as we strive for the great ones, sometimes those really, really good ones have to be left behind.
New episode premieres April 23rd, only on Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Versace in Davos, Switzerland, and this is Bloomberg.
That argument at the commercial break was better than anything that's been on this morning. Do you want to continue? You good?
We don't agree on
We're
things
live.
this morning.
Counting you down to the opening bell, 45 minutes away. Nice. Equity futures up by 0.6% on the Nasdaq, up by 0.9. Your trading diary looks like this. Today, President Trump meeting with the Italian Prime Minister Giorgia Meloni, and Netflix earnings coming after the closing bell tomorrow. Markets close for Good Friday. Next week, earnings season ramping up with results from Tesla on Tuesday, Wednesday, Boeing reports, and we'll get some PMI data Thursday, durable goods, and another round of jobless claims. And the President of the United States, no doubt, will have a few things to say on trade along the way. In just a moment, we'll have an ECB news conference for you with ECB President Christine Lagarde. Seeing live pictures out the corner of my eye. That's just commencing. When it starts and she starts to address people, we'll take that for you. But enough time for a final word around the table. A final word on a pretty interesting morning going into a long weekend.
I think the president's going to have a lot to say on trade today, but also he's going to be asked about these words regarding this, quote, termination cannot come fast enough for the Fed Chair Jay Powell. What does he mean by termination? The end of Powell's term next year, May? Or can he do something? Can he oust Powell? And the reason why I think this is an important moment is because the context of the Supreme Court basically giving the president the leeway to oust 2 top officials at independent agencies. And this is where I think me and Mohammed differ a little differently about what's going on in this moment right now.
I would just generalize what Anne-Marie just said and refer back to what I think is just one of the best headlines I've seen, which comes from Justin Fox's column in Opinion. Economic uncertainty has never felt this uncertain. I think that is such a powerful sentence.
I'm going to finish the week with some good news. In the bond market, some stability. There was great fear over the last week about a loss of safe haven status in the United States of America. We're ending the week with some stability, and let's hope it stays that way. The bond market pretty much unmoved. A special thanks to Mohammed Al-Arian for the last 2 hours on this programme. To you as well, Anne-Marie.
Thanks.
To Bramo, who's already getting ready for the long weekend. Thanks to Lisa as well, as always. Let's head over to Frankfurt, Germany, and hear from the ECB President Christine Lagarde following a 25 basis point reduction in interest rates.
Based on our updated assessment of the inflation outlook, the dynamics of underlying inflation, and the strength of monetary policy transmission, the disinflation process is well on track. Inflation has continued to develop as staff expected, with both headline and core inflation declining in March. Services inflation has also eased markedly over recent months. Most measures of underlying inflation suggest that inflation will settle at around our 2% medium-term target on a sustained basis. Wage growth is moderating, and profits are partially buffering the impact of still elevated wage growth on inflation. The euro area economy has been building up some resilience against global shocks, but the outlook for growth has deteriorated owing to rising trade tensions. Increased uncertainty is likely to reduce confidence among households and firms, and the adverse and volatile market response to the trade tensions is likely to have a tightening impact on financing conditions. These factors may further weigh on the economic outlook for the euro area. We are determined to ensure that inflation stabilizes sustainably at our 2% medium-term target. Especially in current conditions of exceptional uncertainty, we will follow a data-dependent and meeting-by-meeting approach to determining the appropriate monetary policy stance. In particular, our interest rate decisions will be based on our assessment of the inflation outlook in light of the incoming economic and financial data, the dynamics of underlying inflation, and the strength of monetary policy transmission. We are not pre-committing to a particular rate path. The decisions taken today are set out in a press release available on our website. I will now outline in more detail how we see the economy and inflation developing, and will then explain our assessment of financial and monetary conditions. So the economic outlook is clouded by exceptional uncertainty. Euro area exporters face new barriers to trade, although their scope remains unclear. Disruptions to international commerce, financial market tensions, and geopolitical uncertainty are weighing on business investment. As consumers become more cautious about the future, they may hold back spending as well. At the same time, the euro area economy has been building up some resilience against the global shocks. The economy is likely to have grown in the first quarter of the year, and manufacturing has shown signs of stabilization. Unemployment fell to 6.1% in February, its lowest level since the launch of the euro. A strong labor market, higher real incomes, and the impact of our monetary policy should underpin spending. The important policy initiatives that have been launched at the national and EU levels to increase defense spending and infrastructure investment can be expected to bolster manufacturing, which is also reflected in recent surveys. In the present geopolitical environment, it is even more urgent for fiscal and structural policies to make the euro area economy more productive, competitive, and resilient. The European Commission's Competitiveness Compass provides a concrete roadmap for action, and its proposals, including on simplification, should be swiftly adopted. This includes completing the Savings and Investment Union, following a clear and ambitious timetable, which should help savers benefit from more opportunities to invest and improve firms' access to finance, especially risk capital. It is also important to rapidly establish the legislative framework to prepare the ground for the potential introduction of the digital euro. Governments should ensure sustainable public finances in line with the EU's economic governance framework and prioritize essential growth-enhancing structural reforms and strategic investments. Annual inflation edged down to 2.2% in March. Energy prices fell by 1% after a slight rise in February, while food price inflation rose to 2.9% in March, from 2.7% in February. Goods inflation was stable at 0.6%. Services inflation fell again in March to 3.5%, and it now stands 0.5 percentage point below the rate recorded at the end of last year. Most indicators of underlying inflation are pointing to a sustained return of inflation to our 2% medium-term target. Domestic inflation has declined since the end of 2024. Wages are gradually moderating. In the last quarter of 2024, annual growth in compensation per employee stood at 4.1%, down from 4.5% in the previous quarter. Rising productivity also meant that unit labor costs grew more slowly. The ECB's wage tracker and information from our contacts with companies point to a decline in wage growth in 2025, as also indicated in the March staff projections. Unit profit fell at an annual rate of 1.1% at the end of last year, contributing to lower domestic inflation. Most measures of longer-term inflation expectations continue to stand at around 2%, which supports the sustainable return of inflation to our target. To economic growth have increased. The major escalation in global trade tensions and associated uncertainties will likely lower euro area growth by dampening exports, and it may drag down investment and consumption. Deteriorating financial market sentiment could lead to tighter financing conditions, increased risk aversion, and make firms and households less willing to invest and consume. Geopolitical tensions, such as Russia's unjustified war against Ukraine and the tragic conflict in the Middle East, also remain a major source of uncertainty. At the same time, the increase in defense and infrastructure spending would add to growth. Increasing global trade disruptions are adding more uncertainty to the outlook for euro area inflation. Falling global energy prices and appreciation of the euro could put further downward pressure on inflation. This could be reinforced by lower demand for euro area exports owing to a higher tariff and a rerouting of exports into the euro area from countries with overcapacity. Adverse financial market reactions to the trade tensions could weigh on domestic demand and thereby also lower inflation. By contrast, a fragmentation of global supply chains could raise inflation by pushing up import prices. A boost in defense and infrastructure spending could also raise inflation over the medium term. Extreme weather events and the unfolding climate crisis more broadly could drive up food prices by more than expected. Looking at the financial and monetary conditions now. Risk-free interest rates have declined in response to the escalating trade tensions. Equity prices have fallen amid high volatility, and corporate bond spreads have widened around the globe. The euro has strengthened over recent weeks as investor sentiment has proven more resilient towards the euro area than towards other economies. The latest official statistics on corporate borrowing, which predated these market tensions, continued to indicate that our interest rate cuts had made it less expensive for firms to borrow. The average interest rate on new loans to firms declined to 4.1% in February from 4.3% in January. Firms' cost of issuing market-based debt declined to 3.5% in February, but there has been some upward pressure more recently. Moreover, growth in lending to firms picked up again in February to 2.2%, while debt securities issuance by firms grew at an unchanged rate of 3.2%. At the same time, credit standards for business loans tightened slightly again in the first quarter of 2025, as reported in our latest bank lending survey for the euro area. As in the previous quarter, this was mainly because banks are becoming more concerned about the economic risks faced by their customers. Demand for loans to firm decreased slightly in the first quarter after a modest recovery in previous quarters. The average rate on new mortgages at 3.3% in February increased on the back of earlier rises in longer-term market rates. Mortgage lending continued to strengthen in February, albeit at a still subdued annual rate of 1.5%, as banks eased their credit standards and demand for loans to households continued to increase strongly. So, in conclusion, the Governing Council decided today to lower the three key ECB interest rates by 25 basis points. In particular, the decision to lower the deposit facility rate, the rate through which we steer the monetary policy stance, is based on our updated assessment of the inflation outlook, the dynamics of underlying inflation, and the strength of monetary policy transmission. We are determined to ensure that inflation stabilizes sustainably at our 2% medium-term target. Especially in current conditions of exceptional uncertainty, we will follow a data-dependent and meeting-by-meeting approach to determining the appropriate monetary policy stance. In particular, our interest rate decisions will be based on our assessment of the inflation outlook in light of the incoming economic and financial data, the dynamics of underlying inflation, and the strength of monetary policy transmission. We are not pre-committing to a particular rate path. In any case, we stand ready to adjust all of our instruments within our mandate to ensure that inflation stabilizes sustainably at our medium-term target and to preserve the smooth functioning of monetary policy transmission. We are now ready to take your questions. Thank you very much.
And today the first question goes to Annette Weisbach of CNBC. Annette, please.
President Lagarde, thank you for taking my question. The first one would be on the rate cut. So 25 basis points, has that been backed by everybody, and has there been a discussion about potentially cutting by 50? And then I would like to know your assessment about the re-inflationary or disinflationary effect of tariffs, because there the jury seems to be still out, but you seem to rather err on the side of that it has disinflationary effects. If I'm reading through your statement, perhaps you could tell me if I'm right. Thanks.
Well, thank you so much for your two questions. I can confirm to you that the decision to cut rates by 25 basis points was a unanimous decision. Options were debated, but there was no one to argue in favor of a 50 basis points cut, for instance. So 25 basis points was definitely the rate cut on which all in the room agreed. Looking at today, and I will happily address the issue of why we actually cut rate, because I think it's a twofold rationale. But looking at today and the tariffs debate that is going on, as well as the tariff impact that is actually happening, we know that it's a negative demand shock. We can anticipate that it will have some impact on growth, but the net impact on inflation will only become clearer over the course of time. And there are diverging views as to the short-term and the longer-term impact of the various, the development of circumstances, because let's be clear, we have a lot of uncertainty still today, and there will be many decisions and many implementation that will take place over the course of the next few weeks and months that will be decisive to err in one direction or the other. But I think the net impact of inflation will become clear over that period. Clearer, I shouldn't say clear. Clearer over the course of time. Thank you.
Thank you. And next question goes to Jana Rando of Bloomberg.
Thank you very much. In your policy statement and also in your remarks now, you no longer characterize the policy stance on the restrictive, neutral, accommodative spectrum. And I would be quite interested in why you decided to do that and what kind of conclusions we are to draw from that. And following on, I would like to know whether the direction of travel, as you so often have said, is still clear on policy ahead. And then I want to pick up, so that's kind of a big first one, and I do want to pick up on what you told Annette just now about options were debated. Would you care to elaborate a little bit more on what kind of options were debated? Thank you.
Well, on your first twofold questions, right? Shall we call it that way? So, your first question, I think, is very relevant because we did remove from the monetary policy statement a sentence that referred to the restrictiveness and, in particular, as lately qualified the meaningfully restrictiveness or not. And while that assessment of the restrictiveness was meaningful or made sense, to the extent that we were very far away from destination. It is meaningless at this point in time. Meaningless because assessing restrictiveness relies heavily on the comparison between the policy rates and the neutral rate. And I think I had the opportunity in front of this esteemed group to give you my views, and I think the views that are shared by many of us on the Governing Council concerning the neutral rate. Our view, my view certainly, is that the neutral rate, apart from the measurements issues associated with it, is a concept that works for a shock-free world. That's how it is described. And anybody in this room who thinks that we are in a shock-free world, would I suggest maybe raise their hands or have their head examined, either way. But we are not in a shock-free world, that's for sure. So that assessment of the restrictiveness is not operative anymore. And what we need to do is to determine the appropriate monetary policy stance that will actually take us to our destination. And I will not comment on the direction of travel. I will comment on the destination. That, as you know, is our 2% target in a sustained manner. I think given the cloud of uncertainty that we have, the multiple decisions that are expected, or lack of it, in the next few weeks and months, our stance will have to be determined by two key attributes. And the first one is readiness. We must be attentive to all the developments, and in particular the development of those new shocks, and be able to make the appropriate determination. And that's the first one. The second one is agility. Given the speed at which we see development, the impact they have, the spillovers that we can analyze, it's not going to be a question of rushing to a particular stance, but it will be a question of agility in the face of what we are seeing. And that will require a cohesive approach that will be based more than ever on the analysis of data. So when I have said repeatedly, we need to be data dependent and we need to decide meeting by meetings, and we do not have a predetermined path. I know this has been annoying for some, because there's nothing like having a bit more certainty, anticipating where it's going. more than ever now, we need to be data dependent, and we need to rely on safe, reliable data. We are going to be particularly attentive to all that at the moment. And we will decide meeting by meeting. What is certain is destination. And we're determined to take whatever measures will be appropriate and to use whatever instruments will be appropriate to arrive at that destination. Now, you asked me about the debate. We always debate. And we debate on, all sides of the decision that we ultimately arrive at. And in total candor with you, there were a number of governors who, a few weeks ago, would have argued in favor of a skip. Uncertainty, halo of fog around our navigation, it calls for a skip, and then we will decide when we have more data, the projection exercise that is built with the central bank and the national central banks together. So that was on one side of the debate, if you will. And there were some to say, well, it might warrant a 50, but at the end of the day, this is not what I'm arguing for. So when I say debated, but there was not any single argument in favor of arriving at 50 basis points. So it was a very strong 25 rally of everybody. But we debate, and we, hypothetically try to figure out what it would have been if, or what it would imply if. But I can tell you that it was, I'm sure that you will all do your homework to find out who said what and all the rest of it. But I can assure you that it was unanimous rally about 25 basis points. Thank you.
Thank you. Next question, Balazs Kourani of Reuters. Balazs, please.
Good afternoon, President Lagarde. First question is about the outlook. A couple of weeks ago in Parliament, you presented some numbers on the possible impact of a trade war. I wonder if you have an update for us, whether there was such an update made in the Governing Council. Quite a lot has changed. I'm especially interested in what you make of the tariffs, and also sharply lower energy prices, significant appreciation of the euro. These all change quite a bit for you. Second question is about your relationship with the Federal Reserve. And I'm asking this because just moments before the decision itself, of course, the US president came out and criticized the Fed, which raises questions about Fed independence and whether the Fed can remain independent. So the question for you is, do you think there is a risk that central banks around the world start to lose independence in this current environment? Also, you have a really important relationship with the Fed, with the swaps. The swaps. Are you confident that the swaps remain in place, they're safe, that you can rely on it? And are you making any sort of contingency plans in case the Fed changes policy on those?
That's a lot of questions, huh? So your first one had to do with whether or not I quantify the current situation relative to previous assessment of the situation. And I will say that I will characterize it as follows. We are in the presence of a negative demand shock, no question about that. But this is not in and of itself, because we can anticipate, and let me be clear on that. When I say we are in the presence of a negative demand shock, some of the tariffs are already in place. And from an approximately 3% average tariff, we are now in the presence of a 13, I'm not giving you the decimal, but roughly it went from 3-ish to 13% in terms of custom duties on average on goods, not goods and services. So that's what we face now. But we also have the prospect of something that could be far more impactful, number one. Number two, there is a series of potential responses on the part of the Commission. We know one or two or three of them, depending on the tactic that is adopted.